Hello everyone, and welcome to the channel. In today's audiobook, we dive into trading price action, trading ranges, technical analysis of price charts, bar by bar for the serious trader by Al Brooks. If you're a day trader, swing trader, or anyone serious about mastering price action in the markets, this book is a game changer. Al Brooks, a veteran trader with over 25 years of experience, breaks down how to read and trade price charts bar by bar, focusing on trading ranges, which markets spend most of their time in. In this audiobook, we'll dive deep into real-world examples using primarily 5-minute charts, but with insights applicable to daily and weekly timeframes as well. You'll learn how to spot profitable opportunities in sideways markets, handle breakouts effectively, and understand the key magnets that pull prices like support and resistance. Whether you're trading stocks, forex, futures, or options, Al's no-nonsense, pure price action approach will help you make smarter entry and exit decisions without relying on indicators. If you're new here, hit that subscribe button and turn on notifications so you don't miss any chapters. Like and comment below if you're excited to level up your trading. Let's get started with part 1. This is the second book in Al Brooks's acclaimed Trading Price Action series, essential for serious traders who want to master bar-by-bar analysis. While markets trend only about 20–30% of the time, they spend the majority in trading ranges, and this book teaches you exactly how to profit from them using pure price action on candle charts. Al Brooks draws from decades of real trading experience to explain complex concepts with detailed chart examples, primarily 5-minute E-mini charts, but applicable to stocks, forex, futures, and more. Key topics covered. Part 1. Breakouts. Transitioning into a new trend. Chapter 1. Example of how to trade a breakout. Chapter 2. Signs of strength in a breakout. Chapter 3. Initial breakout. Chapter 4. Breakout entries and existing strong trends. Chapter 5. Failed breakouts, breakout pullbacks, and breakout tests. Chapter 6. Gaps. Part 2. Magnets. Support and resistance. Chapter 7. Measured moves, based on the size of the first leg, the spike. Chapter 8. Measured moves based on gaps and trading ranges. Chapter 9. Reversals often end at signal bars from prior failed reversals. Chapter 10. Other magnets. This audiobook is designed to help traders understand why price moves the way it does, giving you the structure and confidence to trade ranges, breakouts, and trends with greater consistency. Let's get started.
Introduction. There is a reason why there is no other comprehensive book about price action written by a trader. It takes thousands of hours, and the financial reward is meager compared to that from trading. However, with my 3 girls now away in grad school, I have a void to fill, and this has been a very satisfying project. I originally planned on updating the first edition of Reading Price Charts Bar by Bar, John Wiley & Sons, 2009. But as I got into it, I decided instead to go into great detail about how I view and trade the markets. I am metaphorically teaching you how to play the violin. Everything you need to know to make a living at it is in these books, but it is up to you to spend the countless hours learning your trade. After a year of answering thousands of questions from traders on my website at www.brookspriceaction.com, I think that I have found ways to express my ideas much more clearly, and these books should be easier to read than that one. The earlier book focused on reading price action, and this series of books is instead centered on how to use price action to trade the markets. Since the book grew to more than 4 times as many words as the first book, John Wiley & Sons decided to divide it into 3 separate books. This first book covers price action basics and trends. The second book is on trading ranges, order management, and the mathematics of trading, and the final book is about trend reversals, day trading, daily charts, options, and the best setups for all time frames. Many of the charts are also in Reading Price Charts Bar by Bar, but most have been updated, and the discussion about the charts has also been largely rewritten. Only about 5% of the 120,000 words from that book are present in the 570,000 words in this new series, so readers will find little duplication. My goals in writing this series of 3 books are to describe my understanding of why the carefully selected trades offer great risk-reward ratios, and to present ways to profit from the setups. I am presenting material that I hope will be interesting to professional traders and students in business school, but I also hope that even traders starting out will find some useful ideas. Everyone looks at price charts, but usually just briefly and with a specific or limited goal. However, every chart has an incredible amount of information that can be used to make profitable trades. But much of it can be used effectively only if traders spend time to carefully understand what each bar on the chart is telling them about what institutional money is doing. 90% or more of all trading in large markets is done by institutions, which means that the market is simply a collection of institutions. Almost all are profitable over time, and the few that are not soon go out of business. Since institutions are profitable and they are the market, every trade that you take has a profitable trader, a part of the collection of institutions, taking the other side of your trade. No trade can take place without one institution willing to take one side and another willing to take the other. The small volume trades made by individuals can only take place if an institution is willing to take the same trade. If you want to buy at a certain price, the market will not get to that price unless one or more institutions also want to buy at that price. You cannot sell at any price unless one or more institutions are willing to sell there, because the market can only go to a price where there are institutions willing to buy and others willing to sell. If the E-mini is at 1264 and you are long with a protective sell stop at 1262, your stop cannot get hit unless there is an institution who is also willing to sell at 1262. This is true for virtually all trades. If you trade 200 E-mini contracts, then you are trading institutional volume and are effectively an institution, and you will sometimes be able to move the market a tick or two. Most individual traders, however, have no ability to move the market, no matter how stupidly they are willing to trade. The market will not run your stops. The market might test the price where your protective stop is, but it has nothing to do with your stop. It will only test that price if one or more institutions believe that it is financially sound to sell there and other institutions believe that it is profitable to buy there. At every tick, there are institutions buying and other institutions selling, and all have proven systems that will make money by placing those trades. You should always be trading in the direction of the majority of institutional dollars because they control where the market is heading. At the end of the day, when you look at a printout of the day's chart, how can you tell what the institutions did during the day? The answer is simple. Whenever the market went up, the bulk of institutional money was buying, and whenever the market went down, more money went into selling. Just look at any segment of the chart where the market went up or down and study every bar, and you will soon notice many repeatable patterns. With time, you will begin to see those patterns unfold in real time, and that will give you confidence to place your trades. Some of the price action is subtle, so be open to every possibility. For example, sometimes when the market is working higher, a bar will trade below the low of the prior bar, yet the trend continues higher. You have to assume that the big money was buying at and below the low of that prior bar, and that is also what many experienced traders were doing. They bought exactly where weak traders let themselves get stopped out with a loss, or where other weak traders shorted, believing that the market was beginning to sell off. Once you get comfortable with the idea that strong trends often have pullbacks and big money is buying them rather than selling them, you will be in a position to make some great trades that you previously thought were exactly the wrong thing to do. Don't think too hard about it. If the market is going up, institutions are buying constantly, even at times when you think that you should stop yourself out of your long with a loss. Your job is to follow their behavior and not use too much logic to deny what is happening right in front of you. It does not matter if it seems counterintuitive. All that matters is that the market is going up, and therefore institutions are predominantly buying, and so should you. Institutions are generally considered to be smart money, meaning that they are smart enough to make a living by trading, and they trade a large volume every day. Television still uses the term institution to refer to traditional institutions like mutual funds, banks, brokerage houses, insurance companies, pension funds, and hedge funds. These companies used to account for most of the volume, and they mostly trade on fundamentals. Their trading controls the direction of the market on daily and weekly charts and a lot of the big intraday swings. Until a decade or so ago, most of the trade decisions were made, and most trading was done by very smart traders, but it is now increasingly being done by computers. They have programs that can instantly analyze economic data and immediately place trades based on that analysis, without a person ever being involved in the trade. In addition, other firms trade huge volumes by using computer programs that place trades based on the statistical analysis of price action. Computer-generated trading now accounts for as much as 70% of the day's volume. Computers are very good at making decisions, and playing chess and winning at Jeopardy are more difficult than trading stocks. Garry Kasparov for years made the best chess decisions in the world, yet a computer made better decisions in 1997 and beat him. Ken Jennings was heralded as the greatest Jeopardy! Player of all time, yet a computer destroyed him in 2011. It is only a matter of time before computers are widely accepted as the best decision-makers for institutional trading. Since programs use objective mathematical analysis, there should be a tendency for support and resistance areas to become more clearly defined. For example, measured move projections should become more precise as more of the volume is traded based on precise mathematical logic. Also, there might be a tendency toward more protracted tight channels as programs buy small pullbacks on the daily chart. However, if enough programs exit longs or go short at the same key levels, sell-offs might become larger and faster. Will the changes be dramatic? Probably not, since the same general forces were operating when everything was done manually, but nonetheless, there should be some move toward mathematical perfection as more of the emotion is removed from trading. As these other firms contribute more and more to the movement of the market, and as traditional institutions increasingly use computers to analyze and place their trades, the term institution is becoming vague. It is better for an individual trader to think of an institution as any of the different entities that trade enough volume to be a significant contributor to the price action. Since these buy and sell programs generate most of the volume, they are the most important contributor to the appearance of every chart, and they create most of the trading opportunities for individual investors. Yes, it's nice to know that Cisco Systems, Cisco, had a strong earnings report and is moving up, and if you are an investor who wants to hold stock for many months, then do what the traditional institutions are doing and buy Cisco. However, if you are a day trader, ignore the news and look at the chart, because the programs will create patterns that are purely statistically based and have nothing to do with fundamentals, yet offer great trading opportunities. The traditional institutions placing trades based on fundamentals determine the direction and the approximate target of a stock over the next several months. But increasingly, firms using statistical analysis to make day trades and other short-term trades determine the path to that target and the ultimate high or low of the move. Even on a macro level, fundamentals are only approximate at best. Look at the crashes in 1987 and 2009. Both had violent sell-offs and rallies, yet the fundamentals did not change violently in the same short period of time. In both cases, the market got sucked slightly below the monthly trend line and reversed sharply up from it. The market fell because of perceived fundamentals, but the extent of the fall was determined by the charts. There are some large patterns that repeat over and over on all time frames and in all markets, like trends, trading ranges, climaxes, and channels. There are also lots of smaller tradable patterns that are based on just the most recent few bars. These books are a comprehensive guide to help traders understand everything they see on a chart, giving them more opportunities to make profitable trades and to avoid losers. The most important message that I can deliver is to focus on the absolute best trades, avoid the absolute worst setups, use a profit objective reward that is at least as large as your protective stop risk, and work on increasing the number of shares that you are trading. I freely recognize that every one of my reasons behind each setup is just my opinion, and my reasoning about why a trade works might be completely wrong. However, that is irrelevant. What is important is that reading price action is a very effective way to trade, and I have thought a lot about why certain things happen the way they do. I am comfortable with my explanations, and they give me confidence when I place a trade. However, they are irrelevant to my placing trades, so it is not important to me that they are right. Just as I can reverse my opinion about the direction of the market in an instant, I can also reverse my opinion about why a particular pattern works if I come across a reason that is more logical, or if I discover a flaw in my logic. I am providing the opinions because they appear to make sense. They might help readers become more comfortable trading certain setups, and they might be intellectually stimulating, but they are not needed for any price action trades. The books are very detailed and difficult to read, and are directed towards serious traders who want to learn as much as they can about reading price charts. However, the concepts are useful to traders at all levels. The books cover many of the standard techniques described by Robert D. Edwards and John Magee. Technical Analysis of Stock Trends, Amicom, 9th ed. 2007, and others, but focus more on individual bars to demonstrate how the information they provide can significantly enhance the risk-reward ratio of trading. Most books point out 3 or 4 trades on a chart, which implies that everything else on the chart is incomprehensible, meaningless, or risky. I believe that there is something to be learned from every tick that takes place during the day, and that there are far more great trades on every chart than just the few obvious ones. But to see them, you have to understand price action, and you cannot dismiss any bars as unimportant. I learned from performing thousands of operations through a microscope that some of the most important things can be very small. I read charts bar by bar and look for any information that each bar is telling me. They are all important. At the end of every bar, most traders ask themselves, what just took place? With most bars, they conclude that there is nothing worth trading at the moment, so it is just not worth the effort to try to understand. Instead, they choose to wait for some clearer and usually larger pattern. It is as if they believe that the bar did not exist, or they dismiss it as just institutional program activity that is not tradable by an individual trader. They do not feel like they are part of the market at these times, but these times constitute the vast majority of the day. Yet, if they look at the volume, all of those bars that they are ignoring have as much volume as the bars they are using for the basis for their trades. Clearly, a lot of trading is taking place, but they don't understand how that can be and essentially pretend that it does not exist. But that is denying reality. There is always trading taking place, and as a trader, you owe it to yourself to understand why it's taking place and to figure out a way to make money off of it. Learning what the market is telling you is very time-consuming and difficult, but it gives you the foundation that you need to be a successful trader. Unlike most books on candle charts, where the majority of readers feel compelled to memorize patterns, these 3 books of mine provide a rationale for why particular patterns are reliable setups for traders. Some of the terms used have specific meaning to market technicians, but different meanings to traders, and I am writing this entirely from a trader's perspective. I am certain that many traders already understand everything in these books, but likely wouldn't describe price action in the same way that I do. There are no secrets among successful traders. They all know common setups, and many have their own names for each one. All of them are buying and selling pretty much at the same time, catching the same swings, and they all have their own reasons for getting into a trade. Many trade price action intuitively, without ever feeling a need to articulate why a certain setup works. I hope that they enjoy reading my understanding of and perspective on price action, and that this gives them some insights that will improve their already successful trading. The goal for most traders is to maximize trading profits through a style that is compatible with their personalities. Without that compatibility, I believe that it is virtually impossible to trade profitably for the long term. Many traders wonder how long it will take them to be successful and are willing to lose money for some period of time, even a few years. However, it took me over 10 years to be able to trade successfully. Each of us has many considerations and distractions, so the time will vary, but a trader has to work through most obstacles before becoming consistently profitable. I had several major problems that had to be corrected, including raising 3 wonderful daughters who always filled my mind with thoughts of them and what I needed to be doing as their father. That was solved as they got older and more independent. Then it took me a long time to accept many personality traits as real and unchangeable, or at least I concluded that I was unwilling to change them. And finally, there was the issue of confidence. I have always been confident to the point of arrogance in so many things that those who know me would be surprised that this was difficult for me. However, deep inside I believed that I really would never come up with a consistently profitable approach that I would enjoy employing for many years. Instead, I bought many systems, wrote and tested countless indicators and systems, read many books and magazines, went to seminars, hired tutors, and joined chat rooms. I talked with people who presented themselves as successful traders, but I never saw their account statements and suspect that most could teach but few, if any, could trade. Usually in trading, those who know don't talk, and those who talk don't know. This was all extremely helpful because it showed all of the things that I needed to avoid before becoming successful. Any non-trader who looks at a chart will invariably conclude that trading has to be extremely easy, and that is part of the appeal. At the end of the day, anyone can look at any chart and see very clear entry and exit points. However, it is much more difficult to do it in real time. There is a natural tendency to want to buy the exact low and never have the trade come back. If it does, a novice will take the loss to avoid a bigger loss, resulting in a series of losing trades that will ultimately bust the trader's account. Using wide stops solves that to some extent, but invariably traders will soon hit a few big losses that will put them into the red and make them too scared to continue using that approach. Should you be concerned that making the information in these books available will create lots of great price action traders, all doing the same thing at the same time, thereby removing the late entrants needed to drive the market to your price target? No, because the institutions control the market, and they already have the smartest traders in the world, and those traders already know everything in these books, at least intuitively. At every moment, there is an extremely smart institutional bull taking the opposite side of the trade being placed by an extremely smart institutional bear. Since the most important players already know price action, having more players know it will not tip the balance one way or the other. I therefore have no concern that what I am writing will stop price action from working. Because of that balance, any edge that anyone has is always going to be extremely small, and any small mistake will result in a loss, no matter how well a person reads a chart. Although it is very difficult to make money as a trader without understanding price action, that knowledge alone is not enough. It takes a long time to learn how to trade after a trader learns to read charts, and trading is just as difficult as chart reading. I wrote these books to help people learn to read charts better and to trade better, and if you can do both well, you deserve to be able to take money from the accounts of others and put it into yours. The reason why the patterns that we all see do unfold as they do is because that is the appearance that occurs in an efficient market with countless traders placing orders for thousands of different reasons, but with the controlling volume being traded based on sound logic. That is just what it looks like, and it has been that way forever. The same patterns unfold in all time frames in all markets around the world, and it would simply be impossible for all of it to be manipulated instantaneously on so many different levels. Price action is a manifestation of human behavior and therefore actually has a genetic basis. Until we evolve, it will likely remain largely unchanged, just as it has been unchanged for the 80 years of charts that I have reviewed. Program trading might have changed the appearance slightly, although I can find no evidence to support that theory. If anything, it would make the chart smoother because it is unemotional, and it has greatly increased the volume. Now that most of the volume is being traded automatically by computers, and the volume is so huge, irrational and emotional behavior is an insignificant component of the markets, and the charts are a purer expression of human tendencies. Since price action comes from our DNA, it will not change until we evolve. When you look at the two charts in Figure 1.1, your first reaction is that they are just a couple of ordinary charts, but look at the dates at the bottom. These weekly Dow Jones Industrial Average charts from the Depression era and from World War II have the same patterns that we see today on all charts, despite most of today's volume being traded by computers. If everyone suddenly became a price action scalper, the smaller patterns might change a little for a while, but over time, the efficient market will win out, and the votes by all traders will get distilled into standard price action patterns, because that is the inescapable result of countless people behaving logically. Also, the reality is that it is very difficult to trade well, and although basing trades on price action is a sound approach, it is still very difficult to do successfully in real time. There just won't be enough traders doing it well enough, all at the same time, to have any significant influence over time on the patterns. Just look at Edwards and Maggi. The best traders in the world have been using those ideas for decades, and they continue to work. Again, for the same reason charts look the way they do, because that is the unchangeable fingerprint of an efficient market filled with a huge number of smart people using a huge number of approaches and time frames, all trying to make the most money that they can. For example, Tiger Woods is not hiding anything that he does in golf, and anyone is free to copy him. However, very few people can play golf well enough to make a living at it. The same is true of trading. A trader can know just about everything there is to know and still lose money, because applying all that knowledge in a way that consistently makes money is very difficult to do. Why do so many business schools continue to recommend Edwards and Maggi when their book is essentially simplistic? largely using trend lines, breakouts, and pullbacks as the basis for trading. It is because it works, and it always has, and it always will. Now that just about all traders have computers with access to intraday data, many of those techniques can be adapted to day trading. Also, candle charts give additional information about who is controlling the market, which results in a more timely entry with smaller risk. Edwards and Maggie's focus is on the overall trend. I use those same basic techniques, but pay much closer attention to the individual bars on the chart to improve the risk-reward ratio, and I devote considerable attention to intraday charts. It seemed obvious to me that if one could simply read the charts well enough to be able to enter at the exact times when the move would take off and not come back, then that trader would have a huge advantage. The trader would have a high winning percentage, and the few losses would be small. I decided that this would be my starting point, and what I discovered was that nothing had to be added. In fact, any additions are distractions that result in lower profitability. This sounds so obvious and easy that it is difficult for most people to believe. I'm a day trader who relies entirely on price action on the intraday E-mini S&P 500 futures charts, and I believe that reading price action well is an invaluable skill for all traders. Beginners often instead have a deep-seated belief that something more is required, that maybe some complex mathematical formula that very few use would give them just the edge that they need. Goldman Sachs is so rich and sophisticated that its traders must have a supercomputer and high-powered software that gives them an advantage that ensures that all the individual traders are doomed to failure. They start looking at all kinds of indicators and playing with the inputs to customize the indicators to make them just right. Every indicator works some of the time, but for me, they obfuscate instead of elucidate. In fact, without even looking at a chart, you can place a buy order and have a 50% chance of being right. I am not dismissing indicators and systems out of ignorance of their subtleties. I have spent over 10,000 hours writing and testing indicators and systems over the years, and that probably is far more experience than most have. This extensive experience with indicators and systems was an essential part of my becoming a successful trader. Indicators work well for many traders, but the best success comes once a trader finds an approach that is compatible with his or her personality. My single biggest problem with indicators and systems was that I never fully trusted them. At every setup, I saw exceptions that needed to be tested. I always wanted every last penny out of the market and was never satisfied with a return from a system if I could incorporate a new twist that would make it better. You can optimize constantly, but since the market is always changing from strong trends to tight trading ranges and then back again, and your optimizations are based on what has recently happened, they will soon fail as the market transitions into a new phase. I am simply too controlling, compulsive, restless, observant, and untrusting to make money in the long term off indicators or automated systems. But I am at the extreme in many ways, and most people don't have these same issues. Many traders, especially beginners, are drawn to indicators or any other higher power, guru, TV pundit, or newsletter that they want to believe will protect them and show their love and approval of them as human beings by giving them lots of money, hoping that an indicator will show them when to enter a trade. What they don't realize is that the vast majority of indicators are based on simple price action. And when I am placing trades, I simply cannot think fast enough to process what several indicators might be telling me. If there is a bull trend, a pullback, and then a rally to a new high, but the rally has lots of overlapping bars, many bare bodies, a couple of small pullbacks, and prominent tails on the tops of the bars, any experienced trader would see that it is a weak test of the trend high, and that this should not be happening if the bull trend was still strong. The market is almost certainly transitioning into a trading range and possibly into a bear trend. Traders don't need an oscillator to tell them this. Also, oscillators tend to make traders look for reversals and focus less on price charts. These can be effective tools on most days when the market has 2 or 3 reversals lasting an hour or more. The problem comes when the market is trending strongly. If you focus too much on your indicators, you will see that they are forming divergences all day long, and you might find yourself repeatedly entering countertrend and losing money. By the time you come to accept that the market is trending, you will not have enough time left in the day to recoup your losses. Instead, If you were simply looking at a bar or candle chart, you would see that the market is clearly trending, and you would not be tempted by indicators to look for trend reversals. The most common successful reversals first break a trend line with strong momentum and then pull back to test the extreme. And if traders focus too much on divergences, they will often overlook this fundamental fact. Placing a trade because of a divergence in the absence of a prior countertrend momentum surge that breaks a trend line is a losing strategy. Wait for the trend line break and then see if the test of the old extreme reverses or if the old trend resumes. You do not need an indicator to tell you that a strong reversal here is a high probability trade, at least for a scalp, and there will almost certainly be a divergence. So why complicate your thinking by adding the indicator to your calculus? Some pundits recommend a combination of time frames, indicators, wave counting, and Fibonacci retracements and extensions. But when it comes time to place the trade, they will do it only if there is a good price action setup. Also, when they see a good price action setup, they start looking for indicators that show divergences, different time frames for moving average tests, wave counts, or Fibonacci setups to confirm what is in front of them. In reality, they are price action traders who are trading exclusively off price action on only one chart, but don't feel comfortable admitting it. They are complicating their trading to the point that they certainly are missing many trades because their overanalysis takes too much time for them to place their orders, and they are forced to wait for the next setup. The logic just isn't there for making the simple so complicated. Obviously, adding any information can lead to better decision-making, and many people might be able to process lots of inputs when deciding whether to place a trade. Ignoring data because of a simplistic ideology alone is foolish. The goal is to make money, and traders should do everything they can to maximize their profits. I simply cannot process multiple indicators and time frames well in the time needed to place my orders accurately, and I find that carefully reading a single chart is far more profitable for me. Also, if I rely on indicators, I find that I get lazy in my price action reading and often miss the obvious. Price action is far more important than any other information, and if you sacrifice some of what it is telling you to gain information from something else, you are likely making a bad decision. One of the most frustrating things for traders when they are starting out is that everything is so subjective. They want to find a clear set of rules that guarantee a profit, and they hate how a pattern works on one day but fails on another. Markets are very efficient because you have countless very smart people playing a zero-sum game. For a trader to make money, he has to be consistently better than about half of the other traders out there. Since most of the competitors are profitable institutions, a trader has to be very good. Whenever an edge exists, it is quickly discovered and it disappears. Remember, someone has to be taking the opposite side of your trade. It won't take them long to figure out your magical system, and once they do, they will stop giving you money. Part of the appeal of trading is that it is a zero-sum game with very small edges, and it is intellectually satisfying and financially rewarding to be able to spot and capitalize on these small, fleeting opportunities. It can be done, but it is very hard work, and it requires relentless discipline. Discipline simply means doing what you do not want to do. We are all intellectually curious, and we have a natural tendency to try new or different things, but the very best traders resist the temptation. You have to stick to your rules and avoid emotion, and you have to patiently wait to take only the best trades. This all appears easy to do when you look at a printed chart at the end of the day, but it is very difficult in real time as you wait bar by bar, and sometimes hour by hour. Once a great setup appears, if you are distracted or lulled into complacency, you will miss it, and you will then be forced to wait even longer. But if you can develop the patience and the discipline to follow a sound system, the profit potential is huge. There are countless ways to make money trading stocks and E-mini-S, but all require movement well, except for shorting options. If you learn to read the charts, you will catch a great number of these profitable trades every day without ever knowing why some institution started the trend and without ever knowing what any indicator is showing. You don't need these institutions' software or analysts because they will show you what they are doing. All you have to do is piggyback onto their trades and you will make a profit. Price action will tell you what they are doing and allow you an early entry with a tight stop. I have found that I consistently make far more money by minimizing what I have to consider when placing a trade. All I need is a single chart on my laptop computer with no indicators, except a 20-bar exponential moving average, EMA, which does not require too much analysis and clarifies many good setups each day. Some traders might also look at volume because an unusually large volume spike sometimes comes near the end of a bear trend, and the next new swing low or two often provide profitable long scalps. Volume spikes also sometimes occur on daily charts when a sell-off is overdone. However, it is not reliable enough to warrant my attention. Many traders consider price action only when trading divergences and trend pullbacks. In fact, most traders using indicators won't take a trade unless there is a strong signal bar, and many would enter on a strong signal bar if the context was right, even if there was no divergence. They like to see a strong close on a large reversal bar, but in reality, this is a fairly rare occurrence. The most useful tools for understanding price action are trend lines and trend channel lines, prior highs and lows, breakouts and failed breakouts, the sizes of bodies and tails on candles, and relationships between the current bar to the prior several bars. In particular, how the open, high, low, and close of the current bar compare to the action of the prior several bars tells a lot about what will happen next. Charts provide far more information about who is in control of the market than most traders realize. Almost every bar offers important clues as to where the market is going, and a trader who dismisses any activity as noise is passing up many profitable trades each day. Most of the observations in these books are directly related to placing trades, but a few have to do with simple, curious price action tendencies without sufficient dependability to be the basis for a trade. I personally rely mainly on candle charts for my E-mini, futures, and stock trading, but most signals are also visible on any type of chart, and many are even evident on simple line charts. I focus primarily on 5-minute candle charts to illustrate basic principles, but also discuss daily and weekly charts as well. Since I also trade stocks, forks, treasury note futures, and options, I discuss how price action can be used as the basis for this type of trading. As a trader, I see everything in shades of gray and am constantly thinking in terms of probabilities. If a pattern is setting up and is not perfect but is reasonably similar to a reliable setup, it will likely behave similarly as well. Close is usually close enough. If something resembles a textbook setup, the trade will likely unfold in a way that is similar to the trade from the textbook setup. This is the art of trading, and it takes years to become good at trading in the gray zone. Everyone wants concrete, clear rules or indicators, and chat rooms, newsletters, hotlines, or tutors that will tell them when exactly to get in to minimize risk and maximize profit. But none of it works in the long run. You have to take responsibility for your decisions, but you first have to learn how to make them, and that means that you have to get used to operating in the gray fog. Nothing is ever as clear as black and white, and I have been doing this long enough to appreciate that anything, no matter how unlikely, can and will happen. It's like quantum physics. Every conceivable event has a probability, and so do events that you have yet to consider. It is not emotional, and the reasons why something happens are irrelevant. Watching to see if the Federal Reserve cuts rates today is a waste of time because there is both a bullish and bearish interpretation of anything that the Fed does. What is key is to see what the market does, not what the Fed does. If you think about it, trading is a zero-sum game, and it is impossible to have a zero-sum game where rules consistently work. If they worked, everyone would use them, and then there would be no one on the other side of the trade. Therefore, the trade could not exist. Guidelines are very helpful, but reliable rules cannot exist, and this is usually very troubling to a trader starting out who wants to believe that trading is a game that can be very profitable if only you can come up with just the right set of rules. All rules work some of the time, and usually just often enough to fool you into believing that you just need to tweak them a little to get them to work all of the time. You are trying to create a trading god who will protect you, but you are fooling yourself and looking for an easy solution to a game where only hard solutions work. You are competing against the smartest people in the world, and if you are smart enough to come up with a foolproof rule set, so are they, and then everyone is faced with the zero-sum game dilemma. You cannot make money trading unless you are flexible, because you need to go where the market is going, and the market is extremely flexible. It can bend in every direction, and for much longer than most would ever imagine. It can also reverse repeatedly every few bars for a long, long time. Finally, it can and will do everything in between. Never get upset by this, and just accept it as reality and admire it as part of the beauty of the game. The market gravitates toward uncertainty. During most of the day, every market has a directional probability of 50-50 of an equidistant move up or down. By that I mean that if you don't even look at a chart and you buy any stock, and then place a one cancels the other, OCO, order to exit on a profit-taking limit, order X cents above your entry, or on a protective stop at X cents below your entry, you have about a 50% chance of being right. Likewise, if you sell any stock at any point in the day without looking at a chart, and then place a profit-taking limit, order X cents lower, and a protective stop X cents higher, you have about a 50% chance of winning and about a 50% chance of losing. There is the obvious exception of X being too large relative to the price of the stock. You can't have X be $60 in a $50 stock because you would have a 0% chance of losing $60. You also can't have X be $49 because the odds of losing $49 would also be minuscule. But if you pick a value for X that is within reasonable reach on your time frame, this is generally true. When the market is 50-50, it is uncertain and you cannot rationally have an opinion about its direction. This is the hallmark of a trading range, so whenever you are uncertain, assume that the market is in a trading range. There are brief times on a chart when the directional probability is higher. During a strong trend, it might be 60 or even 70%, but that cannot last long because it will gravitate toward uncertainty and a 50-50 market where both the bulls and bears feel there is value. When there is a trend and some level of directional certainty, the market will also gravitate toward areas of support and resistance, which are usually some type of measured move away. And those areas are invariably where uncertainty returns and a trading range develops, at least briefly. Never watch the news during the trading day. If you want to know what a news event means, the chart in front of you will tell you. Reporters believe that the news is the most important thing in the world, and that everything that happens has to be caused by their biggest news story of the day. Since reporters are in the news business, news must be the center of the universe and the cause of everything that happens in the financial markets. When the stock market sold off in mid-March 2011, they attributed it to the earthquake in Japan. It did not matter to them that the market began to sell off 3 weeks earlier after a buy climax. I told the members of my chat room in late February that the odds were good that the market was going to have a significant correction when I saw 15 consecutive bull trend bars on the daily chart after a protracted bull run. This was an unusually strong buy climax and an important statement by the market. I had no idea that an earthquake was going to happen in a few weeks and did not need to know that anyway. The chart was telling me what traders were doing. They were getting ready to exit their longs and initiate shorts. Television experts are also useless. Invariably, when the market makes a huge move, the reporter will find some confident, convincing expert who predicted it and interview him or her, leading the viewers to believe that this pundit has an uncanny ability to predict the market, despite the untold reality that this same pundit has been wrong in his last 10 predictions. The pundit then makes some future prediction, and naive viewers will attach significance to it and let it affect their trading. What the viewers may not realize is that some pundits are bullish 100% of the time and others are bearish 100% of the time, and still others just swing for the fences all the time and make outrageous predictions. The reporter just rushes to the one who is consistent with the day's news, which is totally useless to traders. And in fact, it is destructive because it can influence their trading and make them question and deviate from their own methods. No one is ever consistently right more than 60% of the time on these major predictions, and just because pundits are convincing does not make them reliable. There are equally smart and convincing people who believe the opposite but are not being heard. This is the same as watching a trial and listening to only the defense side of the argument. Hearing only one side is always convincing and always misleading, and rarely better than 50% reliable. Institutional bulls and bears are placing trades all the time, and that is why there is constant uncertainty about the direction of the market. Even in the absence of breaking news, the business channels air interviews all day long, and each reporter gets to pick one pundit for her report. What you have to realize is that she has a 50-50 chance of picking the right one in terms of the market's direction over the next hour or so. If you decide to rely on the pundit to make a trading decision, and he says that the market will sell off after midday, and instead it just keeps going up, are you going to look to short? Should you believe this very convincing head trader at one of Wall Street's top firms? He obviously is making over $1 million a year, and they would not pay him that much unless he was able to correctly and consistently predict the market's direction. In fact, he probably can, and he is probably a good stock picker, but he almost certainly is not a day trader. It is foolish to believe that just because he can make 15% annually managing money, he can correctly predict the market's direction over the next hour or two. Do the math. If he had that ability, he would be making 1% 2 or 3 times a day and maybe 1,000% a year. Since he is not, you know that he does not have that ability. His time frame is months and yours is minutes. Since he is unable to make money by day trading, why would you ever want to make a trade based on someone who is a proven failure as a day trader? He has shown you that he cannot make money by day trading by the simple fact that he is not a successful day trader. That immediately tells you that if he day trades, he loses money, because if he was successful at it, that is what he would choose to do, and he would make far more than he is currently making. Even if you are holding trades for months at a time in an attempt to duplicate the results of his fund, it is still foolish to take his advice, because he might change his mind next week, and you would never know it. Managing a trade once you are in is just as important as placing the trade. If you are following the pundit and hope to make 15% a year like he does, you need to follow his management, but you have no ability to do so, and you will lose over time employing this strategy. Yes, you will make an occasional great trade, but you can simply do that by randomly buying any stock. The key is whether the approach makes money over 100 trades, not over the first 1 or 2. Follow the advice that you give your kids. Don't fool yourself into believing that what you see on television is real, no matter how polished and convincing it appears to be. As I said, there will be pundits who will see the news as bullish and others who will see it as bearish, and the reporter gets to pick one for her report. Are you going to let a reporter make trading decisions for you? That's insane. If that reporter could trade, she would be a trader and make hundreds of times more money than she is making as a reporter. Why would you ever allow her to influence your decision-making? You might do so only out of a lack of confidence in your ability, or perhaps you are searching for a father figure who will love and protect you. If you are prone to be influenced by a reporter's decision, you should not take the trade. The pundit she chooses is not your father, and he will not protect you or your money. Even if the reporter picks a pundit who is correct on the direction, that pundit will not stay with you to manage your trade, and you will likely be stopped out with a loss on a pullback. Financial news stations do not exist to provide public service. They are in business to make money, and that means they need as large an audience as possible to maximize their advertising income. Yes, they want to be accurate in their reporting, but their primary objective is to make money. They are fully aware that they can maximize their audience size only if they are pleasing to watch. That means that they have to have interesting guests, including some who will make outrageous predictions, others who are professorial and reassuring, and some who are just physically attractive. Most of them have to have some entertainment value. Although some guests are great traders, they cannot help you. For example, if they interview one of the world's most successful bond traders, he will usually only speak in general terms about the trend over the next several months, and he will do so only weeks after he has already placed his trades. If you are a day trader, this does not help you, because every bull or bear market on the monthly chart has just about as many up moves on the intraday chart as down moves, and there will be long and short trades every day. His time frame is very different from yours, and his trading has nothing to do with what you are doing. They will also often interview a chartist from a major Wall Street firm who, while his credentials are good, will be basing his opinion on a weekly chart. But the viewers are looking to take profits within a few days. To the chartist, that bull trend that he is recommending buying will still be intact, even if the market falls 10% over the next couple of months. The viewers, however, will take their losses long before that, and will never benefit from the new high that comes 3 months later. Unless the chartist is addressing your specific goals and time frame, whatever he says is useless. When television interviews a day trader instead, he will talk about the trades that he already took, and the information is too late to help you make money. By the time he is on television, the market might already be going in the opposite direction. If he is talking while still in his day trade, he will continue to manage his trade long after his 2-minute interview is over, and he will not manage it while on the air. Even if you enter the trade that he is in, he will not be there when you invariably will have to make an important decision about getting out as the market turns against you, or as the market goes in your direction and you are thinking about taking profits. Watching television for trading advice under any circumstances, even after a very important report, is a sure way to lose money, and you should never do it. Only look at the chart, and it will tell you what you need to know. The chart is what will give you money or take money from you, so it is the only thing that you should ever consider when trading. If you are on the floor, you can't even trust what your best friend is doing. He might be offering a lot of orange juice calls, but secretly having a broker looking to buy 10 times as many below the market. Your friend is just trying to create a panic to drive the market down so he can load up through a surrogate at a much better price. Friends and colleagues freely offer opinions for you to ignore. Occasionally, traders will tell me that they have a great setup and want to discuss it with me. I invariably get them angry with me when I tell them that I am not interested. They immediately perceive me as selfish, stubborn, and close-minded, and when it comes to trading, I am all of that and probably much more. The skills that make you money are generally seen as flaws to the layperson. Why do I no longer read books or articles about trading or talk to other traders about their ideas? As I said, the chart tells me all that I need to know, and any other information is a distraction. Several people have been offended by my attitude, but I think in part it comes from me turning down what they are presenting as something helpful to me when in reality they are making an offering, hoping that I will reciprocate with some tutoring. They become frustrated and angry when I tell them that I don't want to hear about anyone else's trading techniques. I tell them that I haven't even mastered my own and probably never will, but I am confident that I will make far more money perfecting what I already know than trying to incorporate non-price action approaches into my trading. I asked them if James Galway offered a beautiful flute to Yo-Yo Ma and insisted that Ma start learning to play the flute because Galway makes so much money by playing his flute. Should Ma accept the offer? Clearly not. Ma should continue to play the cello, and by doing so he will make far more money than if he also started playing the flute. I am no Galway or Ma, but the concept is the same. Price action is the only instrument that I want to play, and I strongly believe that I will make far more money by mastering it than by incorporating ideas from other successful traders. The charts, not the experts on television, will tell you exactly how the institutions are interpreting the news. Yesterday, Costco's earnings were up 32% on the quarter and above analysts' expectations. See figure 1.2. Cost gapped up on the open, tested the gap on the first bar, and then ran up over $1 in 20 minutes. It then drifted down to test yesterday's close. It had 2 rallies that broke bear trend lines and both failed. This created a double top bars 2 and 3, bear flag or triple top bars 1, 2, and 3, and the market then plunged $3 below the prior day's low. If you were unaware of the report, you would have shorted at the failed bear trend line breaks at bars 2 and 3, and you would have sold more below bar 4, which was a pullback that followed the breakout below yesterday's low. You would have reversed to long on the bar 5 big reversal bar, which was the second attempt to reverse the breakout below yesterday's low, and a climactic reversal of the breakout of the bottom of the steep bear trend channel line. Alternatively, you could have bought the open because of the bullish report, and then worried about why the stock was collapsing instead of soaring the way the TV analysts predicted. And you likely would have sold out your long on the second plunge down to bar 5 with a $2 loss. Any trend that covers a lot of points in very few bars, meaning that there is some combination of large bars and bars that overlap each other only minimally, will eventually have a pullback. These trends have such strong momentum that the odds favor resumption of the trend after the pullback, and then a test of the trend's extreme. Usually the extreme will be exceeded, as long as the pullback does not turn into a new trend in the opposite direction and extend beyond the start of the original trend. In general, the odds that a pullback will get back to the prior trend's extreme fall substantially if the pullback retraces 75% or more. For a pullback in a bear trend at that point, A trader is better off thinking of the pullback as a new bull trend rather than a pullback in an old bear trend. Bar 6 was about a 70% pullback, and then the market tested the climactic bear low on the open of the next day. Just because the market gaps up on a news item does not mean that it will continue up despite how bullish the news is, as shown in Figure 1.3 before the open of Bar 1 on both Yahoo. Yahoo charts daily on the left, weekly on the right. The news reported that Microsoft was looking to take over Yahoo at $31 a share, and the market gapped up almost to that price. Many traders assumed that it had to be a done deal because Microsoft is one of the best companies in the world, and if it wanted to buy Yahoo, it certainly could make it happen. Not only that Microsoft has so much cash that it would likely be willing to sweeten the deal if needed. Well, the CEO of Yahoo said that his company was worth more like $40 a share, but Microsoft never countered. The deal slowly evaporated along with Yahoo's price. In October, Yahoo was 20% below the price where it was before the deal was announced and 50% lower than on the day of the announcement, and it continues to fall. So much for strong fundamentals and a takeover offer from a serious suitor. To a price action trader, a huge up move in a bear market is probably just a bear flag, unless the move is followed by a series of higher lows and higher highs. It could be followed by a bull flag and then more of a rally, but until the bull trend is confirmed, you must be aware that the larger weekly trend is more important. The only thing that is as it seems is the chart. If you cannot figure out what it is telling you, do not trade. Wait for clarity, it will always come. But once it is there, you must place the trade and assume the risk and follow your plan. Do not dial down to a 1-minute chart and tighten your stop because you will lose. The problem with the 1-minute chart is that it tempts you by offering lots of entries with smaller bars and therefore smaller risk. However, you will not be able to take them all, and you will instead cherry pick, which will lead to the death of your account because you will invariably pick too many bad cherries. When you enter on a 5-minute chart, your trade is based on your analysis of the 5-minute chart without any idea of what the 1-minute chart looks like. You must therefore rely on your 5-minute stops and targets, and just accept the reality that the 1-minute chart will move against you and hit a 1-minute stop frequently. If you watch the 1-minute chart, you will not be devoting your full attention to the 5-minute chart, and a good trader will take your money from your account and put it into his account. If you want to compete, you must minimize all distractions and all inputs other than what is on the chart in front of you, and trust that if you do, you will make a lot of money. It will seem unreal, but it is very real. Never question it. Just keep things simple and follow your simple rules. It is extremely difficult to consistently do something simple, but in my opinion, it is the best way to trade. Ultimately, as a trader understands price action better and better, trading becomes much less stressful and actually pretty boring, but much more profitable. Although I never gamble, because the combination of odds, risk, and reward are against me, and I never want to bet against math. There are some similarities with gambling, especially in the minds of those who don't trade. Gambling is a game of chance, but I prefer to restrict the definition to situations where the odds are slightly against you and you will lose over time. Why this restriction? Because without it, every investment is a gamble since there is always an element of luck and a risk of total loss. Even if you buy investment real estate, buy a home, start a business, buy a blue chip stock, or even buy treasury bonds, the government might choose to devalue the dollar to reduce the real size of our debt. And in so doing, the purchasing power of the dollars that you will get back from those bonds would be much less than when you originally bought the bonds. Some traders use simple game theory and increase the size of a trade after one or more losing trades. This is called a martingale approach to trading. Blackjack card counters are very similar to trading range traders. The card counters are trying to determine when the math has gone too far in one direction. In particular, they want to know when the remaining cards in the deck are likely overweighed with face cards. When the count indicates that this is likely, they place a trade bet based on the probability that a disproportionate number of face cards will be coming up, increasing the odds of winning. Trading range traders are looking for times when they think the market has gone too far in one direction, and then they place a trade in the opposite direction, a fade. I tried playing poker online a few times without using real money to find similarities to and differences from trading. I discovered early on that there was a deal breaker for me. I was constantly anxious because of the inherent unfairness due to luck, and I never want luck to be a large component of the odds for my success. This is a huge difference and makes me see gambling and trading as fundamentally different, despite public perception. In trading, everyone is dealt the same cards, so the game is always fair, and over time, you get rewarded or penalized entirely due to your skill as a trader. Obviously, sometimes you can trade correctly and lose, and this can happen several times in a row due to the probability curve of all possible outcomes. There is a real but microscopic chance that you can trade well and lose 10 or even 100 times or more in a row. But I cannot remember the last time I saw as many as 4 good signals fail in a row, so this is a chance that I am willing to take. If you trade well, over time you should make money because it is a zero-sum game except for commissions, which should be small if you choose an appropriate broker. If you are better than most of the other traders, you will win their money. There are 2 types of gambling that are different from pure games of chance, and both are similar to trading. In both sports betting and poker, gamblers are trying to take money from other gamblers rather than from the house, and therefore they can create odds in their favor if they are significantly better than their competitors. However, the commissions that they pay can be far greater than those that a trader pays, especially with sports betting, where the VIG is usually 10%. And that is why incredibly successful sports gamblers like Billy Walters are so rare. They have to be at least 10% better than the competition just to break even. Successful poker players are more common, as can be seen on all of the poker shows on TV. However, even the best poker players do not make anything comparable to what the best traders make, because the practical limits to their trading size are much smaller. I personally find trading not to be stressful, because the luck factor is so tiny that it is not worth considering. However, there is one thing that trading and playing poker share, and that is the value of patience. In poker, you stand to make far more money if you patiently wait to bet on only the very best hands, and traders make more when they have the patience to wait for the very best setups. For me, this protracted downtime is much easier in trading because I can see all of the other cards during the slow times, and it is intellectually stimulating to look for subtle price action phenomena. There is an important adage in gambling that is true in all endeavors, and that is that you should not bet until you have a good hand. In trading, that is true as well. Wait for a good setup before placing a trade. If you trade without discipline and without a sound method, then you are relying on luck and hope for your profits, and your trading is unquestionably a form of gambling. One unfortunate comparison is from non-traders who assume that all-day traders, and all market traders for that matter, are addicted gamblers and therefore have a mental illness. I suspect that many are addicted, in the sense that they are doing it more for excitement than for profit. They are willing to make low-probability bets and lose large sums of money because of the huge rush they feel when they occasionally win. However, most successful traders are essentially investors, just like an investor who buys commercial real estate or a small business. The only real differences from any other type of investing are that the time frame is shorter and the leverage is greater. Unfortunately, it is common for beginners to occasionally gamble, and it invariably costs them money. Every successful trader trades on the basis of rules. Whenever traders deviate from those rules for any reason, they are trading on hope rather than logic, and are then gambling. Beginning, traders often find themselves gambling right after having a couple of losses. They are eager to be made whole again and are willing to take some chances to make that happen. They will take trades that they normally would not take because they are eager to get back the money they just lost. Since they are now taking a trade that they believe is a low-probability trade, and they are taking it because of anxiety and sadness over their losses, they are now gambling and not trading. After they lose on their gamble, they feel even worse. Not only are they even further down on the day, but they feel especially sad because they are faced with the reality that they did not have the discipline to stick to their system when they know that discipline is one of the critical ingredients to success. Interestingly, neurofinance researchers have found that brain scan images of traders about to make a trade are indistinguishable from those of drug addicts about to take a hit. They found a snowball effect and an increased desire to continue, regardless of the outcome of their behavior. Unfortunately, when faced with losses, traders assume more risk rather than less, often leading to the death of their accounts. Without knowing the neuroscience, Warren Buffett clearly understood the problem, as seen in his statement. Once you have ordinary intelligence, what you need is the temperament to control the urges that get other people into trouble in investing. The great traders control their emotions and constantly follow their rules. One final point about gambling: there is a natural tendency to assume that nothing can last forever and that every behavior regresses toward a mean. If the market has 3 or 4 losing trades, surely the odds favor the next one being a winner. It's just like flipping a coin, isn't it? Unfortunately, that is not how markets behave. When a market is trending, most attempts to reverse fail. When it is in a trading range, most attempts to break out fail. This is the opposite of coin flips, where the odds are always 50-50. In trading, the odds are more like 70% or better that what just happened will continue to happen again and again. Because of the coin flip logic, most traders at some point begin to consider game theory. Martingale techniques work well in theory, but not in practice, because of the conflict between math and emotion. That is the Martingale Paradox. If you double or even triple your position size and reverse at each loss, you will theoretically make money. Although 4 losers in a row is uncommon on the 5-minute E-mini chart, if you choose your trades carefully, they will happen, and so will a dozen or more, even though I can't remember ever seeing that. In any case, if you are comfortable trading 10 contracts, but start with just 1 and plan to double up and reverse with each loss, 4 consecutive losers would require 16 contracts on your next trade, and 8 consecutive losers would require 256 contracts. It is unlikely that you would place a trade that is larger than your comfort zone following 4 or more losers. Anyone willing to trade 1 contract initially would never be willing to trade 16 or 256 contracts, and anyone willing to trade 256 contracts would never be willing to initiate this strategy with just 1. This is the inherent, insurmountable mathematical problem with this approach. Since trading is fun and competitive, it is natural for people to compare it to games, and because wagering is involved, gambling is usually the first thing that comes to mind. However, a far more apt analogy is to chess. In chess, you can see exactly what your opponent is doing, unlike in card games where you don't know your opponent's cards. Also, in poker, the cards that you are dealt are yours purely by chance. But in chess, the location of your pieces is entirely due to your decisions. In chess, nothing is hidden, and it is simply your skill compared to that of your opponent that determines the outcome. Your ability to read what is in front of you and determine what will likely follow is a great asset, both to a chess player and to a trader. Laypeople are also concerned about the possibility of crashes, and because of that risk, they again associate trading with gambling. Crashes are very rare events on daily charts. These non-traders are afraid of their inability to function effectively during extremely emotional events. Although the term crash is generally reserved for daily charts and applied to bear markets of about 20% or more happening in a short time frame, like in 1927 and 1987, it is more useful to think of it as just another chart pattern, because that removes the emotion and helps traders follow their rules. If you remove the time and price axes from a chart and focus simply on the price action, there are market movements that occur frequently on intraday charts that are indistinguishable from the patterns in a classic crash. If you can get past the emotion, you can make money off crashes, because with all charts, they display tradable price action. Figure 1.4 from TradeStation shows how markets can crash in any time frame. The one on the left is a daily chart of GE during the 1987 crash. The middle is a 5-minute chart of cost after a very strong earnings report, and the one on the right is a 1-minute E-mini chart. Although the term crash is used almost exclusively to refer to a 20% or more sell-off over a short time on a daily chart, and was widely used only twice in the past 100 years, a price action trader looks for shape, and the same crash pattern is common on intraday charts. Since crashes are so common intraday, there is no need to apply the term, because from a trading perspective, they are just a bear swing with tradable price action. Incidentally, the concept that the same patterns appear on all time frames means that the principles of fractal mathematics might be useful in designing trading systems. In other words, every pattern subdivides into standard price action patterns in smaller time frame charts, and trading decisions based on price action analysis therefore work in all time frames. How to read these books. I tried to group the material in the 3 books in a sequence that should be helpful to traders. Book 1, Trading Price Action Trends, Technical Analysis of Price Charts Bar by Bar for the Serious Trader. The Basics of Price Action and Candles. The market is either trending or in a trading range. That is true of every time frame down to even an individual bar, which can be a trend bar or a non-trend bar, doji. Trend lines and trend channel lines. These are basic tools that can be used to highlight the existence of trends and trading ranges. Trends. These are the most conspicuous and profitable components of every chart. Book 2, Trading Price Action Trading Ranges, Technical Analysis of Price Charts Bar by Bar for the Serious Trader. Breakouts. These are transitions from trading ranges into trends. Gaps. Breakouts often create several types of intraday gaps that can be helpful to traders, but these gaps are evident only if you use a broad definition. Magnets, support, and resistance. Once the market breaks out and begins its move, it is often drawn to certain prices, and these magnets often set up reversals. Pullbacks. These are transitions from trends to temporary trading ranges. Trading ranges. These are areas of largely sideways price activity, but each leg is a small trend, and an entire trading range is usually a pullback in a trend on a higher time frame chart. Order and trade management. Traders need as many tools as possible and need to understand scalping, swing trading, and scaling into and out of trades, as well as how to enter and exit on stops and limit orders. The mathematics of trading. There is a mathematical basis for all trading, and when you see why things are unfolding the way they do, trading becomes much less stressful. Book 3, Trading Price Action Reversals, Technical Analysis of Price Charts Bar by Bar for the Serious Trader. Trend reversals. These offer the best risk-reward ratios of any type of trade, but since most fail, traders need to be selective. Day trading. Now that readers understand price action, they can use it to trade. The chapters on day trading, trading the first hour, and detailed examples show how. Daily, weekly, and monthly charts. These charts have very reliable price action setups. Options. Price action can be used effectively in option trading. Best trades. Some price action setups are especially good, and beginners should focus on these. Guidelines. There are many important concepts that can help keep traders focused. If you come across an unfamiliar term, you should be able to find its definition in the list of terms at the beginning of the book. Some books show charts that use the time zone of the location of the market, but now that trading is electronic and global, that is no longer relevant. Since I trade in California, the charts are in Pacific Standard Time, PST. All of the charts were created with TradeStation. Since every chart has dozens of noteworthy price action events that have not yet been covered, I describe many of them immediately after the primary discussion under deeper discussion of this chart. Even though you might find this incomprehensible when you first read it, you will understand it on a second reading of the books. The more variations of standard patterns that you see, the better you will be able to spot them as they are developing in real time. I also usually point out the major 1 or 2 trades on the chart. If you prefer, you can ignore that supplemental discussion on your first read and then look at the charts again after completing the books when the deeper discussion would be understandable. Since many of the setups are excellent examples of important concepts, even though not yet covered, many readers will appreciate having the discussion if they go through the books again. At the time of publication, I am posting a daily end-of-day analysis of the E-mini and providing real-time chart reading during the trading day at www.brookspriceaction.com. All of the charts in the 3 books will be in a larger format on John Wiley and Son's site at www.wiley.com/go/trading ranges. See the About the Website page at the back of the book. You will be able to zoom in to see the details, download the charts, or print them. Having a printout of a chart when the description is several pages long will make it easier to follow the commentary. Signs of strength, trends, breakouts, reversal bars, and reversals. Here are some characteristics that are commonly found in strong trends. There is a big gap opening on the day. There are trending highs and lows, swings. Most of the bars are trend bars in the direction of the trend. There is very little overlap of the bodies of consecutive bars. For example, in a bull spike, many bars have lows that are at or just 1 tick below the closes of the prior bar. Some bars have lows that are at and not below the close of the prior bar, so traders trying to buy on a limit order at the close of the prior bar do not get their orders filled and they have to buy higher. There are bars with no tails or small tails in either direction, indicating urgency. For example, in a bull trend, if a bull trend bar opens on its low tick and trends up, traders were eager to buy it as soon as the prior bar closed. If it closes on or near its high tick, traders continued their strong buying in anticipation of new buyers entering right after the bar closes. They were willing to by going into the close because they were afraid that if they waited for the bar to close, they might have to buy a tick or two higher. Occasionally, there are gaps between the bodies. For example, the open of a bar might be above the close of the prior bar in a bull trend. A breakout gap appears in the form of a strong trend bar at the start of the trend. Measuring gaps occur where the breakout test does not overlap the breakout point. For example, the pullback from a bull breakout does not drop below the high of the bar where the breakout occurred. Micro-measuring gaps appear where there is a strong trend bar and a gap between the bar before it and the bar after it. For example, if the low of the bar after a strong bull trend bar in a bull trend is at or above the high of the bar before the trend bar, this is a gap and a breakout test and a sign of strength. No big climaxes appear. Not many large bars appear, not even large trend bars. Often, the largest trend bars are countertrend, trapping traders into looking for countertrend trades and missing with trend trades. The countertrend setups almost always look better than the with trend setups. No significant trend channel line overshoots occur, and the minor ones result in only sideways corrections. There are sideways corrections after trend line breaks. Failed wedges and other failed reversals occur. There is a sequence of 20 moving average gap bars, 20 or more consecutive bars that do not touch the moving average, discussed in Book 2. Few, if any, profitable countertrend trades are found. There are small, infrequent, and mostly sideways pullbacks. For example, if the E-mini-S average range is 12 points, the pullbacks will all likely be less than 3 or 4 points, and the market will often go for 5 or more bars without a pullback. There is a sense of urgency. You find yourself waiting through countless bars for a good with trend pullback, and one never comes, yet the market slowly continues to trend. The pullbacks have strong setups. For example, the high 1 and high 2 pullbacks in a bull trend have strong bull reversal bars for signal bars. In the strongest trends, the pullbacks usually have weak signal bars, making many traders not take them and forcing traders to chase the market. For example, in a bear trend, the signal bars for a low 2 short are often small bull bars in 2 or 3 bar bull spikes, and some of the entry bars are outside down bars. It has trending anything, closes, highs, lows, or bodies. Repeated 2-legged pullbacks are setting up with trend entries. No 2 consecutive trend bar closes occur on the opposite side of the moving average. The trend goes very far and breaks several resistance levels, like the moving average, prior swing highs, and trend lines, and each by many ticks. Reversal attempts in the form of spikes against the trend have no follow-through, fail, and become flags in the direction of the trend. The more of the following characteristics that a bull breakout has, the more likely the breakout will be strong. The breakout bar has a large bull trend body and small tails or no tails. The larger the bar, the more likely the breakout will succeed. If the volume of the large breakout bar is 10 to 20 times the average volume of recent bars, the chance of follow-through buying and a possible measured move increases. The spike goes very far, lasts several bars, and breaks several resistance levels, like the moving average, prior swing highs and trend lines, and each by many ticks. As the first bar of the breakout bar is forming, it spends most of its time near its high, and the pullbacks are small, less than a quarter of the height of the growing bar. There is a sense of urgency. You feel like you have to buy, but you want a pullback, yet it never comes. The next 2 or 3 bars also have bull bodies that are at least the average size of the recent bull and bear bodies. Even if the bodies are relatively small and the tails are prominent, if the follow-through bar, the bar after the initial breakout bar, is large, the odds of the trend continuing are greater. The spike grows to 5 to 10 bars without pulling back for more than a bar or so. 1 or more bars in the spike have a low that is at or just 1 tick below the close of the prior bar. 1 or more bars in the spike have an open that is above the close of the prior bar. 1 or more bars in the spike have a close on the bar's high or just 1 tick below its high. The low of the bar after a bull trend bar is at or above the high of the bar before the bull trend bar, creating a micro gap, which is a sign of strength. These gaps sometimes become measuring gaps. Although it is not significant to trading, according to Elliot wave theory, they probably represent the space between a smaller time frame Elliot wave 1 high and a wave 4 pullback, which can touch but not overlap. The overall context makes a breakout likely, like the resumption of a trend after a pullback, or a higher low or lower low test of the bear low after a strong break above the bear trend line. The market has had several strong bull trend days recently. There is growing buying pressure in the trading range, represented by many large bull trend bars, and the bull trend bars are clearly more prominent than the bear trend bars in the range. The first pullback occurs only after 3 or more bars of breaking out. The first pullback lasts only 1 or 2 bars, and it follows a bar that is not a strong bear reversal bar. The first pullback does not reach the breakout point and does not hit a break-even stop, the entry price. The breakout reverses many recent closes and highs. For example, when there is a bear channel and a large bull bar forms, this breakout bar has a high and close that are above the highs and closes of 5 or even 20 or more bars. A large number of bars reversed by the close of the bull bar is a stronger sign than a similar number of bars reversed by the high. The more of the following characteristics that a bear breakout has, the more likely the breakout will be strong. The breakout bar has a large bear trend body and small tails or no tails. The larger the bar, the more likely the breakout will succeed. If the volume of the large breakout bar is 10 to 20 times the average volume of recent bars, the chance of follow-through selling and a possible measured move down increases. The spike goes very far, lasts several bars, and breaks several support levels like the moving average, prior swing lows and trend lines, and each by many ticks. As the first bar of the breakout bar is forming, it spends most of its time near its low, and the pullbacks are small, less than a quarter of the height of the growing bar. There is a sense of urgency. You feel like you have to sell, but you want a pullback, yet it never comes. The next 2 or 3 bars also have bear bodies that are at least the average size of the recent bull and bear bodies. Even if the bodies are relatively small and the tails are prominent, if the follow-through bar, the bar after the initial breakout bar, is large, the odds of the trend continuing are greater. The spike grows to 5 to 10 bars without pulling back for more than a bar or so. As a bear breakout goes below a prior significant swing low, the move below the low goes far enough for a scalper to make a profit if he entered on a stop at 1 tick below that swing low. 1 or more bars in the spike has a high that is at or just 1 tick above the close of the prior bar. 1 or more bars in the spike has an open that is below the close of the prior bar. 1 or more bars in the spike has a close on its low or just 1 tick above its low. The high of the bar after a bear trend bar is at or below the low of the bar before the bear trend bar, creating a micro gap, which is a sign of strength. These gaps sometimes become measuring gaps. Although it is not significant to trading, they probably represent the space between a smaller time frame Elliot wave 1 low and a wave 4 pullback, which can touch but not overlap. The overall context makes a breakout likely, like the resumption of a trend after a pullback, or a lower high or higher high test of the bull high after a strong break below the bull trend line. The market has had several strong bear trend days recently. There was growing selling pressure in the trading range, represented by many large bear trend bars, and the bear trend bars were clearly more prominent than the bull trend bars in the range. The first pullback occurs only after 3 or more bars of breaking out. The first pullback lasts only 1 or 2 bars, and it follows a bar that is not a strong bull reversal bar. The first pullback does not reach the breakout point and does not hit a break-even stop, the entry price. The breakout reverses many recent closes and lows. For example, when there is a bull channel and a large bear bar forms, this breakout bar has a low and close that are below the lows and closes of 5 or even 20 or more bars. A large number of bars reversed by the close of the bear bar is a stronger sign than a similar number of bars reversed by its low. The best-known signal bar is the reversal bar, and the minimum that a bull reversal bar should have is either a close above its open, a bull body, or a close above its midpoint. The best bull reversal bars have more than one of the following: an open near or below the close of the prior bar, and a close above the open and above the prior bar's close. A lower tail that is about 1/3 to 1/2 the height of the bar, and a small or non-existent upper tail. Not much overlap with the prior bar or bars. The bar after the signal bar is not a doji inside bar, and instead is a strong entry bar, a bull trend bar with a relatively large body and small tails. A close that reverses closes above the closes and highs of more than one bar. The minimum that a bear reversal bar should have is either a close below its open, a bear body, or a close below its midpoint. The best bear reversal bars have an open near or above the close of the prior bar and a close well below the prior bar's close. An upper tail that is about 1/3 to 1/2 the height of the bar and a small or non-existent lower tail. Not much overlap with the prior bar or bars. The bar after the signal bar is not a doji inside bar and instead is a strong entry bar, a bear trend bar with a relatively large body and small tails. A close that reverses closes below the closes and extremes of more than one bar. Here are a number of characteristics that are common in strong bull reversals. There is a strong bull reversal bar with a large bull trend body and small tails or no tails. The next 2 or 3 bars also have bull bodies that are at least the average size of the recent bull and bear bodies. The spike grows to 5 to 10 bars without pulling back for more than a bar or so, and it reverses many bars, swing highs, and bear flags of the prior bear trend. 1 or more bars in the spike have a low that is at or just 1 tick below the close of the prior bar. 1 or more bars in the spike have an open that is above the close of the prior bar. 1 or more bars in the spike have a close on the high of the bar or just 1 tick below its high. The overall context makes a reversal likely, like a higher low or lower low test of the bear low after a strong break above the bear trend line. The first pullback occurs only after 3 or more bars. The first pullback lasts only 1 or 2 bars, and it follows a bar that is not a strong bear reversal bar. The first pullback does not hit a break-even stop, the entry price. The spike goes very far and breaks several resistance levels like the moving average, prior swing highs, and trend lines, and each by many ticks. As the first bar of the reversal is forming, it spends most of its time near its high, and the pullbacks are less than a quarter of the height of the growing bar. There is a sense of urgency. You feel like you have to buy, but you want to pull back, yet it never comes. The signal is the second attempt to reverse within the past few bars, a second signal. The reversal began as a reversal from an overshoot of a trend channel line from the old trend. It is reversing a significant swing high or low, e.g., it breaks below a strong prior swing low and reverses up. The high 1 and high 2 pullbacks have strong bull reversal bars for signal bars. It is trending anything, closes, highs, lows, or bodies. The pullbacks are small and sideways. There were prior breaks of earlier bear trend lines. This isn't the first sign of bullish strength. The pullback to test the bear low lacks momentum, as evidenced by its having many overlapping bars with many being bull trend bars. The pullback that tests the bear low fails at the moving average or the old bear trend line. The breakout reverses many recent closes and highs. For example, when there is a bear channel and a large bull bar forms, this breakout bar has a high and close that are above the highs and closes of 5 or even 20 or more bars. A large number of bars reversed by the close of the bull bar is a stronger sign than a similar number of bars reversed by only its high. Here are a number of characteristics that are common in strong bear reversals. A strong bear reversal bar with a large bear trend body and small tails or no tails. The next 2 or 3 bars also have bear bodies that are at least the average size of the recent bull and bear bodies. The spike grows to 5 to 10 bars without pulling back for more than a bar or so, and it reverses many bars, swing lows, and bull flags of the prior bull trend. 1 or more bars in the spike has a high that is at or just 1 tick above the close of the prior bar. 1 or more bars in the spike has an open that is below the close of the prior bar. 1 or more bars in the spike has a close on its low or just 1 tick above its low. The overall context makes a reversal likely, like a lower high or higher high test of the bull high after a strong break below the bull trend line. The first pullback occurs only after 3 or more bars. The first pullback lasts only 1 or 2 bars, and it follows a bar that is not a strong bull reversal bar. The first pullback does not hit a break-even stop, the entry price. The spike goes very far and breaks several support levels like the moving average, prior swing lows, and trend lines, and each by many ticks. As the first bar of the reversal is forming, it spends most of its time near its low, and the pullbacks are less than a quarter of the height of the growing bar. There is a sense of urgency. You feel like you have to sell, but you want a pullback, yet it never comes. The signal is the second attempt to reverse within the past few bars, a second signal. The reversal began as a reversal from an overshoot of a trend channel line from the old trend. It is reversing at a significant swing high or low area, e.g., breaks above a strong prior swing high and reverses down. The low 1 and low 2 pullbacks have strong bear reversal bars for signal bars. It has trending anything, closes, highs, lows, or bodies. The pullbacks are small and sideways. There were prior breaks of earlier bull trend lines. This isn't the first sign of bearish strength. The pullback to test the bull high lacks momentum, as evidenced by it having many overlapping bars with many being bear trend bars. The pullback that tests the bull high fails at the moving average or the old bull trend line. The breakout reverses many recent closes and lows. For example, when there is a bull channel and a large bear bar forms, this breakout bar has a low and close that are below the lows and closes of 5 or even 20 or more bars. A large number of bars reversed by the close of the bear bar is a stronger sign than a similar number of bars reversed by only its low. Bar counting basics: high 1, high 2, low 1, low 2. A reliable sign that a pullback in a bull trend or in a trading range has ended is when the current bar's high extends at least one tick above the high of the prior bar. This leads to a useful concept of counting the number of times that this occurs, which is called bar counting. In a sideways or downward move in a bull trend or a trading range, the first bar whose high is above the high of the prior bar is a high one, and this ends the first leg of the sideways or down move, although this leg may become a small leg in a larger pullback. If the market does not turn into a bull swing and instead continues sideways or down, label the next occurrence of a bar with a high above the high of the prior bar as a high 2, ending the second leg. A high 2 in a bull trend and a low 2 in a bear trend are often referred to as ABC corrections, where the first leg is the A. The change in direction that forms the high 1 or low 1 entry is the B, and the final leg of the pullback is the C. The breakout from the C is a high 2 entry bar in a bull ABC correction and a low 2 entry bar in a bear ABC correction. If the bull pullback ends after a third leg, the buy setup is a high 3 and is usually a type of wedge bull flag. When a bear rally ends in a third leg, it is a low 3 sell setup and usually a wedge bear flag. Some bull pullbacks can grow further and form a high 4. When a high 4 forms, it sometimes begins with a high 2, and this high 2 fails to go very far. It is instead followed by another 2 legs down and a second high 2, and the entire move is simply a high 2 in a higher time frame. At other times, the high 4 is a small spike and channel bear trend where the first or second push down is a bear spike, and the next pushes down are in a bear channel. If the high 4 fails to resume the trend and the market falls below its low, it is likely that the market is no longer forming a pullback in a bull trend and instead is in a bear swing. Wait for more price action to unfold before placing a trade. When a bear trend or a sideways market is correcting sideways or up, the first bar with a low below the low of the prior bar is a low one, ending the first leg of the correction, which can be as brief as that single bar. Subsequent occurrences are called the low 2, low 3, and low 4 entries. If the low 4 fails, a bar extends above the high of the low 4 signal bar after the low 4 short is triggered. The price action indicates that the bears have lost control, and either the market will become two-sided, with bulls and bears alternating control, or the bulls will gain control. In any case, the bears can best demonstrate that they have regained control by breaking a bull trend line with strong momentum. Part 1. Breakouts. Transitioning into a new trend, the market is always trying to break out, and then the market tries to make every breakout fail. This is the most fundamental aspect of all trading and is at the heart of everything that we do. One of the most important skills that a trader can acquire is the ability to reliably determine when a breakout will succeed or fail, creating a reversal. Remember, every trend bar is a breakout, and there are buyers and sellers at the top and bottom of every bull and bear trend bar, no matter how strong the bar appears. Since every trend bar is a breakout and trend bars are common, traders must understand that they have to be assessing every few bars all day long whether a breakout will continue or fail, and then reverse. This is the most fundamental concept in trading, and it is crucial to a trader's financial success to understand it. A breakout of anything is the same. Even a climactic reversal like a V-bottom is simply a breakout, and then a failed breakout. There are traders placing trades based on the belief that the breakout will succeed, and other traders placing trades in the opposite direction, betting it will fail. The better traders become at assessing whether a breakout will succeed or fail, the better positioned they are to make a living as a trader. Will the breakout succeed? If yes, then look to trade in that direction. If no, and become a failed breakout, which is a reversal, then look to trade in the opposite direction. All trading comes down to this decision. Breakout is a misleading term because out implies that it refers only to a market attempting to transition from a trading range into a trend, but it can also be a buy or sell climax attempting to reverse into a trend in the opposite direction. The most important thing to understand about breakouts is that most breakouts fail. There is a strong propensity for the market to continue what it has been doing, and therefore there is a strong resistance to change. Just as most attempts to end a trend fail, most attempts to end a trading range and begin a trend also fail. A breakout is simply a move beyond some prior point of significance, such as a trend line or a prior high or low, including the high or low of the previous bar. That point becomes the breakout point, and if the market later comes back to test that point, the pullback is the breakout test, a breakout pullback that reaches the area of the breakout point. The space between the breakout point and the breakout test is the breakout gap. A significant breakout, one that makes the always in position clearly long or short and is likely to follow through for at least several bars, almost always appears as a relatively large trend bar without significant tails. Always in is discussed in detail in the third book, and it means that if you had to be in the market at all times, either long or short, the always in position is whatever your current position is. The breakout is an attempt by the market either to reverse the trend or to move from a trading range into a new trend. Whenever the market is in a trading range, it should be considered to be in breakout mode. There is two-sided trading until one side gives up and the market becomes heavily one-sided, creating a spike that becomes a breakout. All breakouts are spikes and can be made up of one or several consecutive trend bars. Breakouts of one type or another are very common and occur as often as every few bars on every chart. As is discussed in Chapter 6 on gaps, all breakouts are functionally equivalent to gaps, and since every trend bar is a breakout and also a spike and a climax, it is also a gap. Many breakouts are easily overlooked, and any single one may be breaking out of many things at one time. Sometimes the market will have setups in both directions and is therefore in breakout mode. This is sometimes referred to as being in an inflection area. Traders will be ready to enter in the direction of the breakout in either direction. Because breakouts are one of the most common features of every chart, it is imperative to understand them, their follow-through, and their failure. The high of the prior bar is usually a swing high on some lower time frame chart, so if the market moves above the high of the prior bar, it is breaking above a lower time frame swing high. Also, when the market breaks above a prior swing high on the current chart, that high is simply the high of the prior bar on some higher time frame chart. The same is true for the low of the prior bar. It is usually a swing low on a lower time frame chart, and any swing low on the current chart is usually just the low of the prior bar on a higher time frame chart. It is important to distinguish a breakout into a new trend from a breakout of a small trading range within a larger trading range. For example, if the chart on your screen is in a trading range and the market breaks above a small trading range in the bottom half of the screen, most traders will assume that the market is still within the larger trading range and not yet in a bull trend. The market might simply be forming a buy vacuum test of the top of the larger trading range. Because of this, smart traders will not buy the closes of the strong bull trend bars near the top of the screen. In fact, many will sell out of their longs to take profits and others will short them, expecting the breakout attempt to fail. Similarly, even though buying a high one setup in strong bull spike can be a great trade, it is great only in a bull trend, not at the top of a trading range, where most breakout attempts will fail. In general, if there is a strong bull breakout, but it is still below the high of the bars on the left half of the screen, make sure that there is a strong trend reversal underway before looking to buy near the top of the spike. If you believe that the market might still be within a trading range, only consider buying pullbacks, instead of looking to buy near the top of the spike. Big traders don't hesitate to enter a trend during its spike phase because they expect significant follow-through even if there is a pullback immediately after their entry. If a pullback occurs, they increase the size of their position. For example, if there is a strong bull breakout lasting several bars, more and more institutions become convinced that the market has become always in long with each new higher tick. And as they become convinced that the market will go higher, they start buying, and they press the trades by buying more as the market continues to rise. This makes the spike grow very quickly. They have many ways to enter, like buying at the market, buying a 1 or 2 tick pullback, buying above the prior bar on a stop, or buying on a breakout above a prior swing high. It does not matter how they get in because their focus is to get at least a small position on and then look to buy more as the market moves higher or if it pulls back. Because they will add on as the market goes higher, the spike can extend for many bars. A beginning trader sees the growing spike and wonders how anyone could be buying at the top of such a huge move. What they don't understand is that the institutions are so confident that the market will soon be higher that they will buy all of the way up, because they don't want to miss the move while waiting for a pullback to form. Beginners are also afraid that their stops would have to be below the bottom of the spike, or at least below its midpoint, which is far away. The institutions know this and simply adjust their position size down to a level where their dollars at risk are the same as for any other trade. At some resistance level, the early buyers take some profits, and then the market pulls back a little. When it does, the traders who want a larger position quickly buy, thereby keeping the initial pullback small. Also, the bulls who missed the earlier entries will use the pullback to finally get long. Some traders don't like to buy spikes because they don't like to risk too much. The stop often needs to be below the bottom of the spike. They prefer to feel like they are buying at a better price, a discount, and therefore will wait for a pullback to form before buying. If everyone is looking to buy a pullback, why would one ever develop? It is because not everyone is looking to buy. Experienced traders who bought early on know that the market can reverse at any time, and once they feel that the market has reached a resistance area where they think that profit-taking might come in or the market might reverse, they will take partial profits, they will begin to scale out of their longs, and sometimes will sell out of their entire position. These are not the bulls who are looking to buy a few ticks lower on the first pullback. The experienced traders who are taking partial profits are scaling out because they are afraid of a reversal or of a deeper pullback where they could buy back many ticks lower. If they believed that the pullback was only going to last for a few ticks and then the bull was going to resume, they would never have exited. They always take their profits at some resistance level, like a measured move target, a trend line, a trend channel line, a new high, or at the bottom of a trading range above. Most of the trading is done by computers, so everything has a mathematical basis, which means that the profit-taking targets are based on the prices on the screen. With practice, traders can learn to spot areas where the computers might take profits, and they can take their profits at the same prices, expecting a pullback to follow. Although trends have inertia and will go above most resistance areas, when a reversal finally does come, it will always be at a resistance area, whether or not it is obvious to you. Sometimes the spike will have a bar or a pattern that will allow aggressive bears to take a small scalp if they think that the pullback is imminent and that there is enough room for a profit. However, most traders who attempt this will lose, because most of the pullbacks do not go far enough for a profit, or the trader's equation is weak. The probability of making a scalp times the size of the profit is smaller than the probability of losing times the size of the protective stop. Also, traders who take the short are hoping so much for their small profit that they invariably end up missing the much more profitable long that forms a few minutes later. Traders enter in the direction of the breakout or in the opposite direction, depending on whether they expect it to succeed or to fail. Are they believers or non-believers? There are many ways to enter in the direction of the breakout. Once traders feel a sense of urgency because they believe that a significant move might be underway, they need to get into the market. Entering during a breakout is difficult for many traders because the risk is larger and the move is fast. They will often freeze and not take the trade. They are worried about the size of the potential loss, which means that they are carrying too much to trade. They have to get their position size down to the I don't care size so that they can quickly get in the trade. The best way for them to take a scary trade is to automatically trade only a third or a quarter of their normal trade size and use the wide stop that is required. They might catch a big move, and making a lot on a small position is much better than making nothing on their usual position size. It is important to avoid making the mistake of not caring to the point that you begin to trade weak setups and then lose money. First, spot a good setup and then enter the I don't care mode. As soon as traders feel that the market has had a clear always-in move, they believe that a trend is underway and they need to get in as soon as possible. For example, if there is a strong bull breakout, they can buy the close of the bar that made them believe that the trend has begun. They might need to see the next bar also have a bull close. If they wait and they get that bull close, they could buy as soon as the bar closes, either with a limit order at the level of the close of the bar or with a market order. They could wait for the first pause or pullback bar and place a limit order to buy at its close, a tick above its low, at its low, or a tick or two below its low. They can place a limit order to buy any small pullback, like a 1 to 4 tick pullback in the E-mini or a 5 to 10 cent pullback in a stock. If the breakout bar is not too large, the low of the next bar might test the high of the bar before the breakout, creating a breakout test. They might place a limit order to buy at or just above the high of that bar and risk to the low of the breakout bar. If they try to buy at or below a pause bar and they do not get filled, they can place a buy-stop order at 1 tick above the high of the bar. If the spike is strong, they can look to buy the first high one setup, which is a breakout pullback. Earlier on, they can look at a 1, 2, or 3-minute chart and buy at or below the low of a prior bar, above a high 1 or high 2 signal bar, or with a limit order at the moving average. Once they are in, they should manage the position like any trend trade and look for a swing to a measured move target to take profits and not exit with a small scalp. The bulls will expect every attempt by the bears to fail and therefore look to buy each one. They will buy around the close of every bear trend bar even if the bar is large and closes on its low. They will buy as the market falls below the low of the prior bar, any prior swing low, and any support level, like a trend line. They also will buy every attempt by the market to go higher, like around the high of a bull trend bar, or as the market moves above the high of the prior bar or above a resistance level. This is the exact opposite of what traders do in strong bear markets, when they sell above and below bars, and above and below both resistance and support. They sell above bars and around every type of resistance, including strong bull trend bars, because they see each move up as an attempt to reverse the trend, and most trend reversal attempts fail. They will sell below bars and around every type of support, because they see each move down as an attempt to resume the bear trend and expect that most will succeed. Since most breakout attempts fail, many traders enter breakouts in the opposite direction. For example, if there is a bull trend and it forms a large bear trend bar closing on its low, most traders will expect this reversal attempt to fail, and many will buy at the close of the bar. If the next bar has a bull body, they will buy at the close of the bar and above its high. The first target is the high of the bear trend bar, and the next target is a measured move up, equal to the height of the bear trend bar. Some traders will use an initial protective stop that is about the same number of ticks as the bear trend bar is tall, and others will use their usual stop, like 2 points in the E-mini. Information comes fast during a breakout, and traders can usually formulate increasingly strong opinions with the close of each subsequent bar. If there is a second strong bear trend bar and then a third, more traders will believe that the always-in position has reversed to down, and the bears will short more. The bulls who bought the bear spike will soon decide that the market will work lower over the next several bars and will therefore exit their longs. It does not make sense for them to hold long when they believe that the market will be lower in the near future. It makes more sense for them to sell out of their longs, take the loss, and then buy again at a lower price once they think that the bull trend will resume. Because the bulls have become sellers, at least for the next several bars, there is no one left to buy, and the market falls to the next level of support. If the market rallied after that first bear bar, the bears would quickly see that they were wrong and would buy back their shorts. With no one left to short, and everyone buying, the bulls initiating new longs and the bears buying back their shorts, the market will probably rally, at least for several more bars. Traders have to assess a breakout in relation to the entire chart and not just the current leg. For example, if the market is breaking out in a strong bull spike, look across the chart to the left side of the screen. If there are no bars at the level of the current price, then buying closes and risking to below the bottom of the spike is often a good strategy. Since the risk is big, trade small, but because a strong breakout has at least a 60% chance of reaching a measured move that is approximately equal to the size of the spike, the trader's equation is good. The probability of success times the potential reward is greater than the probability of failure times the risk. However, when you look to the left side of the screen, if you see that the current breakout is still below the high from 20 or 30 bars earlier, the market might still be in a trading range. Trading ranges regularly have sharp bull spikes that race to the top, only to reverse. The market then races to the bottom, and that breakout attempt also fails. Because of this, buying the closes of strong bull trend bars near the top of the trading range is risky, and it is usually better to look to buy pullbacks instead. Traders should trade the market like a trading range until it is clearly in a trend. A move above a prior high in a bull trend will generally lead to one of three outcomes: more buying, profit-taking, or shorting. When the trend is strong bulls will press add to their longs by buying the breakout above the old high, and there will be a measured move up of some kind. If the market goes up far enough above the breakout to enable a trader to make at least a profitable scalp before there is a pullback, then assume that there was mostly new buying at the high. If it goes sideways and the breakout shows signs of weakness discussed further on, assume that there was profit-taking and that the bulls are looking to buy again a little lower. If the market reverses down hard, assume that the strong bears dominated at the new high and that the market will likely trade down for at least a couple of legs and at least 10 bars. In the absence of some rare, dramatic news event, traders don't suddenly switch from extremely bullish to extremely bearish. There is a gradual transition. A trader becomes less bullish, then neutral, and then bearish. Once enough traders make this transition, the market reverses into a deeper correction or into a bear trend. Every trading firm has its own measure of excess, and at some point, enough firms decide that the trend has gone too far. They believe that there is little risk of missing a great move up if they stop buying above the old high, and they will buy only on pullbacks. If the market hesitates above the old high, the market is becoming two-sided, and the strong bulls are using the new high to take profits. Profit-taking means that traders are still bullish and are looking to buy a pullback. Most new highs are followed by profit-taking. Every new high is a potential top, but most reversal attempts fail and become the beginning of bull flags, only to be followed by another new high. If a rally to test the high has several small pullbacks within the leg up, with lots of overlapping bars, several bear bodies and big tails on the tops of the bars, and most of the bull trend bars are weak, then the market is becoming increasingly two-sided. The bulls are taking profits at the tops of the bars and buying only at the bottoms of the bars, and the bears are beginning to short at the tops of the bars. Similarly, the bulls are taking profits as the market approaches the top of the bull trend, and the bears are shorting more. If the market goes above the bull high, it is likely that the profit-taking and shorting will be even stronger. Most traders do not like to reverse, so if they are anticipating a reversal signal, they prefer to exit their longs and then wait for that signal. The loss of these bulls on the final leg up in the trend contributes to the weakness of the rally to the final high. If there is a strong reversal down after the market breaks above the prior high, the strong bears are taking control of the market, at least for the near term. Once that happens, then the bulls who were hoping to buy a small pullback believe instead that the market will fall further. They therefore wait to buy until there is a much larger pullback, and their absence of buying allows the bears to drive the market down into a deeper correction lasting 10 or more bars and often having 2 or more legs. Whenever there is a new trend, traders reverse their mindset. When a bull trend reverses to a bear trend, they stop buying above bars on stops and buying below bars on limit orders, and begin selling above bars on limit orders and selling below bars on stops. When a bear trend reverses to a bull trend, they stop selling below bars on stops and selling above bars on limit orders, and begin buying above bars on stops and buying below bars on limit orders. There is one situation where the breakout in a bull trend is routinely met by aggressive shorts who will usually take over the market. A pullback is a minor trend in the opposite direction, and traders expect it to end soon and for the larger trend to resume. When there is a pullback in a strong bear trend, the market will often have two legs up in the minor bull trend. As the market goes above the high of the first leg up, it is breaking out above a prior swing high in a minor bull trend. However, since most traders will see the move up as a pullback that will end very soon, the dominant traders on the breakout will usually be aggressive sellers instead of aggressive new buyers, and the minor bull trend will usually reverse back down into the direction of the major bear trend after breaking out above the first or second swing high in the pullback. The same is true of new lows in a bear trend. When the bear trend is strong, strong bears will press their shorts by adding to their positions on the breakout to a new low, and the market will continue to fall until it reaches some measured move target. As the trend weakens, the price action at a new low will be less clear, which means that the strong bears are using the new low as an area to take profits on their shorts rather than as an area to add to their shorts. As the bear trend further loses strength, the strong bulls will eventually see a new low as a great price to initiate longs, and they will be able to create a reversal pattern and then a significant rally. As a trend matures, it usually transitions into a trading range, but the first trading ranges that form are usually followed by a continuation of the trend. How do the strong bulls and bears act as a trend matures? In a bull trend, when the trend is strong, the pullbacks are small because the strong bulls want to buy more on a pullback. Since they suspect that there may not be a pullback until the market is much higher, they begin to buy in pieces, but relentlessly. They look for any reason to buy, and with so many big traders in the market, there will be some buying for every imaginable reason. They place limit orders to buy a few ticks down and other limit orders to buy a few ticks above the low of the prior bar, at the low of the prior bar, and below the low of the prior bar. They place stop orders to buy above the high of the prior bar and on a breakout above any prior swing high. They also buy on the close of both any bull or bear trend bar. They see the bear trend bar as a brief opportunity to buy at a better price and the bull trend bar as a sign that the market is about to move up quickly. The strong bears are smart and see what is going on. Since they believe, just like the strong bulls, that the market is going to be higher before long, it does not make sense for them to be shorting. They just step aside and wait until they can sell higher. How much higher? Each institution has its own measure of excess, but once the market gets to a price level where enough bear firms believe that it might not go any higher, they will begin to short. If enough of them short around the same price level, more and larger bear trend bars form and bars start to get tails on the tops. These are signs of selling pressure, and they tell all traders that the bulls are becoming weaker and the bears are becoming stronger. The strong bulls eventually stop buying above the last swing high and instead begin to take profits as the market goes to a new high. They are still bullish, but are becoming selective and will buy only on pullbacks. As the two-sided trading increases and the sell-offs have more bear trend bars and last for more bars, the strong bulls will want to buy only at the bottom of the developing trading range and will look to take profits at the top. The strong bears begin to short at new highs and are now willing to scale in higher. They might take partial profits near the bottom of the developing trading range if they think that the market might reverse back up and break out to a new high, but they will keep looking to short new highs. At some point, the market becomes a 50-50 market and neither the bulls nor the bears are in control. Eventually, the bears become dominant, a bear trend begins, and the opposite process unfolds. A protracted trend will often have an unusually strong breakout, but it can be an exhaustive climax. For example, in a protracted bull trend, all strong bulls and bears love to see a large bull trend bar or two, especially if it is exceptionally large, because they expect it to be a brief, unusually great opportunity. Once the market is close to where the strong bulls and bears want to sell, like near a measured move target or a trend channel line, especially if the move is the second or third consecutive by climax, they step aside. The absence of selling by the strongest traders results in a vacuum above the market. The programs that detect the momentum early on in a bar see this and quickly buy repeatedly until the momentum slows. Since few strong traders are selling, the result is one or two relatively large bull trend bars. This bull spike is just the sign that the strong traders have been waiting for, and once it is there, they appear as if out of nowhere and begin their selling. The bulls take profits on their longs, and the bears initiate new shorts. Both sell aggressively at the close of the bar, above its high, at the close of the next bar, especially if it is a weaker bar, and at the close of the following bar, especially if the bars are starting to have bear bodies. They also short below the low of the prior bar. When they see a strong bear trend bar, they short at its close and below its low. The momentum programs also take profits. Both the bulls and the bears expect a larger correction, and the bulls will not consider buying again until at least a 10-bar two-legged correction, and even then only if the sell-off looks weak. The bears expect the same sell-off and will not be eager to take profits too early. Weak traders see that large bull trend bar in the opposite way. The weak bulls, who had been sitting on the sidelines hoping for an easy pullback to buy, see the market running away from them and want to make sure they catch this next leg up, especially since the bar is so strong and the day is almost over. The weak bears, who shorted early and maybe scaled in, were terrified by the rapidity with which the bar broke to a new high. They are afraid of relentless follow-through buying, so they buy back their shorts. These weak traders are trading on emotion and are competing against computers, which do not have emotion as one of the variables in their algorithms. Since the computers control the market, the emotions of the weak traders doom them to big losses on big bull trend bars at the end of an overdone bull trend. Once a strong bull trend begins to have pullbacks that are relatively large, the pullbacks, which are always small trading ranges, behave more like trading ranges than like bull flags. The direction of the breakout becomes less certain, and traders begin to think that a downside breakout is about as likely as an upside breakout. A new high is now a breakout attempt above a trading range, and the odds are that it will fail. Likewise, once a strong bear trend begins to have relatively large pullbacks, those pullbacks behave more like trading ranges than like bear flags, and therefore a new low is an attempt to break below a trading range, and the odds are that it will fail. Every trading range is within either a bull or a bear trend. Once the two-sided trading is strong enough to create the trading range, the trend is no longer strong, at least while the trading range is in effect. There will always be a breakout from the range eventually, and if it is to the upside and it is very strong, the market is in a strong bull trend. If it is to the downside and strong, the market is in a strong bear trend. Once the bears are strong enough to push a pullback well below the bull trend line and the moving average, they are confident enough that the market will likely not go much higher, and they will aggressively short above the old high. At this point, the bulls will have decided that they should buy only a deep pullback. A new mindset is now dominant at the new high. It is no longer a place to buy because it no longer represents much strength. Yes, there is profit-taking by the bulls, but most big traders now look at the new high as a great opportunity to initiate shorts. The market has reached the tipping point, and most traders have stopped looking to buy small pullbacks and instead are looking to sell rallies. The bears are dominant, and the strong selling will likely lead to a large correction or even a trend reversal. After the next strong push down, the bears will look for a lower high to sell again or to add to their short positions, and the bulls who bought the pullback will become concerned that the trend might have reversed, or at least that there will be a much larger pullback. Instead of hoping for a new bull high to take profits on their longs, they will now take profits at a lower high and not look to buy again until after a larger correction. Bulls know that most reversal attempts fail, and many who rode the trend up will not exit their longs until after the bears have demonstrated the ability to push the market down hard. Once these bulls see this impressive selling pressure, they will then look for a rally to finally exit their longs. Their supply will limit the rally, and their selling, added to the shorting by aggressive bears and the profit-taking by bulls who saw the sell-off as a buying opportunity, will create a second leg down. If the market enters a bear trend, the process will reverse. When the bear trend is strong, traders will short below prior lows. As the trend weakens, the bears will take profits at new lows and the market will likely enter a trading range. After a strong rally above the bull trend line and the moving average, the bears will take profits at a new low and strong bulls will aggressively buy and try to take control of the market. The result will be a larger bear rally or possibly a reversal into a bull trend. A similar situation occurs when there is a pullback that is large enough to make traders wonder if the trend has reversed. For example, if there is a deep, sharp pullback in a bull trend, traders will begin to wonder if the market has reversed. They are looking at moves below prior swing lows, but this is in the context of a pullback in a bull trend instead of as part of a bear trend. They will watch what happens as the market breaks out below a prior swing low. Will the market fall far enough for bears, who entered on a sell stop below that swing low to make a profit? Did the new low find more sellers than buyers? If it did, that is a sign that the bears are strong and that the pullback will probably go further. The trend might even have reversed. Another possibility on the breakout to a new low is that the market enters a trading range, which is evidence that the shorts took profits and that there was unimpressive buying by the bulls. The final alternative is that the market reverses up after the breakout to a new low. This means that there were strong bulls below that swing low just waiting for the market to test there. This is a sign that the sell-off is more likely just a big pullback in an ongoing bull trend. The shorts from higher up took profits on the breakout to the new low because they believed that the trend was still up. The strong bulls bought aggressively because they believed that the market would not fall further and that it would rally to test the bull high. Whenever there is any breakout below a swing low, traders will watch carefully for evidence that the bulls have returned or that the bears have taken control. They need to decide what influence is greater at the new low and will use the market's behavior to make that decision. If there is a strong breakout, then new selling is dominant. If the market's movement is uncertain, then profit-taking by the shorts and weak buying by the bulls are taking place, and the market will likely enter a trading range. If there is a strong reversal up, then aggressive buying by the longs is the most important factor. Sometimes, when the market is in a weak trend, there is a large breakout bar in the direction of the trend. That breakout bar often acts as a spike, and it is usually followed by several more trend bars, but they usually overlap and have tails. These bars create a tight bull channel. Like with any spike and channel trend, the market often tests back to the start of the channel, which in this case is the breakout gap area. For example, if there is a relatively weak bull swing, and then the market breaks to the upside with a large bull trend bar, and this is followed by 3 or 4 more smaller bull trend bars, these bars usually act as a channel. Once the market trades down to the area of the first of those channel bars, it often goes slightly below its low, and that puts the market in the gap area that was created by the breakout bar. The gap is both a measuring gap and a breakout gap, and the test of the gap is usually followed by a resumption of the trend rather than the start of a reversal down. An inflection is a mathematical term that means that there has been a change of direction. For example, if there is a horizontal wave that goes up and down repeatedly, when the wave is going down, at some point the slope changes from steeply down to less steeply down as it begins to form a bottom. For example, the middle of the letter S is the inflection point in the curve, because it is the point where the slope begins to change direction. In trading, an inflection is just an area where you expect a trend reversal, which may or may not develop. Since the move can go in either direction, the market is in breakout mode and traders will be ready to enter in the direction of the breakout. In either case, the market will often make a measured move, which is a move that covers about the same number of points as the pattern that led up to it. For example, a double top often leads to a breakout to the upside or downside. After the breakout, the market often runs beyond the breakout point to a measured move target that is about the same number of points away as the distance from the bottom to the top of the double top. There is often a gap between the breakout point and the first pullback, and the middle of the gap often leads to a measured move. Measuring gaps are discussed in Chapter 6 on gaps. Breakout mode situations can behave in an opposite way in a trading range. For example, if there is a breakout mode setup in the middle of a trading range, there may be more buyers than sellers below the bar, and more sellers than buyers above. If the situation is too uncertain to make traders believe that they have a good trader's equation, it is usually better to wait for clarity. At the extremes of a trading range, 3 things can happen. There can be 1, a reversal, 2, a breakout that fails and is followed by a reversal, or 3, a successful breakout. Only one of the 3 leads to a trend. This is consistent with the concept that most breakout attempts fail. When there is a breakout against a trend, the countertrend traders are trying to create a channel, a spike and channel trend, or some other form of a new trend after their spike. However, the trend traders are usually able to reverse the breakout within a few bars, turning it into a flag. For example, if there is a bear channel that has a large bull trend bar or two breaking above the channel, the bulls are hoping to form a bull channel after a pullback. However, they will usually fail, and the bull spike will end up as simply part of a bear flag. The bears saw the spike as a great opportunity to add to their shorts at a brief, high price, which represented correctly value to them. When a bull trend breaks above a prior swing high, there will be new buyers, profit takers, and shorts. See figure P1.1. If the trend that preceded the breakout is starting out and is very strong, there will be some profit taking, like after bars 5, 12, and 17, but the new buyers will overwhelm the bears, and the trend will quickly resume. Later in the trend, there will be much less new buying and much more profit taking, like after bar 19. There are many measures of excess, and once enough trading firms believe that the bull trend is overdone, they will take profits on their longs and buy again only after about a 10-bar, two-legged correction. I use the phrase 10-bar, two-legged often, and my intention is to say that the correction will last longer and be more complex than a small pullback. That usually requires at least 10 bars and 2 legs, and sometimes can result in a trend reversal. Whenever there is a breakout, it might fail and lead to a trend reversal. The chance of a successful reversal is greater if the context is right and the reversal bar is strong. If the breakout bar and spike leading to the breakout is stronger than the reversal bar, and the chance of a climactic reversal is not great, the odds are that the reversal attempt will fail within a few bars and form a breakout pullback setup that will lead to a resumption of the trend. For example, bar 12 was a small bear reversal bar, but it followed a much stronger 3-bar bull spike, and the market was trending up in a tight channel all day following a large gap up. This made the odds of a successful reversal small, so bulls bought at and below the low of bar 12. The next bar was a doji and therefore a weak entry bar for the bears, so there were almost certainly going to be more buyers than sellers above its high. It became a breakout pullback by signal bar, here, a high one by setup. The next bar was a bull bar, and more buyers bought above its high. In general, the odds of a successful buy signal are greater when traders wait to enter above a bull bar. Bar 14 was the breakout bar, but it closed on its low and formed a bear doji reversal bar, which is a weak sell signal in the face of such a tight bull channel. The bulls were so aggressive that they did not want the short to trigger. They placed limit orders at and above the low of the bear bar, and there were enough buy orders to overwhelm the bears. The short never triggered and the market continued to rally. Bar 14 was simply another pullback from the breakout, and it was also the breakout. And traders bought above the high of bar 15, which was another breakout pullback by signal. Another example of comparing the strength of the breakout with that of the reversal occurred on the bar 5 breakout. The bear bar after bar 5 was the signal bar for the failed breakout of the bar 4 1-bar bull flag and the breakout above bar 3. The bear signal was small compared to the 3-bar bull spike up from bar 4 and was therefore unlikely to reverse the trend. The next bar was a breakout pullback by setup, but had a bear body, which is not a strong buy signal bar. The bar after had a bull body, and therefore buying above its high had a higher probability of success. Bar 10 was a breakout of an Roman 2 bull flag, but the breakout bar was a bear reversal bar, which is a weak breakout bar. This increased the chances that the breakout would fail. The breakout bar was also the signal bar for the failed breakout. The correction sometimes breaks the bull trend line and creates enough selling pressure for the bears to become aggressive at the next new high, as they were at bar 25. There was still some profit taking by the bulls, but very little new buying. The bears took control going into the close. Both the strong bulls and bears looked forward to the final, strong breakout up to bar 19. They liked seeing a large bull spike after a protracted bull trend because the expected correction provided both of them with a temporary trading opportunity. It was the third consecutive bull climax without a correction since the bar 11 low bars 11 to 12 and 15 to 17 were the first two. And consecutive buy climaxes often lead to a two-legged correction lasting about 10 bars and falling below the moving average. Both the strong bulls and bears sold at the close of the 2-bar bull spike before bar 19, above its high at the close of bar 19, especially since it had a bear body, and below its low. The bulls didn't look to buy again, and the bears did not take profits on their shorts until after the two-legged correction was complete, which was in the bar 21 to bar 24 area. The sell-off was strong enough for both to think that the market might have a trend reversal into a bear trend after a lower high or higher high test of the bar 19 bull high, and this resulted in the sell-off from bar 25 into the close. Since most reversal attempts fail, traders often fade them. Bar 22 was a strong bear trend bar in a bull trend, and many traders bought its close. Their first target was a move to the high of the bar, which occurred 2 bars later, and then a measured move up, which was reached by the end of the day. The bear bar after bar 5 was a breakout mode setup. Since it was a bear bar after a bull breakout above the bar 3 swing high, it was a failed breakout short setup. It was also a 1-bar pullback in a bull breakout, so it was a high 1 breakout pullback by setup. In this case, since the 3-bar bull spike was so strong, it was more likely that the bulls would outnumber the bears both below and above the bar. Some bought at the low of the bear inside bar with limit orders, whereas others bought above it and above bar 6 with stop orders. As shown in figure P1.2, the E-mini was in a bear trend on the 60-minute chart on the left, and many traders looked to buy a measured move down, based on the height of the initial spike down from bar 1 to bar 2. The bears bought back their shorts to take profits, and aggressive bulls bought to initiate longs, expecting a possible trend reversal and test of the start of the bear channel. The lower swing high after bar 2. The chance of at least 2 legs up was increased by the reversal down from the bar 3 moving average gap bar and break above the bear trend line. Reversals are covered in the 3rd book. The 5-minute chart on the right reversed up after falling 1 tick below the 60-minute measured move target. Bar 4 is the same time on both charts. Bar 5 was a large bull reversal bar with a small tail, and bulls were hopeful for a strong reversal up. However, the bar had only 23,000 contracts, or about 3 times as many as an average 5-minute bar. When the average 5-minute bar has 5,000 to 10,000 contracts, most bull reversals with protracted follow-through have about 5 to 10 times that volume, or at least 40,000 to 50,000 contracts. The most reliable bars have over 100,000 contracts. Traders do not have to worry about volume because the chart will tell them what they need to know, but seeing huge volume on a large trend bar that is breaking out increases the chances that there will be follow-through and usually at least some kind of measured move. When there is a strong bear trend and the reversal up goes for only 2 bars and then pulls back, and the second bar up has a large tail, the reversal is not strong. More experienced traders can look at the volume and see it as another sign that the reversal is not strong, or they can look at the 60-minute chart and see the strong bear trend. However, all day traders need to see is the 5-minute chart to place their trades. They would have bought bar 5 as it was forming as it closed and above its high. They would have also bought the bar 7 IOI inside pattern high 4 bull flag at the moving average. Since they were buying a strong bull move, they should have assumed that they had at least a 60% chance of making a reward that was at least as large as their risk. They could have chosen a 2-point stop, since that worked well lately, and then used a 2-point profit target. Another trader who bought at the bar 5 close might have been willing to risk to below the bar 5 low, about 4 points, and his profit-taking target might have been as many points as he had to risk. The stop for the trader who bought above bar 7 would have been below the low of bar 7 or below the bar before it. Her risk was about 2 points, and she could have held for either 2 points or for a move above the bar 6 high. Here, it was also about 2 points. Chapter 1. Example of how to trade a breakout. Many beginners find breakouts difficult to trade because the market moves fast, requiring quick decisions and often has large bars, which means that there is more risk, and traders then have to reduce their position size. However, if a trader learns to identify one that is likely to be successful, the trader's equation can be very strong. When a chart discussion runs for multiple pages, remember that you can go to the Wiley website, www.wiley.com/go/trading-ranges, and either view the chart or print it out, allowing you to read the description in the book without having to repeatedly flip pages back to see the chart. Successful breakouts, like the bull breakouts in Figure 1.1, have excellent math, but can be emotionally very difficult to trade. They happen quickly and traders instinctively know that the risk is to the bottom of the spike. They put their protective stop at 1 tick below the low of the lowest bar in the bull spike, like below bar 14, which is often more than their usual risk tolerance. They want a pullback, but know it will likely not come until the market is higher, and they are afraid to buy at the market because they are buying at the top of a spike. If the market reverses on the next tick, they will have bought at the top of a spike, and their protective stop is very far away. However, what they often fail to appreciate is that the math is on their side. Once there is a strong spike in a breakout like this, the probability of at least a measured move up based on the height of the spike is at least 60% and may even sometimes be 80%. This means that they have at least a 60% chance of making at least as much as their initial risk. And if the spike continues to grow after they enter, their risk stays the same, but the measured move target gets higher and higher. For example, if traders bought at the close of bar 15 on the 5-minute chart of the 10-year U.S. Treasury note futures in figure 1.1, they would risk to 1 tick, 1/64th of a point below the bottom of the 2-bar spike, which is 1 tick below the bar 14 low, or 7 ticks below the entry price. At this point, since the traders believed that the market was always in long, they thought that there was at least a 60% chance of it being higher within a few bars. They should also have assumed that there would be at least a measured move up. Since the spike was 6 ticks tall, the market had at least a 60% chance of trading up at least 6 ticks before falling to their protective stops. At the close of bar 19, the spike had grown to 17 ticks tall, and since it was still a breakout spike, there was still at least a 60% chance of at least a measured move up. If traders were flat at this point, they could have bought small positions at the market and risked to 1 tick below the bar 14 bottom of the spike, or 18 ticks. To make 16 ticks, if the market went 17 ticks higher, they could get out with 16 ticks of profit. The traders who bought the bar 15 close were still risking 7 ticks to below the bar 14 low, but now had a 60% chance of the market trading 17 ticks above the bar 19 high, which would be about a 28-tick profit, 1432 NDS. The spike ended at bar 19, once the next bar was a bear inside bar instead of another strong bull trend bar. This was the first in a series of pullbacks in the channel phase of the bull trend. Bar 24 went above the measured move target, and the market traded even higher about an hour later. In practice, most traders would have tightened their stops as the spike grew, so they would have risked less than what was just discussed. Many traders who bought the bar 15 close might have raised their stops to below bar 17 once it closed, because they would not have wanted the market to fall below such a strong bull trend bar. If it did, they would have believed that their premise was wrong and they would not want to risk a larger loss. When bar 19 closed and traders saw that it was a strong bull trend bar, many might have put their protective stops in the micro-measuring gap created by the bar 17 breakout. The low of bar 18 was above the high of bar 16, and this gap is a sign of strength. Traders would want the market to continue up and not trade below bar 18 and into the gap, so some traders would have trailed their stop to below the bar 18 low. Many experienced traders use spikes to press their trades. They add to their longs as the spike continues up, because they know that the spike has an exceptional trader's equation and that the great opportunity will be brief. A trader needs to be aggressive when the market is offering trades with strong trader's equations. He also needs to trade little or not at all when it does not, like in a tight trading range. The bull's spike up from bar 5 flipped the market to always in long for most traders. When the market traded above the bar 11 wedge bear flag high, it was likely to have approximately a measured move up. Bar 15 was a second consecutive strong bull trend bar and confirmed the breakout in the minds of many traders. Both bars 14 and 15 were strong bull trend bars with good-sized bodies and without significant tails. There was good buying pressure all of the way up from the bar 5 low, as seen by many strong bull trend bars, little overlap, and only a few bear trend bars and the absence of consecutive strong bear trend bars. The market might have been in the early stages of a bull trend, and smart traders were looking for a bull breakout. They were eager to get long once bars 14 and 15 broke out, and traders kept buying relentlessly in pieces all the way up to the bar 19 high. The most important thing that traders must force themselves to do, and it is usually difficult, is as soon as they believe that there is a reliable breakout spike, they must take at least a small position. When they feel themselves hoping for a pullback, but fearing that it won't come for many more bars, they should assume that the breakout is strong. They must decide where a worst-case protective stop would be, which is usually relatively far away, and use that as their stop. Because the stop will be large, their initial position should be small if they are entering late. Once the market moves in their direction and they can tighten their stop, they can look to add to their position, but should never exceed their normal risk level. When everyone wants a pullback, it usually will not come for a long time. This is because everyone believes that the market will soon be higher, but they do not necessarily believe that it will be lower anytime soon. Smart traders know this, and therefore they start buying in pieces. Since they have to risk to the bottom of the spike, they buy small. If their risk is 3 times normal, they will buy only 1/3 of their usual size to keep their absolute risk within their normal range. When the strong bulls keep buying in small pieces, this buying pressure works against the formation of a pullback. The strong bears see the trend and they, too, believe that the market will soon be higher. If they think it will be higher soon, they will stop looking to short. It does not make sense for them to short if they think that they can short at a better price after a few more bars. So the strong bears are not shorting and the strong bulls are buying in small pieces in case there is no pullback for a long time. What is the result? The market keeps working higher. Since you need to be doing what the smart traders are doing, you need to buy at least a small amount at the market or on a 1 or 2 tick pullback and risk to the bottom of the spike. Even if the pullback begins on the next tick, the odds are that it won't fall too far before smart bulls see it as value and they buy aggressively. Remember, everyone is waiting to buy a pullback, so when it finally comes, it will only be small and not last long. All of those traders who have been waiting to buy will see this as the opportunity that they wanted. The result is that your position will once again be profitable very soon. Once the market goes high enough, you can look to take partial profits, or you can look to buy more on a pullback, which will probably be at a price above your original entry. The important point is that as soon as you decide that buying a pullback is a great idea, you should do exactly what the strong bulls are doing and buy at least a small position at the market. Some traders like to buy breakouts as the market moves above a prior swing high, entering on a buy stop at 1 tick above the old high. In general, the reward is greater, the risk is smaller, and the probability of success is higher when entering on pullbacks. If traders buy these breakouts, they usually will then have to hold through a pullback before they can make much profit. It is usually better to buy the pullback than the breakout. For example, rather than buying above bar 6 as the market moved up to bar 9, the trader's equation was probably stronger for a buy above the bar 10 pullback instead. The same is true for the bar 11 move above bar 9. With every breakout, traders have to decide if it will succeed or fail. If they believe that it will succeed, they will look to buy the close of the breakout or follow through bars, at and below the low of the prior bar and above the high of the prior bar. If they believe that it will fail, they will not buy, and if they are long, they will exit their positions. If they believe that the failure will trade down far enough for a scalp, they might go short for a scalp. If they think that the failure will lead to a trend reversal, they might look to swing a short down. In this particular case, as the market moved strongly above the bar 9 and bar 11 double top, it was reasonable to buy the breakout. But traders who bought the close of bar 15 entered around the same price and had a more sound reason to take the trade, buying the close of a strong bull trend bar in a strong bull spike. If any bull trend or breakout that does not look quite strong enough to buy near the top of the spike, like on the close of the most recent bar, the trader's equation is stronger if traders instead wait to buy pullbacks. Bar 22 was the second bar of a breakout from a Roman 2 pattern and therefore the beginning of a possible final flag reversal setup. This was likely a minor by Climax, discussed in Book 3 in the chapter on Climax reversals. At this point, the trader's equation was stronger for buying a pullback than for buying the close of bar 22. The same was true for bar 24. As a trend becomes more two-sided, it is better to look to buy pullbacks. Once the two-side trading becomes strong enough and the prior pullbacks have been deeper and lasted for more than 5 bars or so, traders can begin to short for scalps, like at the 2-bar reversal at bar 24, shorting below the low of then bear bar that followed. After the market has transitioned into a trading range, the bears will begin to short for swing trades, expecting deeper pullbacks and a possible trend reversal. Other examples of breakout pullback by setups in this bull trend include the bar 8 high 2 bull flag, a pullback from the rally to bar 6, which broke out of the bear channel from bar 3 to bar 5. The bar 12 high 2 at the moving average, bar 11 broke above the trading range and out of the bar 10 high 1 bull flag. The first push down was the bear bar that formed 2 bars after bar 11. The bar 14 outside up bar traders could have bought as it went outside up, but the probability of success was higher if they bought above bar 14 because it was a bull trend bar. The bar 20 Roman 2, the high 2 at bar 23 was the entry bar, and the bar 25 high 2, all double bottoms are high 2 patterns. The signal bar is more reliable when it has a bull body. In general, whenever there is an initial pullback in a trend that has just become strongly always in long, a trader should immediately place a buy stop to buy above the high of the spike. This is because many traders are afraid to buy below the low of the prior bar or above a high one, thinking that the market might have a two-legged pullback. However, if they wait for a two-legged pullback, they will miss many of the very strongest trends. To prevent themselves from being trapped out of a strong trend, traders need to get into the habit of placing that last-ditch buy stop. If they buy the high one, they can cancel their buy stop. But if they miss the earlier entries, at least they will get into the trend, which is what they need to do. By bar 19, the trend was clearly very strong and was likely to continue up for about a measured move based on the height of the spike. As soon as the market gave a sign of a possible pullback, traders needed to place their worst-case entry buy stop orders above the spike high. The bar after bar 19 was a bear trend bar and a possible start of a pullback. They needed to place a buy stop at one tick above the bar 19 high in case the trend quickly resumed. If they instead bought the bar 20 Roman 2 high 1 setup, they would have canceled the buy stop above bar 19. However, if they missed buying the high one for any reason, at least they would have been swept into the trend as the market moved to the new high. Their initial protective stop would have been below the most recent minor pullback, which was the bar 20 low. Bar 24 was a 2-bar bull spike and the third consecutive by climax without a correction. There was not enough time left in the day for a 10-bar, two-legged correction, so not many bears were willing to short it, especially since the move up from bars 5 and 12 had had so little selling pressure. However, some bulls used it as an opportunity to take profits, which turned out to be a reasonable decision since the market did not get back above its high for the rest of the day. Traders know that most attempts to reverse a trend fail, and many like to fade the attempts. The bar before bar 12 was a large bear trend bar, which was a break below the trend line and an attempt to reverse down from the bar 11 bull breakout. Bulls bought the close of the bear trend bar, expecting a move back up to its high and probably a measured move up equal to the height of the bar. Once they saw that bar 12 had a bull close, they bought the close of bar 12 and above its high. A successful bear breakout usually is followed by another bear trend bar or at least a doji bar, and if there is instead a bull body, even a small one, the odds of a failed breakout attempt become higher, especially when the bar is at the moving average in a bull trend. The bears wanted a bear channel after the bear spike, or some other type of bear trend, but the bulls saw the bear spike as an opportunity to buy during a brief discount. Bear spikes, especially on daily charts, can be due to news items, but most fail to have follow through, and the longer-term bullish fundamentals win out, leading to a failed bear breakout and a resumption of the bull trend. The bears get excited and hopeful because of the terrible news, but the news is usually a one-day minor event and trivial compared to the sum of all of the fundamentals. Figure 1.2 shows that when a bull swing has a breakout to the upside, the market usually tests back into the breakout gap. The market sold off down to bar 8 and then reversed up. Bar 12 was a second entry moving average gap bar short, but it failed. Instead of testing the bear low, the market broke to the upside on bar 13. The low of the bar after the breakout bar and the high of the bar 11 breakout point created a breakout gap. Either its middle or the high of the first leg up to bar 11 could lead to a measured move up. After the bar 13 spike up, there was a tight 4-bar channel that ended at bar 15 and then a test down to the bottom of the channel. The bar 19 test also tested into the breakout gap, which usually happens in these situations. The sell-off from bar 5 to bar 8 had no pullbacks, and the bar after bar 8 was the first bar that traded above the high of the prior bar. Why would experienced traders ever buy back their highly profitable shorts when the first pullback in a strong trend usually fails? They have learned that they should always look for reasons to take partial or full profits, especially when they are large, because those profits can vanish quickly, especially after a possible sell climax. Here, there were 3 consecutive sell climaxes, the moves down to bars 6, 7, and 8. And the inside bar after bar 7 was a potential final flag. These patterns are discussed in Book 3. The odds were high that the market would correct up for about 10 bars, probably to the moving average, the bar 4 low, or even the bar 5 high. The bears saw this as a great opportunity to lock in their profits around bar 8, expecting at least a 10-bar rally, and then look to sell again much higher if a sell setup developed. The move up was so strong that there was no sell pattern, and the bears were happy that they wisely took their profits, and they were not concerned about the absence of another good chance to short. Had they held onto their shorts, all of their profits would have turned into losses. Profit-taking is the cause of the first pullback in any strong trend. The bears who missed the sell-off were hoping for a pullback that would allow them to short, but they never got that opportunity. The bears who missed the sell-off to bar 4, or who took profits at bar 4 and were looking to sell again on a pullback, got their chance at the bar 5 low 2 at the moving average. It had a bear body and was also a 20-gap bar short setup, discussed later in this book. Chapter 2. Signs of strength in a breakout. The minimum criterion for a breakout to be successful is that a trader could enter on the breakout and make at least a scalper's profit. The strongest breakouts will result in strong trends that can last for dozens of bars. There are early signs that increase the likelihood that a breakout will be strong enough to run to one or more measured move targets. For example, the more of the following characteristics that a bull breakout has, the more likely the breakout will be strong. The breakout bar has a large bull trend body and small tails or no tails. The larger the bar, the more likely the breakout will succeed. If the volume is 10 to 20 times the average volume of recent bars, the chance of follow-through buying and a possible measured move increases. The spike goes very far, lasts several bars, and breaks several resistance levels like the moving average, prior swing highs, and trend lines, and each by many ticks. As the first bar of the breakout bar is forming, it spends most of its time near its high, and the pullbacks are small, less than a quarter of the height of the growing bar. There is a sense of urgency. You feel like you have to buy, but you want a pullback, yet it never comes. The next 2 or 3 bars also have bull bodies that are at least the average size of the recent bull and bear bodies. Even if the bodies are relatively small and the tails are prominent, if the follow-through bar, the bar after the initial breakout bar, is large, the odds of the trend continuing are greater. The spike grows to 5 to 10 bars without pulling back for more than a bar or so. As a bull breakout goes above a prior significant swing high, the move above the high goes far enough for scalpers to make a profit if they entered on a stop at 1 tick above that swing high. 1 or more bars in the spike has a low that is at or just 1 tick below the close of the prior bar. 1 or more bars in the spike has an open that is above the close of the prior bar. 1 or more bars in the spike has a close on its high or just 1 tick below its high. The low of the bar after a bull trend bar is at or above the high of the bar before the bull trend bar, creating a micro gap, which is a sign of strength. These gaps sometimes become measuring gaps. Although it is not significant to trading, they probably represent the space between a smaller time frame Elliot wave 1 high and a wave 4 pullback, which can touch but not overlap. The overall context makes a breakout likely, like the resumption of a trend after a pullback, or a higher low or lower low test of the bear low after a strong break above the bear trend line. The market has had several strong bull trend days recently. There was growing buying pressure in the trading range, represented by many large bull trend bars, and the bull trend bars were clearly more prominent than the bear trend bars in the range. The first pullback occurs only after 3 or more bars of breaking out. The first pullback lasts only 1 or 2 bars, and it follows a bar that is not a strong bear reversal bar. The first pullback does not reach the breakout point and does not hit a break-even stop, the entry price. The breakout reverses many recent closes and highs. For example, when there is a bear channel and a large bull bar forms, this breakout bar has a high and close that are above the highs and closes of 5 or even 20 or more bars. A large number of bars reversed by the close of the bull bar is a stronger sign than a similar number of bars reversed by its high. The more of the following characteristics that a bull breakout has, the more likely it will fail and lead to either a trading range or a reversal. The breakout bar has a small or average size bull trend body and a large tail on top. The next bar has a bear body and is either a bear reversal bar or a bear inside bar. That bar closes on or near its low, and the body is about the size of the average bodies of the bars before the breakout, not just a one-tick tall bear body. The overall context makes a breakout unlikely, like a rally to test the high of a trading range day. But the rally has bear bars, many overlapping bars, bars with prominent tails, and a couple of pullbacks along the way. The market has been in a trading range for several days. The bar after the breakout bar is a strong bear reversal bar or a bear inside bar. The bar after a bull trend bar has a low that is below the high of the bar before the bull trend bar. The first pullback occurs 2 bars after the reversal. The pullback extends for several bars. The trend resumption after the pullback stalls, and the market forms a lower high with a bear signal bar. The spike breaks above a resistance level like a swing high, a bear trend line, or a bull trend channel line by only a tick or so, and then reverses down. The spike barely breaks above a single resistance level, but pulls back before breaking above other levels that are just a little higher. A trader who bought on a stop above a prior swing high would not be able to make a scalper's profit before there was a pullback. As the breakout bar is forming, it pulls back more than 2/3 of the height of the bar. As the breakout bar is forming, it pulls back for at least 1/3 of its height 2 or more times. The pullback falls below the breakout point. There are no gaps between the low of any bar and the high of the bar 2 bars earlier. The pullback falls below the low of the first bar of the spike. The pullback hits the break-even stop. There is a sense of confusion. You feel like you are not certain whether the breakout will succeed or fail. The opposite of all of the preceding is true for bear breakouts. The more of the following characteristics that a bear breakout has, the more likely the breakout will be strong. The breakout bar has a large bear trend body and small tails or no tails. The larger the bar, the more likely the breakout will succeed. If the volume is 10 to 20 times the average volume of recent bars, the chance of follow-through selling and a possible measured move down increases. The spike goes very far, lasts several bars, and breaks several support levels like the moving average, prior swing lows, and trend lines, and each by many ticks. As the first bar of the breakout bar is forming, it spends most of its time near its low, and the pullbacks are small less than 1/4 of the height of the growing bar. There is a sense of urgency. You feel like you have to sell but you want a pullback, yet it never comes. The next 2 or 3 bars also have bear bodies that are at least the average size of the recent bull and bear bodies. Even if the bodies are relatively small and the tails are prominent, if the follow-through bar, the bar after the initial breakout bar, is large, the odds of the trend continuing are greater. The spike grows to 5 to 10 bars without pulling back for more than a bar or so. As a bear breakout goes below a prior significant swing low, the move below the low goes far enough for scalpers to make a profit if they entered on a stop at 1 tick below that swing low. 1 or more bars in the spike has a high that is at or just 1 tick above the close of the prior bar. 1 or more bars in the spike has an open that is below the close of the prior bar. 1 or more bars in the spike has a close on its low or just 1 tick above its low. The high of the bar after a bear trend bar is at or below the low of the bar before the bear trend bar, creating a micro gap, which is a sign of strength. These gaps sometimes become measuring gaps. Although it is not significant to trading, they probably represent the space between a smaller time frame Elliot wave 1 low and a wave 4 pullback, which can touch but not overlap. The overall context makes a breakout likely, like the resumption of a trend after a pullback, or a lower high or higher high test of the bull high after a strong break below the bull trend line. The market has had several strong bear trend days recently. There was growing selling pressure in the trading range, represented by many large bear trend bars, and the bear trend bars were clearly more prominent than the bull trend bars in the range. The first pullback occurs only after 3 or more bars of breaking out. The first pullback lasts only 1 or 2 bars, and it follows a bar that is not a strong bull reversal bar. The first pullback does not reach the breakout point and does not hit a break-even stop, the entry price. The breakout reverses many recent closes and lows. For example, when there is a bull channel and a large bear bar forms, this breakout bar has a low and close that are below the lows and closes of 5 or even 20 or more bars. A large number of bars reversed by the close of the bear bar is a stronger sign than a similar number of bars reversed by its low. The more of the following characteristics that a bear breakout has, the more likely it will fail and lead to either a trading range or a reversal. The breakout bar has a small or average size bear trend body and a large tail on the bottom. The next bar has a bull body and is either a bull reversal bar or a bull inside bar. That bar closes on or near its high, and the body is about the size of the average bodies of the bars before the breakout, not just a one-tick tall bull body. The overall context makes a breakout unlikely, like a sell-off to test the low of a trading range day. But the sell-off has bull bars, many overlapping bars, bars with prominent tails, and a couple of pullbacks along the way. The market has been in a trading range for several days. The bar after the breakout bar is a strong bull reversal bar or a bull inside bar. The bar after a bear trend bar has a high that is above the low of the bar before the bear trend bar. The first pullback occurs 2 bars after the reversal. The pullback extends for several bars. The trend resumption after the pullback stalls, and the market forms a higher low with a bull signal bar. The spike breaks below a support level like a swing low, a bull trend line, or a bear trend channel line by only a tick or so, and then reverses up. The spike barely breaks below a single support level but pulls back before breaking below other levels that are just a little lower. A trader who shorted on a stop below a prior swing low would not be able to make a scalper's profit before there was a pullback. As the breakout bar is forming, it pulls back more than 2/3 of the height of the bar. As the breakout bar is forming, it pulls back for at least 1/3 of its height 2 or more times. The pullback rallies above the breakout point. There are no gaps between the high of any bar and the low of the bar 2 bars earlier. The pullback rallies above the high of the first bar of the spike. The pullback hits the break-even stop. There is a sense of confusion. You feel like you are not certain whether the breakout will succeed or fail. To a trader, the breakout implies strength and a possible new trend. It follows a period of two-sided trading where the bulls and bears both agree that there is value and both are willing to take positions. During the breakout, they both now agree that the market should find value at another price, and the breakout is a fast move in search of that new price. The market prefers uncertainty and quickly moves in search of it. A breakout is a period of certainty. Bulls and bears are certain that the prices within the breakout are too high in a bear breakout or too low in a bull breakout, and the odds of follow-through are usually about 60 to 70%. The market moves quickly in search of a price level where both the bulls and bears agree there is value for them to initiate trades. This means that there is once again uncertainty, and no one knows which side will win and succeed in creating the next breakout. Uncertainty is the hallmark of a trading range, so a breakout is a search for a trading range, for uncertainty, and a 50% directional probability of an equidistant move. The channel that follows the spike usually creates an approximate top and bottom of the trading range that typically follows. As the market is moving up in the channel, the directional probability of an equidistant move erodes, and it actually favors a reversal when it reaches the end of the channel. This is because trading range breakouts generally fail, and the odds favor a move back into the middle of the range where the directional probability is neutral. That middle of the range is the target of the breakout, and its location is unknown until after it forms. A breakout begins with a trend bar, which can be large or small, but it is usually at least somewhat large compared to the size of the recent bars. Remember, all trend bars should be viewed as breakouts, spikes, gaps, and climaxes. When it is small, it is easy to dismiss its importance, but if it is followed by some sideways price action and then a steady directional move, a breakout is underway. The easiest breakouts to spot occur when an unusually large trend bar quickly moves the market out of a trading range, and it is soon followed by other trend bars in the same direction. Whether the breakout is a single trend bar or a series of trend bars, it is a spike. As mentioned earlier, almost all trends can be considered to be some type of spike and channel trend. For example, if a bull breakout bar has a strong close and the next several bars also have strong closes, small or non-existent tails, and trending highs and lows, no pullback bars, and there is very little overlap between the bodies of consecutive bull trend bars, then the market will likely be higher than it is at the current moment at some point before the market reverses back beyond the start of the breakout move. If the trend continues, eventually its momentum will slow and there will generally be some type of channel. One of the most important concepts in trading is that most breakouts fail. Because of this, entering on every breakout in the direction of the breakout is a losing strategy. However, there are often price action events that increase the likelihood that a breakout will succeed. For example, if there is a strong bear trend and then a two-legged rally to the moving average, going short on the downside breakout of this bear flag is a sensible trade. However, if the market is not in a trend and there are lots of overlapping bars and many bars with large tails, the market is in balance. Both the bulls and the bears are comfortable taking positions and a trading range is developing. If the market then has a bull trend bar that extends to the top of or even above the trading range, the bears who are happy to sell in the middle of the range are going to be even more aggressive at this better price. Also, the bulls who are happy to buy in the middle of the range will become hesitant to buy higher and instead will be quick to exit at the top of the range. This behavior by the bulls and the bears creates a magnetic pull in the middle of the range, and the result is that most of the trading will be in the middle of the range. Even once the market successfully breaks out and travels for maybe a measured move equal to the height of the range, the magnetic pull will still tend to draw the market back into the range. This is what makes final flag reversals so reliable, discussed in Book 3. If you look at any chart, you will notice lots of bull and bear trend bars with relatively large bodies and small tails. Each of these is a breakout attempt, and almost all fail to lead to a trend, and instead the trading range continues. On a 5-minute E-mini chart, these probably represent buy and sell programs trying to move the market. Some algorithms are designed to fade these trend bars, expecting most to fail. Experienced traders will do this as well when they believe that the breakout will probably fail. For example, if there is a breakout in the form of a large bull trend bar, these programs might short on the close of the bar, above its high on the close of the next bar or two, or below their lows. If enough program trading dollars come in on the fade side, the sell side, they will overwhelm those programs that are trying to initiate the bull trend, and the trading range will continue. Eventually, a breakout will succeed. The breakout bar will be large, the pullbacks as the bar is forming will be small, and the breakout will have good follow-through over the next several bars. The programs that are trying to fade the move are failing, and they will cover their losing positions and drive the trend further. The strength will attract other trend traders, many of whom are momentum traders, and quickly enter whenever they see momentum. Once everyone is convinced that the market is now trending, it might go far before there is a pullback. Why is that? Consider an example of a market breaking into a strong bull trend with a spike formed by 3 strong bull trend bars. Traders believe that the market will be higher at some point before long, and they are not confident that it will be lower within the next few bars. This makes bears buy back their shorts, lifting the market even more. Bulls who are underinvested believe the market is going higher in the near term and that they will make more money by simply buying at the market or on a 2 or 3 tick pullback than they would if they waited for an 8 or 10 tick pullback or a pullback to the moving average. This also lifts the market. Since bulls and bears are both essentially buying at the market as it is going up, the pullback never comes, or at least it does not come for 5 or more bars after the market is well above the current price. This is discussed in more detail in Chapter 8, but traders are willing to buy at the market at any time in a breakout because they believe that the odds are better than 50-50 that they will make at least as many points as they are risking. When the breakout is strong, the probability is usually 60 to 70% or more. If they buy the 5-minute E-mini on the high tick, when the top of the spike is 4 points above the low of the spike, they believe that the odds are probably 60% or better that the market will go up 4 more points before their 4-point stop is hit. How can you be sure of this? because it is mathematically unwise to have your risk equal your reward if the chance of success is much less than 60%, and institutions would therefore not be taking this trade. Since the market is still going up, then institutions are taking the trade. Since the trade remains valid as long as the market stays above the bottom of the spike, they are risking to the bottom of the spike. They know that the spike usually goes up to about a measured move, so their profit target, which is their reward, is equal to their risk. If the spike grows another 2 points before pausing, the spike is then 6 points tall. If that is the end of the spike, they will assume that there is about a 60% chance that the market will go another 6 points higher before it falls 6 points. This means that all of the bulls who bought lower have a 60% chance that the market will go another 6 points higher before their 4-point stop is hit. For example, the bulls who bought when the spike was 4 points tall are now risking 4 points to make a total of 8 points on a 60% bet, which is a great mathematical situation. They expect that the market has a 60% chance of testing 6 points above the close of the spike, which is 2 points above their entry, giving them an 8-point profit target. When a breakout is successful and leads to a trend, the momentum slows after the initial fast move, and signs of two-sided trading develop, like overlapping bars, increasing tails, trend bars in the opposite direction, and pullback bars. Even though the trend may continue for a long time, this part of the trend usually gets retraced and becomes part of a trading range. For example, in a spike and channel bull trend pattern, the spike is the breakout, and the channel usually becomes the first leg of a trading range and therefore will usually be retraced. Typically, the market eventually pulls back all the way to the start of the channel, completing the second leg of the incipient trading range. In the example of that bull breakout, the market will then usually try to bounce off that support. This results in a double bottom bull flag that sometimes leads to a breakout above the new range, and other times it evolves into a protracted trading range like a tight trading range or a triangle. Less often, it is followed by a reversal. On the 5-minute E-mini chart, there are usually many attempts to break out every day, but most fail after 1 or 2 trend bars. They most likely represent the start of a program trade by some institution, but they get overwhelmed by opposite programs by other institutions. When enough institutions have programs running in the same direction at the same time, their programs will be able to move the market to a new price level, and the breakout will be successful. However, nothing is ever 100% certain, and even the strongest breakouts fail about 30% of the time. When a breakout is very strong, there will be 3 or more trend bars with small tails and very little overlap. This means that traders are not waiting for a significant pullback. They are afraid that there might not be a pullback until after the market has run a long way, and they want to be certain to capture at least part of the trend. They will enter at the market and on tiny pullbacks of 1 or 2 ticks, and their relentless orders will give the trend strength and work against the formation of a significant pullback. The breakout bars often have large volume, and sometimes they will have 10 to 20 times the volume of an average bar. The higher the volume and the more bars in the spike, the more likely it is that there will be significant follow-through. Prior to the breakout, both the bulls and the bears were scaling into their positions, fighting over control of the market and each trying to create a successful breakout in their direction. Once there is a clear breakout, the losing side will cover their large position quickly with a loss, and the winning side will enter even more aggressively. The result is 1 or more trend bars, often with high volume. Volume is not always especially high, but when it is 10 or more times the average of the recent bars, the probability of a successful breakout, meaning that there will be follow-through for many bars, is higher. Also, volume can be unusually high on breakouts that fail within a few bars, but this is less common. Volume is not reliable enough to warrant following it, and the large trend bars that comprise the spike will already tell you whether the breakout is likely to be successful. Trying to think about the volume in addition will, more often than not, distract you and hinder your ability to trade at your best. All successful breakouts should be viewed as spikes, since most are followed by channels and create a spike and channel trend pattern. However, the breakout can also fail, and the trading range that preceded it then becomes a final flag, if it was a flag in a trend. In fact, most breakouts do fail, but the breakout bar is so unremarkable that most traders don't even realize that there was an attempted breakout. Less commonly, the market can enter a tight trading range after the breakout, and this is usually followed by trend resumption. But sometimes the breakout of that tight trading range can be in the other direction, resulting in a reversal. A breakout can be a single large trend bar or a series of large or small trend bars, and the breakout usually becomes part of one of the trend patterns previously discussed. For example, if there is a trend from the open bear trend, it is likely a breakout below a pattern from the previous day. If the trend is orderly, it might be followed by a tight trading range for several hours, and then the day could turn into a trend resumption bear into the close. If instead the breakout is accelerating to the downside with each bar resulting in a steeper slope, and the chart assumes a parabolic and therefore climactic look, it might be followed by a pullback and then a channel. The day could become a spike and channel bear trend day. Sometimes, after the market has been in a strong trend for many bars, it creates an unusually large trend bar in the direction of the trend. That large bar typically either becomes a breakout into an even steeper, stronger trend, or at least another leg in the trend, or can signify a climactic end of the trend. If the market pulls back for a few bars and does not retrace too much of the breakout bar, the odds of the breakout being successful are good, and traders will enter on the high one breakout pullback if this was a bull breakout, or short a low one in a bear breakout. The trend can continue even if the pullback retraces beyond the breakout point, but the deeper the pullback, the more likely it is that the breakout will fail and the market will reverse. In this case, the large bar will represent a climactic end of the trend rather than a breakout. If the pullback is fairly deep, traders might hesitate to enter with the trend for an hour or so. For example, if there is a large bull trend bar that breaks above a swing high or trading range but the pullback is fairly deep, maybe a little below the top of the swing high, traders will not be certain if the breakout has failed or if the rally is just a little overdone. The bulls in this case often will not buy for about 10 bars or so, and the market will frequently enter a small trading range. Instead of buying a high one, they will likely wait for a high two, especially if it forms after an hour or so. If the trading range is holding above the moving average and about an hour has passed, bulls will look to buy a two-legged sideways or down pullback. Sometimes the sideways move is followed by a second leg down. That second leg can lead to a new high or to a trend reversal and more selling. Once there is a pullback, which is a small trading range, traders will look for the trend to resume. The breakout from the pullback has an initial target of an approximate measured move equal to about the height of the trading range. Many traders will take partial or total profits in that area, and aggressive countertrend traders will initiate new positions. The easiest breakout failures to spot are those where the market quickly reverses direction and does not make any significant attempt to continue in the direction of the breakout. This is more likely to happen when there is other evidence of a possible reversal, like a breakout above a trend channel line and then a reversal down with a strong signal bar. The breakout can be of anything, such as a trend line, a trading range, or the high or low of the day or yesterday. It does not matter because they are all traded the same. Fade it if it fails and re-enter in the direction of the breakout if the reversal attempt fails and therefore becomes a breakout pullback. Enter on the breakout only if it is very strong. An example of this is if there is a strong bull trend and then a two-bar pullback to a high one by setup. Traders can buy at one tick above the high of the prior bar, and they can buy more on a breakout to a new high by placing an order to buy on a stop at one tick above the old high. Usually, however, it is better to buy a pullback or to look to short a failed breakout. On most days, traders look at new swing highs and lows as possible fade setups. On a strong trend day, however, the breakouts are usually on huge volume and there is very little pullback, even on a 1-minute chart. It is clear that the trend traders are in control. For example, when a bull trend is that strong, price action traders will be buying on high 1 and high 2 pullbacks instead of waiting for a breakout above the prior high of the trend. They are always trying to minimize the risk of the trade. However, once a strong trend is underway, entering with the trend for any reason is a good trade. In a strong trend, every tick is a with-trend entry, so you can simply enter at the market at any point and use a reasonable stop. If there is a breakout with a large trend bar and the bar has not yet closed, you have a decision to make. If you just scalped out of part of your trade and are now thinking about swinging the remainder, always consider how much risk you have. One way to help decide if you should continue to hold your swing position is to ask yourself what you would do at this moment if you were not holding a position. If you would be willing to enter at the market using a swing size position and the swing protective stop, then you should stay in your current swing position. If instead you think that it would be too risky to enter at the market with that amount of risk, then you should exit your swing position at the market. When there is a breakout, both buyers and sellers see it as an opportunity. For example, if the market has a swing high and then pulls back, both bulls and bears will enter as the market moves above that prior swing high. Bulls will be buying the breakout because they see it as a sign of strength, and they believe the market will go high enough above their entry for them to exit with a profit. Bears will also see the breakout as an opportunity to make money. For example, bears might sell on a limit order at the level of that prior high or maybe a few ticks above it. If the market reverses and comes down, they will look to exit with a profit. If, however, the market continues up, they will look to add to their short position if they think the market might pull back to test the breakout. Since most pullbacks come all the way back to the prior swing high, they can exit on that breakout test at about break-even on their first entry and with a profit on their second, higher entry. When traders think of breakouts, they usually immediately have the image of a trading range. However, the breakout can be of anything. One common breakout that many traders overlook is a flag breaking out in the unexpected direction, like a bear flag breaking out of the top or a bull flag breaking out of a bottom. For example, if there is a reasonably strong bear trend and traders are not sure if a tradable low is in, and they see a bear flag forming, they might start buying below the low of the prior bars, expecting a low 1 and then a low 2 or even a low 3 to fail. Sometimes the bear flag will have a good shape and trigger the low 2 short or the wedge bear flag short, and then immediately reverse up into 1 or 2 bull trend bars. This breakout usually creates a measuring gap that leads to a measured move up. Traders will enter on the breakout and on any small pullback, and since bears were trapped, they will likely not be eager to short again until the market has had at least 2 legs up. The opposite is true of bull flags in bull trends. There is a special type of breakout that sometimes occurs on trend days in the final hour. For example, if the market is trending down with no sign of a pullback, there can be 1 or 2 large bear trend bars that break out of the bottom of the bear channel. There may be a small pullback, and then a second brief breakout to a new low. At other times, the market just moves down into the close relentlessly, without large bear trend bars. What is likely happening in both cases is that risk managers at trading firms are telling their traders who have been bottom picking that they are on the wrong side of the market, and that they have to sell out of their positions at the market. The plunges usually do not have much follow-through since they are mostly due to forced selling. There are likely some smart programmers who anticipate this and try to capitalize on it by designing programs to go short briefly, increasing the size of the sell climax. Momentum programs are also part of the strong trend. There may or may not be a bounce into the close after the 1 or 2 sell climaxes. The opposite is true on days that end with strong bull spikes or channels. The risk managers are telling their traders to buy back their losing shorts before the close, and as the market is rising quickly, momentum programs detect this and also buy relentlessly as long as the momentum continues. One of the goals of traders is to do what the institutions are doing. Many breakouts are made of large trend bars that have the biggest volume of the day. These are times when the institutions are trading most heavily, and they are doing so because they expect the move to have protracted follow-through. As scary and emotional as the market can feel during a big breakout, the institutions see it as a great opportunity, as indicated by the volume, and so should you. Try to learn to trade breakouts because they have an excellent trader's equation. If you have to, simply trade only a quarter-size position. I don't care size, just to get experience. The move will often be large enough that you can make as much as you do on a routine trade using your full position size. Breakouts of some type occur every few bars on every chart, as shown in Figure 2.1 in the daily chart of the Euro-US dollar forks. Strictly speaking, if the high of a bar is above the high of any prior bar or the low of the bar is below the low of any prior bar, it is a breakout of that bar. Also, every trend bar is a breakout, remember from Book 1. Every trend bar is a spike, breakout, gap, and climax. Many different types of breakouts and failures are highlighted on this chart. Bar 1 broke above a trend channel line and was followed by a breakout below its low on the next bar, setting up a 2-bar reversal, which was triggered on the Bar 3 entry bar. Bar 2 was a second attempt to break out above the bull channel, and it broke out above another 2-bar reversal, but the breakouts failed, and the market reversed down. Bar 4 was a breakout below a swing low, and it was the 6th bar is a sell climax down from Bar 2. Since the range of the bar was large and it had small tails, it might represent a sell climax that needed a correction before there was follow-through selling. This turned out to be the case because Bar 5 was a strong bull reversal bar that turned Bar 4 into a failed breakout. There was a 2-legged pullback to the moving average, and Bar 8 broke out of the bear flag. Bar 9 broke above the bear trend line. Bar 10 broke above a swing high, but the breakout failed when the next bar traded below its low. Bar 12 fell below the Bar 9 entry bar and below the signal bar just before it. Bar 13 tried to reverse back up and create a failed breakout, but that failed breakout failed on the Bar 14 reversal back down. Bar 14 was also a reversal down from the failed breakout above a micro trend line and above a bull reversal bar. When a failed breakout fails to reverse the market, it becomes a breakout pullback. The Bar 16 break above the bear trend line failed, and the bar reversed down into an outside-down reversal, falling below the bear flag trend line of the prior 3 bars. Bars 16 to 18 created a 4-bar breakout composed of strong bear trend bars with large bodies, small tails, and very little overlap. The bulls who scaled into longs within the trading range finally capitulated and not only stopped buying, but had to sell out of their large, long positions quickly without waiting for a pullback. They were not confident that a pullback would come soon and were confident that the market would be lower within a few bars. This means that getting out at the market or on a tiny pullback within the bar was their best option. Their long liquidation and their lack of buying for several bars contributed to the strength of the sell-off. When a breakout is that strong, it usually is followed by a channel and often leads to a measured move from the open of the first bar to the close of the final bar in the spike. The Bar 36 low was just below that measured move projection, and that ended the channel. The market then usually works its way back up to test the first reasonable buy signal after the spike, which was the high of the Bar 19 bull inside bar. If it gets there, it next tries to test the start of the bear channel, which was the Bar 20 high. Bar 20 was an attempt to make the 4-bar breakout fail, but when a breakout is that strong, there is usually follow-through, and the failure will typically fail and just become a breakout pullback, as it did here. The market reversed back down just shy of the Bar 15 breakout point and the moving average. Whenever a market turns back down without touching a resistance level, the bears are very strong because they are not waiting for the resistance to be touched. The bears are afraid that the bulls might not be able to get the market up there, so the bears have limit orders just below. This is a sign of urgency by the bears. That gap between the breakout point, the Bar 15 low, and the breakout pullback, the Bar 20 high, usually becomes a measuring gap and often is the approximate midpoint of the move. The start of the bear trend was the Bar 2 high, and the market ultimately fell below the gap by more than the number of points between the Bar 2 high and the middle of the measuring gap. The breakout and the strong reversal down on the breakout test established the bear trend as very strong, and traders should only look for shorts for the rest of the day. There might be a long scalp or two, but a trader should take them only if the trader is able to immediately reverse back to short as soon as a bar falls below the low of the prior bar, indicating that the small pullback might be ending. Incidentally, Elliot wave traders see the pullback as the top of wave 4 and the breakout point as the bottom of wave 1. The two cannot overlap if the downward wave 3 in between is in fact wave 3, which is usually the strongest wave of the trend. Bar 22 was a large range bear bar that broke below the bottom of a 4-bar channel. It was arguably the third consecutive sell climax. The first was Bar 14, and the second was the 4-bar spike down to Bar 18. The market usually has at least a 10-bar, 2-legged correction after 2 or 3 consecutive climaxes. Here, however, that 4-bar bear spike was the overwhelming feature of the day and was the beginning of a strong breakout. Yes, it was a spike and therefore a sell climax, but it was so large that the character of the market changed and any counting has to start all over. Once it formed, traders decided that there was going to be a strong move down, and a channel is the most common pattern that follows a strong spike. Channels often have 3 pushes before they correct, and this one did as well. The 3 pushes were bars 18, 25, and 36, and they were followed by a weak rally into the close. Bar 23 was a reversal attempt after the bar 22 sell climax and overshoot through the bottom of the 3-bar bear channel. However, it is a mistake to be looking for a long based on these few bars when the big picture is so bearish. The market is always trying to reverse trends, and it is easy to get caught up in the emotion of a bottoming pattern as it happens in real time, but you should never lose sight of the big picture. That 4-bar bear spike was very strong, and the always in position is still short. Any attempt at a bottom at this point will almost certainly result in a bear flag, as it did here. The market always has inertia, and when it is trending, expect all reversal attempts to fail. Bar 25 was a second attempt to reverse up after the breakout below the bars 20 to 21 channel. Since the signal bars for both attempts had strong bull bodies, the market might test the moving average. Most traders should not take this trade and instead should stay short. Too often, traders will scalp the countertrend trade for a point and then do not reverse back to short, and they miss out on making 4 or more points on the with trend trade. It can be difficult to change your mind set quickly back to short if you just went long, and if you cannot do this easily, do not take the countertrend scalp and then miss the swing down. Bar 26 broke out of the top of the channel, as expected. Bar 27 broke above the bear trend line, and above the bar 18 breakout, bar 28 was a breakout of a 3-bar bear flag. Bar 29 broke below the bar 26 long entry bar, but it found buyers, as seen by the large tail. Bar 32 was another test of a bear trend line, and therefore an attempted breakout, but it failed. Bar 35 was another large bear trend bar, and therefore another possible sell climax. When the market begins to form second and third sell climaxes within a short time, it is likely to reverse for at least a 2-legged correction. Bar 36 broke below the measured move, but did not find sellers. Instead, it found quiet trading, which might be signaling a failed breakout of the bars 22 to 34 bear flag. A horizontal bear flag after a long bear trend often becomes a final flag and is typically followed by at least 2 legs sideways to up. Bar 36 was also the 3rd push down in the bear channel, and that usually leads to at least a reversal attempt. The bar after bar 36 broke above the bar 36 high and became the entry bar for the long. Bar 37 was a bull breakout bar above the bear trend line. Bar 38 broke above the strong bar 35 bear trend bar, and there were certainly many buy stops for shorts above this bar because its large bear body represented strong selling. Once the market got above its high, lots of bears decided that there was no longer enough strength to stay short, and they bought back their shorts, short covering into the close. Flags can sometimes break out in the unexpected direction and lead to measured moves. In Figure 2.2, there was a failed wedge bear flag that broke to the upside on bar 9. The measuring gap between the high of the bar 7 breakout point and the bar 10 breakout test led to an almost perfect measured move up. Bar 3 was a low 1 short setup, but after 3 strong bull bodies and the bar 2 sell climax, it was likely to fail. Aggressive traders would have gone long on limit buy orders at and below the bar 3 low. Bar 5 was an entry bar for a low 2 short, but after the strong bar 4 outside up bar, the market might have been making a low of the day. Again, aggressive traders would have gone long at or below the low of the low 2 signal bar. Bar 7 was a signal bar for a wedge bear flag short, but the market was in a bull channel, and the bar 4 outside up bar made the always in trade long. Rather than short below bar 7, bears should have waited to see if the market formed a lower high. Bulls went long above bar 8, expecting a measured move up from the failed wedge bear flag. There was then a failed low 2 bear flag by setup above bar 22, and the entry bar was a bull trend bar. This breakout also led to a measured move up. Bar 21 was the bottom of a bear channel on a bull day, and bar 22 was the breakout pullback from that channel breakout. So alert traders thought that the low 2 had an excellent chance of failing and leading to a test of the high of the day. The low of bar 26 reversed the lows of the past 12 bars. It was below those lows and the closes of the past 13 bars. Its close reversed these same lows, which is significant because a close below a low is more of a sign of strength than simply a low that is below a prior low. The more lows and closes that are reversed, the stronger the reversal. Every trader who bought during those prior 12 bars is now holding a loser and will look for any small bounce to sell out of his longs. Many sold on the next bar and created the tail on the top of the bar. Also, those bulls will not likely look to buy again for at least a few bars. As shown in Figure 2.3, although big breakout bars like bars 3 and 19 often lead to big trends, sometimes a small breakout bar like bar 12 can be the start of a protracted move. After the bar 9 bear spike, traders wondered if the rally to bar 11 might become a low 2 bear flag at the moving average. Bars 10 and 11 were 2 pushes up. However, instead of breaking to the downside, the market broke above the bar 10 and bar 11 double top. This made the rally a final flag, since it was the final flag of the bear trend, even though it never broke to the downside. The bar 12 breakout bar was small, but it was enough to make traders begin to discard the notion that the move to bar 11 was a bear flag, and they began to wonder if bar 9 was an exhaustive sell climax, which could correct for 10 or more bars. The bar after bar 12 was also small, but it had 2 signs of strength: a bull body and a low that did not fall below the bar 11 high, the breakout point. Although the rally to bar 14 did not cover many points, it was a relentless bull trend and became the first of 2 legs up. The second began with the bar 18 double bottom with bar 15, and the triangle formed by the lows of bars 13, 15, and 18. Chapter 3. Initial breakout. On 5-minute charts of most markets, there are usually at least a couple of successful, significant breakouts every day. Most breakouts begin with a single trend bar that is usually larger than the previous bars and has no tails or only small tails. In the strongest breakouts, there will be a series of trend bars with very little overlap. For example, in a strong bull breakout on the 5-minute E-mini chart, as soon as the breakout bar closes, some traders will place limit orders to buy at the closing price of that bar. If the next bar opens at that price and immediately trades up without going below that price, the limit orders will likely not get filled, and these bullish traders will be trapped out of the market. They will experience a sense of urgency because they are afraid of missing the move and will look to get long as soon as possible, using either a market order or a limit order to buy any 1 or 2 tick or small pullback, or they will switch to a smaller time frame chart like a 1 or 2 minute and then enter on a high 1 or high 2 pullback. This is often hard to do emotionally, and it is comparable to jumping off a high diving board. What might work in both situations is to just do it. Pinch your nose, close your eyes tightly, tense up every muscle in your body, and trust that you won't get hurt too badly and that the bad feelings will end quickly. If you are trading the E-mini, you simply buy the small pullback and rely on your stop. If the breakout is good, your stop will not be hit, and you will have a good chance of making 2 to even 6 or more points over the next many bars while risking about 2 points. If, instead of having several strong bull trend bars in a row, the bar after a 1 or 2 bar breakout is a small bar, a doji, an inside bar, a bar with large tails, or a bear trend bar, the breakout might fail. This could lead to a reversal back into the trading range, a trend reversal into a bear trend, or a failed reversal, which is simply a 1 or 2 bar pullback that is followed by resumption of the upward move. When the breakout is successful, it will create some version of a spike and channel trend. A breakout entry appears deceptively easy to take when you see it on the chart at the end of the day. However, in real time, the setups tend to be either unclear or clear, but scary. Entering on the breakout, or after the breakout bar closes, is difficult to do because the breakout spike is often large, and traders have to quickly decide to risk much more than they usually do. As a result, they often end up choosing to wait for a pullback. Even if they reduce their position size so that the dollar risk is the same as with any other trade, the thought of risking 2 or 3 times as many ticks frightens them. Entering on a pullback is difficult because every pullback begins with a minor reversal, and traders are afraid that the pullback might be the start of a deep correction. If the reversal is just for a bar to 2 and sets up a breakout pullback entry, they are afraid to enter because they are concerned that the market might be entering a trading range and they do not want to buy at the top if the market is having a bull breakout, or sell at the bottom if there is a bear breakout. Trends do everything that they can to keep traders out, which is the only way they can keep traders chasing the market all day. When a setup is easy and clear, the move is usually a small, fast scalp. If the move is going to go a long way, it has to be unclear and difficult to take, to keep traders on the sidelines and force them to chase the trend. You will regularly hear pundits discuss a 1 or 2 day sell-off in a stock that resulted from a bad report, like a disappointing earnings report or a change in management. They are deciding if the news is just a 1 day event in an otherwise strong bull trend, or if it will change the outlook for the stock for the next several months. If they conclude that the odds favor the bull trend, they will buy around the bottom of the bear spike. If they think that the news was so severe that the stock will remain under pressure for months, they will not buy, and in fact will look to sell out of their longs on the next rally. Technical traders see the sell-off as a bear breakout and evaluate the stock in terms of the strength of the breakout. If the spike looks strong, they will short rallies, and maybe even the close of the bar, expecting a bigger spike, a spike and channel, or some other type of bear trend. If it looks weak relative to the bull trend, they will buy around the close and low of the bear trend bar, expecting a failed breakout and for the trend reversal attempt to become just another bull flag. The strongest breakouts have a sense of urgency and have several trend bars in a row, as happened in the trend from the open bull trend day in RSX, the Market Vectors Exchange Traded Fund ETF for Russia shown in Figure 3.1. The market broke above the trading range that formed in the final hour of yesterday. Notice how the lows of several of the bars in the breakout did not drop below the close of the prior bar. This means that bulls who waited for the bar to close and then immediately placed limit orders to buy at the level of that close would likely not have their orders filled, and they would be trapped out of the market. The market was running away from them, and they knew it and would then take any reason to get long. This urgency caused the market to rise sharply. This series of bars should be considered to be a bull spike. A bull spike is usually followed by a bull channel, and together they constitute a spike and channel bull trend. Bar 6 was an inside bar and the first pause, and this is usually a reliable high 1 long entry in a trend from the open bull trend day. However, when the trend is this strong, you can just buy at the market or buy for any reason at all. Did it rain somewhere in the Amazon last year? Then buy. Did someone on your kid's high school basketball team score a point last year? Then buy more. You need to get long and stay long because there is probably better than a 70% chance that the market will make a measured move up equal to or greater than the approximate height of the spike, the low or open of bar 1 to the close or high of bar 4 or 8, and add this many points to the closes of those bars. The exact probability is never knowable, but from experience, this is a very strong breakout, and the probability of the measured move is likely greater than 70% here. The measured move up from the open of bar 1 to the close of bar 4 was the price level where the market paused at the top of bar 8. The measured move based on the open of bar 1 to the close of bar 8 was exceeded by 3 cents on the close of the day, not shown. Breakouts are common on the 5-minute E-mini chart, but strong, successful ones that have several bars of follow-through, like at bar 1 and bar 11 in Figure 3.2, usually happen only 1 to 3 times a day. Bar 1 broke above the top of a small wedge, and it had a small tail at the top and bottom and was a large bull trend bar. Bar 2 was a small bear inside bar and is a signal bar both for a failed breakout short and a breakout pullback long. Remember that an inside bar is a 1-bar trading range and a setup for a breakout in either direction. Breakouts often lead to measured moves, and one common pattern is a measured move from the open or low of the spike to the close or high of the spike, and then projected up from the close or high of the spike. Here, the move to the bar 3 high of the day was a measured move from the open to the close of the bar 1 breakout bar. The opening range often leads to a breakout to a measured move, but there are usually several possibilities for the measurement points, and it is best to watch the nearest target first. Traders should look at the low of bar 4 to the high of bar 5. Once that measured move was exceeded, traders should look at other possibilities. A failed wedge often leads to a measured move, but traders need to consider every option that they can see. For example, they might look at the low of bar 7 to the high of the wedge 2 bars after bar 9. However, the wedge began at bar 4, and the bar 7 lower low might be viewed as an overshoot of the actual bar 4 low. The market tried to form a wedge bear flag beginning at the bar 4 low, and it had 3 pushes up, bar 5, and the spikes before and after bar 9. Using the bar 4 low to the top of the wedge for the measurement projected a move that was exceeded by only 1 tick at the bar 14 high of the day. The purpose of finding these measured move targets is to find reasonable areas to take profits, and, if there is a strong countertrend setup, to initiate trades in the opposite direction. Bar 6 was a strong breakout to a new low of the day, but it was reversed up by the bar 7 outside up bull trend bar. When traders saw the sideways action to bar 8, they were thinking that this was a possible breakout pullback, a bear flag, and it could be followed by another move down. You must always consider both bull and bear alternatives. Instead of more selling, the market moved up quickly. How can such a strong bear trend bar be reversed up so quickly? If the institutions had a huge number of buy orders, they would like to fill them at the best prices. And if they thought that the market was likely to test below the bar 4 low before going up, they would wait to buy until after that test. As the market is getting close to their buy zone, it does not make sense for them to buy because they believe the market will be a little lower over the next several minutes. So these very eager bulls are stepping aside. The absence of the strongest buyers creates an imbalance to the sell side, so the market has to fall quickly for the shorts to find someone willing to take the other side of their trade. The result is a large bear trend bar. Once the market is at a level where the bulls think it will not fall further, they appear out of nowhere and begin to buy heavily and relentlessly, overwhelming the bears. The bears realize what is going on, and they stop shorting and begin to buy back their shorts. This means that both the bulls and the bears believe that the market will go up, and this creates a directional probability of an equidistant move of 60% or more in favor of the bulls. In other words, there is a 60% or more chance that the market will go up 2 points before falling 2 points and up 3 points before falling 3 points. In fact, there is probably better than a 60% chance that the market will break out above the opening range and have a measured move up before there is a 2-point pullback, and this is a great trade for the bulls. Bars 9 and 10 were breakout pullbacks after new highs of the day. Bar 11 was a breakout of the wedge that began with the bar 5 high. It was a strong 2-bar bull spike, and it was followed by 2 more pushes up. Bull channels after spikes often have 3 pushes up, where the top of the spike is the first push up. Bar 12 was a 2-legged high 2 breakout pullback in a strong bull trend and is a great buy setup. Bar 13 was another breakout pullback, but since it would lead to a 3rd push up, bulls had to be cautious. Once bar 14 hit 5 ticks above the long entry, many bulls moved their stops to break-even because they were wondering if the bar 14 wedge high would lead to a lengthy 10 bars or more, 2-legged pullback, or even a trend reversal. Therefore, bar 15 was a bad signal for longs, who expected that any rally would end below the bar 14 wedge high and be followed by at least 1 more leg down. Aggressive traders shorted above its high, because a buy signal that is likely to fail means that traders could go short where inexperienced traders just went long, and they would have about a 60% chance of the market falling 2 points to the protective stop of the weak longs before the market hit their profit-taking limit order 6 ticks higher. They are risking 6 ticks to make 8 ticks and are 60% confident that they will win, and this is a logical bet. Bar 16 was a bear breakout below a head and shoulders top, but since most topping patterns are really just bull flags, there was a good chance that the breakout would fail. Bulls could have bought above the small doji inside bar that followed, but this would be somewhat risky because doji bars are not reliable signal bars. Once they saw the bar 17 bull trend bar, buying the wedge bull flag became a more reliable pattern. Buying above a strong bull bar increases the odds for success because the market has already shown some strength. Since strong breakouts usually have several trend bars in a row and not a small doji bar for the next bar, traders saw this as a warning that the bear breakout was weak. As shown in figure 3.3, some news must have been released that led to a sharp sell-off at 10:30 a.m. Pacific Standard Time. You should never pay attention to the news, aside from knowing when it will be released, because it creates a distance between you and what you have to do. It requires thought that you then have to reconcile with the chart, which can only reduce your profit. The chart tells you all that you need to know. Something happened that made the institutions sell aggressively, and that is all the information that a trader needs. It is time to look for short setups. Bar 1 was a strong bull trend bar that trapped early buyers who bought the candle pattern or a smaller time frame reversal. A buy was not even triggered on this 5-minute chart, since the next bar did not go above the bar 1 high. These bulls would exit below the low of bar 1 and wouldn't look to buy again until more price action unfolds. Place an order to short on a stop at 1 tick below the low of bar 1, which is where those longs will have their protective stops, and as they cover, they will provide plenty of downside fuel. If it gets hit, you know the trapped longs will get out and not want to buy again soon, and the smart bears will be adding to their shorts. With no one left to buy, the market will almost certainly provide a scalper's profit, and likely much more. Bar 5 is the third overlapping bar, and at least one of the bars was a doji, all three were. This is barbed wire, which is usually a continuation pattern, and like with any trading range, you should never buy at its high or sell at its low. You can fade small bars at its extremes, and since all horizontal trading ranges are magnets and often become final flags, you can wait for a trend bar breakout to fail and look for a reversal back into the range. Here, bar 7 closed above its midpoint and therefore met the minimum requirement for a reversal bar, and it followed a third consecutive sell climax. This is usually followed by at least a 10-bar, two-legged correction. Bars 3 and 5 were classic candle pattern traps. Traders who memorize candle reversal patterns will be eager to buy these very large candles with long bull tails, because they will see the long tails and the closes near the highs as evidence that the bulls were gaining control. When you see a big bar with a long tail and a small body in a bear trend, it tells you that if you buy above its high, you are paying way too much. In a bear trend, you want to buy low, not at the top of a huge bar with a small body when the market is in a tight bear channel and there has been no prior bull strength or trend line break. Bar 5 was an even better candle pattern trap than bar 3 since it was a gravestone doji, which candle novices worship. Also, the market traded above the high of the bar, seeming to confirm the strength of the bulls, and it was a second attempt at a double bottom with bar 3. But what went wrong? When you see these small-bodied big candles in a strong trend where there has yet to be a trend line break, you should get excited because they are great traps and therefore perfect short setups. Just wait for the small bar that usually follows. Its lack of upside follow-through makes these early bulls very scared. Everyone knows where those bulls are putting their protective stops, so that is exactly where you should be putting your entry stop to go short. When you see those big doji candles, you, too, see bullish strength. But then assume that since the price was hovering at the high of those bars and the bulls were now in balance with the bears, the highs of those bars are likely to be in the middle or top of a trading range and not at a bottom. The two-legged sideways move to bar 6 broke a trend line. Traders then knew that the bulls were getting eager to buy, so a perfect long setup would be a failed breakout to new lows. Smart traders just waited for a 1 or 2 bar break below bars 3 and 5, and then started placing buy orders at 1 tick above the high of the prior bar. They were prepared to keep moving the orders down if they didn't get filled. If the move continued too far down, they would have waited for another trend line break before looking to buy again because the trend would have resumed and this setup would have failed to trigger. The earlier bulls with 2 or 3 losses would wait for confirmation this time and enter late, and this would provide additional fuel for the upward move after the price action longs got in. Even though bar 7 had a bear body, at least it closed above its midpoint, indicating some strength. Presumably, bulls were a little cautious after losing on entries from bars 1, 3, and 5. Also, it was a failed breakout from barbed wire, which often forms the final flag of a trend. The odds were high that this would be a profitable long and smart. Traders would have been anticipating it, so there was no excuse to miss it. The entry bar had a bull body, albeit small, which was constructive. Also, it was an inside body variant. Its body was inside the body of the signal bar, which is a weaker version of an inside bar, which meant that the bears did not take control. At this point, longs were feeling confident because their protective stop was not hit on the bar after entry, as was the case for the earlier bulls. The next 3 bars were all bull trend bars with closes above the prior close, so the closes were in a bull trend. It is reasonable to assume that there will be 2 legs up, but almost certainly there will be a stop rundown before the second leg. The break-even stop was not hit on the violent move down in bar 8, which turned into a bullish outside bar and the start of the second leg up, a higher low. Whenever there is a strong outside up bar that breaks the market into a new trend, its low is the start of the trend, and all bar counting gets reset. For example, the 2-bar reversal at bar 9 was a low 1 setup and not a low 2. The targets for the rally were the bull signal bar highs in the bear, the highs of bars 3 and 5 and possibly bar 2. Bar 9 exceeded the final target by 1 tick. The momentum was so strong that the bar 8 low was likely just part of the first leg up and not the start of the second leg up, and there instead should be a bigger pullback, and then a second leg up. It ended at bar 11. Bar 11 set up a low too short from the rally up from the bar 8 low. Chapter 4. Breakout entries in existing strong trends. When a trend is strong and there is a pullback, every breakout beyond a prior extreme is a valid with trend entry. The breakout usually has strong volume, a large breakout bar, a strong trend bar, and follow through over the next several bars. Smart money is clearly entering on the breakout. However, that is rarely the best way to trade a breakout, and price action traders almost always find an earlier price action entry like a high 1 or 2 in a bull trend. It is important to recognize that when a trend is strong, you can enter at any time and make a profit if you use an adequate stop. Once traders see that a trend is strong, some traders do not take the first entries because they are hoping for a larger pullback, like a two-legged pullback to the moving average. For example, if the market just became clearly always in long and the initial bull spike has 3 good-sized bull trend bars with small tails, a trader might be afraid that the move was a little climactic and decide that he wants to wait for a high 2-buy setup. However, when a trend is very strong like this, the first couple of entries are usually just high 1-buy setups. Aggressive traders will place limit orders to buy below the low of the prior bar, expecting any reversal attempt to fail. Once the market trades below the low of the prior bar, they will expect a high 1-buy setup to lead to at least a new high and probably a measured move up, based on the height of the bull spike. If traders fail to take either of these two early entries, they should train themselves to guarantee that they get into this strong trend. When they are looking at the pullback beginning, they should put a buy stop at 1 tick above the high of the spike, in case the pullback is only 1 bar and reverses up quickly. If they fail to take either of the early pullback entries, and the market begins to race up without them, they will be swept into the trade and not be left behind. On the strongest trades, you will usually see that the bar that breaks above the bull spike is usually a large bull trend bar, and this tells you that many strong bulls believe that there is value buying the new high. If it is a great entry for so many of them, it is a great entry for you as well. One quick way to determine the strength of a trend is to see how it reacts after it breaks beyond prior trend extremes. For example, if a bull trend has a pullback and then breaks above the high of the day, does it find more buyers or sellers on the breakout? If the market moves far enough up for the breakout buyers to make at least a scalper's profit, then the breakout found more buyers than sellers. That is one of the hallmarks of a strong trend. By contrast, if the market raced to a new swing high but then reversed down within a bar or two, then the breakout found more sellers than buyers, which is more characteristic of trading ranges, and the market could be transitioning into a trading range. Watching how the market behaves at a new high gives a clue as to whether there is a still strong trend in effect. If not, even though the trend may still be in effect, it is less strong and longs should be taking profits at the new extreme and even looking to go short, instead of buying the breakout to the new high or looking to buy a small pullback. The opposite is true in bear trends. In general, if you are entering on a stop at a new extreme, you should scalp most or all of your trade unless the trend is especially strong. If so, you can swing most or all of your position. For example, if the market is in a strong bull trend, bulls will buy above the most recent high on a stop, but most will scalp out of their trade. If the market is extremely strong, they might swing most of their position. If not, bears will be shorting on every new swing high with a limit order at the old swing high or slightly above, and they will add on higher. If the market drops after their first entry, they will exit with a profit. If instead the market continued up, they expect the old high to be tested by a pullback within a few bars, and this would allow them to exit their first entry at break-even and to exit their higher entry with a profit. As shown in Figure 4.1, the rally from the bar 4 higher low became a strong bull trend higher low after a trend line break, with 7 bull trend bars in a row as the market reversed through the bar 1 high of the day. With that much momentum, everyone was in agreement that bar 5 would be exceeded before there was a sell-off below the start of the bull trend at bar 4. The market was in always-in mode and would likely have approximately a measured move up based on the bull spike from bar 4 to bar 5 or from the opening range from bar 1 to bar 2. And therefore, bulls could buy at the market, on any pullback, at or below the low of any bar, above the high of any pullback, on the close of any bar, and on a stop above the most recent swing high. Breakout traders would have bought above every prior swing high, such as on bars 5, 6, 8, 11, 13, and 16. By bar 5, the market was clearly strongly always in up. Aggressive bulls placed limit orders to buy at the low of the prior bar, expecting the initial pullback to only be a bar or so long and for the market to reverse up in a high one. Buying below the prior bar is usually a lower entry than buying above the high one. If traders preferred to enter on stops and did not buy at the low of the bar after bar 5, they would have bought on the bar 6 high 1 entry as it moved above the prior bar. If they instead were hoping for a deeper pullback like a high 2 at the moving average and did not take either of these 2 entries, they needed to protect themselves from missing the strong trend. They should never let themselves get trapped out of a great trend. The way to do this would be by placing a worst-case buy stop at 1 tick above the high of the bar 5 bull spike. The entry would be worse, but at least they would get into a trade that was likely to continue for at least a measured move up based on the height of the bull spike. Bar 6 was a large bull trend bar with no tails, which indicated that many strong bulls bought on that same bar. Once traders saw that the strong bulls bought the breakout to the new high, they should have been reassured that the trade was good. Their initial protective stop was below the most recent minor swing low, which was the high 1 signal bar before bar 6. Pullback traders would have entered earlier in every instance, on the breakout pullbacks, which were bull flags. For example, at the bar 6 high 1, the bar 8 high 2, the bar 10 failed wedge reversal, the bar 12 high 2 and failed trendline break not shown, and the bar 15 high 2 test below the moving average, first moving average gap bar buy setup, and double bottom with bar 12. The high 2 was based on the 2 clear, larger legs down from bar 14. Breakout traders are initiating their longs in the exact area where price action traders are selling their longs for a profit. In general, it is not wise to be buying where a lot of smart traders are selling. However, when the market is strong, you can buy anywhere, including above the high, and still make a profit. However, the risk/reward ratio is much better when you buy pullbacks than it is when you buy breakouts. Blindly buying breakouts is foolish, and smart money would not have bought the bar 11 breakout because it was a possible third push-up after the exceptionally strong bar 6 breakout bar reset the count and formed the first push-up. Also, they would not have bought the bar 16 breakout, which was a higher high test of the old bar 14 high after a trend line break, since there was too much risk of a trend reversal. It is far better to fade breakouts when they fail or enter in the direction of the breakout after it pulls back. When traders think that a breakout looks too weak to buy, they will often instead short at and above the prior high. Bears can make money on breakouts above prior swing highs by shorting the breakout and adding on higher. Then, when the market comes back to test the breakout, they can exit their entire short position and make a profit on their second entry and get out around break-even on their first short. This strategy would have been possible if a bear shorted as the market moved above bars 5, 7, 9, and 14. For example, as the market pulled back from the bar 7 swing high, bears could place orders to go short at or slightly above that high. Their shorts would be filled during bar 8. They would then add to their short positions when they thought that the market might begin to pull back again or at a couple of points higher. They would then try to exit all their short trades on a limit order at the original entry price, at the bar 7 high. Because bears are buying back their shorts on that breakout test, and because bulls are adding to their longs in that same area, the pullback often ends at that price and the market once again goes up. The reversal up at bar 4 was a breakout of the final flag of the bear trend. Sometimes final flag reversals come from higher lows and not lower lows. The test of the old extreme can exceed the old extreme or fall short. Bar 15 was the end of the final flag in the bull trend, and the reversal at bar 16 was from a new extreme, a higher high. As shown in figure 4.2, yesterday, only the final hour is visible was a strong trend from the open bull trend day. So the odds were high that there would be enough follow-through today to close above the open. And even if there was a pullback on the open today, the bull trend would likely reach at least a nominal new high. Traders were all watching for a buy setup. Bar 2 was a small higher low after a high 4 buy setup and a double bottom with the final pullback of yesterday. The signal bar had a bear close, but at least its close was above its midpoint. Traders who missed that entry saw the market form a strong bull spike over the next 2 and 3 bars and decided that the market was now always in long. Smart traders bought at least a small position at the market, just in case there was no pullback, until after the market went much higher. There were 2 large bull trend bars on the breakout, each with strong closes and small tails. Had you gone long at the close of bar 3, you would be swinging a portion of your trade at this point. This means that if you were instead flat, you could buy that same position size at the market and use the stop that you would have used had you bought earlier. That stop would now be below the bar 3 strong bull trend bar. Bar 4 was a pause bar just below yesterday's high, and buying 1 tick above its high is another good entry. A pause bar is a possible reversal setup, so buying above its high will be going long where the early bears are buying back their shorts, and where the longs who exited early would also be buying back their longs. At this point, the trend was clear and strong, and you should be buying every pullback. Bar 6 was followed by a 2-bar reversal and a third push-up, and was an acceptable short setup for a pullback to the moving average. Bar 8 was a reasonable countertrend scalp, a failed breakout to a new high after a trendline break, since it was a strong bear reversal bar and an expanding triangle top, but the trend was still up. Note that there had not yet been a close below the moving average, and the market had been above the moving average for more than 20 bars, both of which are signs of strength. If you were thinking about taking a countertrend scalp, you would do so only if you would immediately look to get long again as the trend reversed back up. You do not want to exit a long, take a short scalp, and then miss out on a swing up as the trend resumes. If you cannot process the 2 changes of direction reliably, do not take the countertrend trade, simply hold long. Bar 9 was a bull inside bar after the first close below the moving average and the second bar of a 2-bar reversal, so a breakout above the setup was expected to test the bull high at a minimum. Chapter 5. Failed breakouts, breakout pullbacks, and breakout tests. The sequence of breakout, failed breakout, either trend reversal or breakout pullback, and then trend resumption is one of the most common aspects of price action, and most trades every day can be interpreted as some variation of this process. On a larger scale, it is the basis for a major trend reversal, which is discussed in Book 3, where there is a trend line break and then a breakout pullback that tests the trend's extreme. The sequence occurs with all breakouts, but most often with a breakout of a bull or bear flag, which is a small trend in the opposite direction of the main trend on the screen. Whenever there is a breakout, the market eventually pulls back and tests previous significant prices. The start of the pullback converts the breakout into a failure, and you should look at all breakouts as failing at this point, even if they subsequently resume. If the failure succeeds in reversing the trend, the breakout will have failed and the reversal will have succeeded. If the reversal only goes for a bar or 2 and the breakout resumes, the reversal attempt will simply become a pullback from the breakout. All failed breakouts that fail to reverse the market are breakout pullback setups for trades in the direction of the breakout. For example, if there is a bull breakout and then the market pulls back to around the entry price, forms a buy signal bar and triggers the long, this pullback tested the breakout, it is a breakout test, and set up a long above the high of the most recent pullback bar. If the trend resumes, the breakout bar usually becomes a measuring gap, and if the trend reverses, the bull trend bar becomes an exhaustion gap, and the bear trend bar becomes a breakout gap. Gaps are discussed in Chapter 6. Tests can be on the bar after the breakout or 20 or more bars later. What exactly got tested? The test is whether the breakout will succeed or fail. The market pulls back from the breakout because of selling. The bulls are selling to take partial profits on their longs, and the bears are selling in an attempt to make the breakout fail and flip the direction of the always in trade to down. Both the bulls and the bears assess the strength of the breakout. If the setup and the entry bar are strong, traders will expect higher prices. When the market pulls back to the area of the breakout, bulls who are already long, whether or not they scalped out of some of their position on the breakout, will use the pullback as an opportunity to buy again. Bulls who missed the original entry will also use this pullback to get long. Bears who shorted prior to the breakout, below the entry price, will believe that the market has flipped to always in long and it will trend higher. They will therefore use the pullback to buy back their shorts with a small loss. The bears who shorted the breakout will see that the breakout was strong and that the attempt to make the breakout fail was weak, and they will buy back their shorts with either a small profit or loss, or at break-even. Since the bears now believe the breakout will be successful and that the market will rally, they will not want to short again until the market is higher, and only if a sell signal develops. If the setup or the breakout was weak, and if a strong bear reversal bar developed shortly after the breakout, traders will expect the breakout to fail and for the bear trend to begin or resume. The bulls will sell out of their longs and not look to buy again for at least several bars, and the bears will initiate new shorts or add to their current shorts. The result will be that the market will fall below the bull breakout entry price. The test of that level will have failed, and the bear trend will have at least one more leg sideways to down. If the breakout and the reversal are about equally strong, traders will then look at the bar after the bear reversal signal bar. If it has a strong bear close and is a strong bear trend bar, the chances that the reversal will continue down increase. If instead it is a strong bull reversal bar, chances are the failed breakout will not succeed, and this bull reversal bar then becomes a signal bar for a breakout pullback buy at one tick above its high. Remember, the single most important determination that a trader makes, and he makes this after the close of every bar, is whether there will be more buyers or sellers above and below the prior bar. This is particularly true with breakouts and failed breakouts, because the move that follows usually determines the always-in direction and therefore lasts for many bars, and is not just a scalp. This same process is repeated many times every day on all time frames. The breakout might simply be a quiet push above the high of the prior bar, and the pullback can begin on the next bar. When that is the case, the breakout might be a 10-bar breakout on a smaller time frame chart. The breakout can also be huge, like a 10-bar bull spike, and the pullback can occur 20 or more bars later. When the process involves many bars, it is a small breakout on a higher time frame chart, with the breakout and pullback on that chart simply lasting a few bars. Following a bull breakout, these are some of the common areas that often get by the pullback. The breakout point, the price where the breakout began. The top of a spike in a spike and channel bull trend. Once the market breaks below the channel, it usually tests down to the top of the spike and eventually to the bottom of the channel. The top of the spike in a final flag breakout. Once the market begins to pull back after breaking out of a potential final flag, it usually tests the swing high that preceded the flag. The most recent swing high in a stairs pattern. Bull stairs usually have pullbacks that fall at least a little below the most recent swing high. The top of the lower trading range in a bull trending trading range day. If it does not reverse back up, it can retrace to the bottom of that lower trading range. After the market rallies to the third push-up in a potential wedge, a rising convergent channel, the odds are very high that it will test the top of the second push-up. Once it reverses, it usually tests to the bottom of the wedge, the bottom of the first pullback, which is the bottom of the wedge channel, the high of the signal bar. Even if the breakout bar breaks out above a swing high from 10 bars earlier, there will often be a test of the high of the bar just before the breakout bar, the low of the entry bar. If the market falls below the entry bar, it often does so in a strong bear trend bar, and the move down from there is usually big enough for at least a scalp. The bottom of the swing low at the start of the leg up. The market sometimes falls below the entry bar and signal bar and retraces to the bottom of the bull leg, where it often will form a double bottom bull flag. Any support area like the moving average, a prior swing low, a trend line, or a trend channel line, like if the market forms a wedge bull flag. Whenever there is a breakout, traders have to decide whether it will be followed by a trend or it will fail and reverse. Since there are many breakouts on every chart, it is important to become proficient at this. The breakout may continue for several bars, but at some point there will be a pullback. The countertrend traders will see the pullback as a sign that the breakout has failed, and they will enter on the assumption that the market will reverse, at least enough for a scalp. The with trend traders will be taking some profits, but they expect that the failed breakout won't go far before it sets up a breakout pullback, and then the trend will resume. For example, if there is a bull breakout, the first bar with a low below the low of the prior bar is a pullback. However, traders need to decide if instead it is a failed breakout and about to lead to a reversal back down. The more that the breakout has characteristics of a strong trend, the more likely it will have follow through. If it has few or none of those characteristics, the odds of it failing and reversing back down increase. Characteristics of strong trends are detailed in the first book, Trading Price Action Trends, but important features of a strong bull trend are several consecutive bull trend bars with very little overlap of the bodies, small tails and bull strength earlier in the day. If, however, the second bar is a relatively strong bear reversal or a bear inside bar, the breakout bar is not too large, the breakout is the third push-up, and that bar reverses back below the trend channel line, the odds of a failed breakout and a tradable short are better. If you short below the low of that bar and the next bar is a strong bull reversal bar, you usually should reverse back to long because that failed breakout might be failing and instead setting up a breakout pullback by setup. After a breakout, eventually there will be a pullback to test the strength of the traders who initiated the breakout, and the success of the test will be determined by whether the traders enter in this area for a second time. The strongest breakouts usually do not come all the way back to the breakout point, but some pullbacks can retrace well beyond the breakout point and still be followed by a strong trend. For example, in a bull stare pattern, each breakout to a new swing high is followed by a deep breakout pullback. That breakout pullback stays above the prior higher low, creating a bull trend of higher highs and lows, and then is followed by another higher high. If the breakout pullback comes back to within a few ticks of the entry price, it is a breakout test. The test can occur on the bar after the breakout or even 20 or more bars later or both. This test bar is a potential signal bar, and smart traders look to place a buy-stop entry order at one tick above it in case the test is successful and the trend resumes. It is a particularly reliable breakout pullback setup. In an upside breakout, there was probably heavy buying in the area of the breakout price, and the buyers overwhelmed the sellers. On the breakout pullback, the market is coming back down to that price area to see if the buyers will once again overwhelm the sellers. If they do, the result will likely be at least 2 legs up, with the breakout being the first leg up. If, however, the sellers overpower the buyers, then the breakout failed and there will likely be a tradable move down since the remaining longs will be trapped and new longs will be hesitant to buy again after the failure. The buyers will have made 2 attempts to go up from this price area and failed, so the market will now likely do the opposite and have at least 2 legs down. If there is a pullback within a bar or 2 of the breakout has failed. However, even the strongest breakouts will have a 1 or 2 bar failure that in fact becomes just a breakout pullback instead of a reversal. Once the trend resumes, the failed breakout will have failed, which is the case in all breakout pullbacks. A breakout pullback is simply a failed attempt to reverse the breakout. Consecutive failures are second entries and therefore have an excellent chance of setting up a profitable trade. A breakout pullback is also referred to as a cup and handle, and it is one of the most reliable with trend setups. Breakout pullbacks can happen in the absence of an actual breakout. If the market strongly runs close to the old extreme but does not exceed it, and then quietly pulls back for 1 to 4 bars or so, this will likely function exactly like a breakout pullback, and it should be traded as if the pullback followed an actual breakout. Remember that when something is close to a textbook pattern, it will usually behave like a textbook pattern. If there was a strong move or a first leg of a trend earlier in the day, then a with-trend breakout later in the day is more likely to be successful. A failure will likely not succeed in reversing the trend, and it will become a breakout pullback. However, if most of the day has been trendless with 1 or 2 bar breakouts in both directions, the odds of a failure leading to a reversal are increased. After an initial run, many traders will take partial profits and then place a break-even stop on the balance. The break-even stop is not necessarily exactly at the entry price on every trade. Depending on the stock, a trader might be willing to risk 10 or even 30 or more cents, and it is still basically considered a break-even stop, even though the trader will be losing money. For example, if Google Goog is trading at $750 and a trader just took partial profits on half and wants to protect the rest. But Goog has recently been running break-even stops by 10 to 20 cents, but rarely by 30 cents. The trader might place a break-even stop at 30 cents beyond the breakout, even though it would result in at least a 30-cent loss, and not an exactly break-even trade. In the past year or so, Apple and Research in Motion RIM have been very respectful of exact break-even stops, and most breakout pullback tests in fact end about 5 cents shy of the entry price. Goldman Sachs, GS, in contrast, routinely runs the stops before the pullback ends, so traders would have to be willing to risk a little if they are trying to hold on to their positions. Alternatively, they could exit at break-even and then re-enter on a stop at one tick beyond the test bar, but they will invariably be getting back in at 60 or more cents worse than their initial entry. If the price action is still good, it makes more sense to hold through the breakout test and risk maybe 10 cents rather than getting out and then back in at 60 cents worse. Most major trend reversals can be thought of as breakout pullback trades. For example, if the market has been in a bear trend and then there is a rally above the bear trend line, the pullback to a lower low or higher low is a breakout pullback by setup. It is important to realize that the pullback from the breakout can exceed the old extreme, so in a bull reversal, after the breakout to the upside, the pullback can fall below the bear low, and the bull reversal can still be valid and controlling the price action. Sometimes the final pullback of a trend can also function as the first leg of a new trend in the opposite direction. For example, if there is a bear trend, followed by a slow rally that may last 10 to 20 bars or more, and then a sell climax and a reversal up into a bull trend, the channel that contained the final bear flag, if projected up and to the right, will sometimes also approximately contain the new bull trend. That final bear flag can in fact in hindsight be viewed as actually the first move up in the new bull trend. The plunge down can be thought of as a lower low pullback in the new bull trend. If you recognize this pattern, you should look to swing more of your position and not be too quick to exit. Once the new bull trend surpasses the bear flag high, it will hit the protective stops of the shorts who saw the bear flag as a weak attempt to rally, and therefore likely not the final lower high of the bear trend. After the market reverses above that high, the bears will not look for new shorting opportunities for a while. This often leads to little or no pullback after the bear flag is surpassed, and the move up can be protracted. This same phenomenon is common as a wedge flag is forming. For example, a wedge bear flag has 3 pushes up. It will often have a breakout down to a lower low after the first push up. It will then have 2 more pushes up after that low to complete the wedge bear flag. Once the bear flag is complete, the market then usually will break out of the downside of the wedge bear flag and form a new trend low. Breakouts often fail, and the failure can happen at any point, even after just the first bar. A 1-bar breakout of a tight trading range is as likely to fail and reverse back into the range as it is to continue into a trend. Sharp breakouts on the open that last for a few bars often fail and lead to a trend day in the opposite direction. This is discussed in Book 3 in the chapter on the first hour of trading. On daily charts, there are often sharp countertrend breakouts due to surprising news events. However, instead of the spike having follow through like a channel and becoming a successful breakout, the breakout usually fails and the spike becomes just part of a brief pullback. For example, if a stock is in a strong bull trend and it had a surprisingly bad earnings report after the close yesterday, it might fall 5% today, making traders wonder if the trend was in the process of reversing. In most cases, bulls will aggressively buy around the low and close of the bear spike, which is always down to a support area like a trend line. They are correctly betting that the odds are that the bear breakout will fail and the bull trend will resume. They see the sell-off as a brief fire sale, allowing them to buy more at a great discount that will be gone in a few days. Within a week or so, everyone will have forgotten about the terrible news, and the stock will usually be back above the top of the bear spike, en route to a new high. Sometimes a breakout at the end of trend can be an exhaustive climax and lead to a reversal, and at other times it can be a breakout and lead to another channel. All climaxes end with a trading range, which can be as brief as a single bar. During the trading range, the bulls and bears continue to trade, and both try to get follow-through in their direction. In Figure 5.1, in both the sell climax down to bar 5 and the buy climax up to bar 19, the bulls won the struggles. Bars 1, 2, 3, and 5 ended bear spikes, and consecutive sell climaxes often lead to a correction that lasts at least 10 bars and has at least 2 legs. Bar 4 was the largest bear trend bar of the bear trend, and it could therefore represent the last week longs finally giving up and exiting at any price. This was probably the case, and the market corrected up in 2 legs into the close, with the first leg ending at bar 8 and the second leg ending with the last bar of the day. The next day, bars 15, 16, 17, and 19 were buy climaxes. The market successfully broke out of the downside of the bull channel that followed the gap spike up to bar 15 and ended with the 3 pushes up to bar 17. However, whenever a correction is sideways instead of down, the bulls are strong, and they were able to create a breakout above the 3 push top. Although the large bull bar could have been caused by the last bears finally giving up, in this case, it was created by aggressive bulls successfully breaking the market above the wedge top. This bull spike was followed by a channel that tried to end at bar 21 but was able to extend up to bar 25. As shown in Figure 5.2, bar 8 was a potential failed breakout, but the breakout was strong, made up of 3 bear trend bars that covered most of the day's range and had small tails and little overlap. The market pulled back to the moving average and led to a low too short, or a small wedge bear flag signal at bar 10, which was the second bear trend bar and the end of the second leg of the pullback to the moving average. A breakout pullback is one of the most reliable setups. Bar 12 again was a potential failed breakout to a new low of the day. This is a reversal up from a second consecutive sell climax, and reversals from consecutive climaxes usually lead to pullbacks that have at least 10 bars and 2 legs. Even though the bar 12 signal bar was a doji and not a bull reversal bar, it had a bigger bull tail than bear tail, indicating some buying and some weakening of the bears. Also, the bar 8 to bar 10 bear flag was a tight trading range and therefore had a magnetic pull, increasing the chances that any breakout would get pulled back up to that level. Bar 11 was a breakout bar, and therefore it created a breakout gap. Breakout gaps usually get tested, as do breakout points. The bar 1 low was the breakout point. The bears wanted the pullback to stay below bar 1, and the bulls wanted the opposite. At a minimum, the bulls wanted the market to get back above the bar 1 low and stay there so that most traders would see the breakout as a failure. This would have probably ended the bear trend. Finally, the trading range of the first couple of hours was about half of an average daily range, and this increases the odds that any breakout up or down would be followed by a trading range of about the same size, creating a trending trading range day. Therefore, bulls should be expected to come in around the bar 12 price level, which was a measured move down from the first leg down on the day, bar 2 to bar 4. Bar 31 is a pullback from a small rally that broke above a minor swing high and almost broke to a new high of the day. When the market almost breaks out and then pulls back, it will trade as if it actually broke out and is therefore a type of breakout pullback. This bar 31 breakout pullback traded down to only 2 cents below the top of the bar 29 signal bar. And when a stock is trading at $580, it is just about a perfect breakout test and therefore a reliable long setup. The market once again found strong buyers at the price where it broke out 3 bars earlier. A pullback from the breakout of a flag is one of the most reliable setups. Once the actual breakout to the new high for the day occurred, there was a breakout pullback long entry setup at bar 33. Although it is not worth looking at lots of different time frames during the day, smaller time frames often have reliable breakout test setups that are not apparent on the chart that you are using for trading. For example, if you were trading the 3-minute chart, you would have seen that the bar 6 high was a breakout test of the 3-minute bar that formed the high at bar 3 above. This means that if you looked at the 3-minute chart, you would have discovered that the bar that corresponds to bar 6 on the 5-minute chart formed a perfect breakout test of the low of the bar on the 3-minute chart that corresponds to bar 3 on the 5-minute chart. Bar 28 was a strong bear bar and an attempt to break the market to the downside. As it was forming, it briefly was a large bear trend bar with a last price on its low and below the lows of the prior 8 bars, creating a strong bear breakout and reversal. However, by the time the bar closed, its close was above the bar 26 trading range low. Most attempts to break out against the trend fail and are faded by strong trades. They understand that bear spikes in bull trends are common and usually are followed by new highs. At the moment that bar 28 was at the low of its bar, beginners saw it as a very large bear trend bar and assumed that the trend was reversing sharply into a strong bear. They lost sight of all of the other bars on the chart. Experienced traders saw the bear spike as a brief markdown in price and great opportunity to buy a discount in a bull trend. When a bear spike like this occurs on daily charts, it is usually due to some news event, which seemed huge at the time, but experienced bulls know that it is tiny compared to all of the other fundamentals in the stock, and that it is just one bear bar in a strong bull trend. Many stocks are often well-behaved and will come back to test the breakout to the exact tick, as Lehman Brothers Holdings, LEH, did 4 times in one day, see figure 5.3. Since many traders will enter a breakout on a stop at one tick beyond the signal bar, exact pullbacks like these will run any break-even stop by one tick. However, re-entering at one tick beyond the test bar is usually a good trade, for example, shorting at 1 penny below the low of bar 2. Alternatively, traders could risk a few cents on the pullback, avoiding getting stopped out by the breakout test. After the trend resumes, they can move their stop to just above that test bar. Sellers came in once again at the highs of bars 1, 2, and 3. Buyers again asserted themselves in bar 4 when the market came down to where the buyers originally overwhelmed the sellers at the low of the day. This higher low was the second attempt for the buyers to take control of the market in this price area, and they succeeded, so there should be at least 2 legs up. GS has been notorious for running break-even stops over the past year, but as long as you are aware of the tendencies of the market you are trading, you can make profitable adjustments, see figure 5.4. Bar 8 extended 6 cents above the low of the bar 6 signal bar. Bar 10 hit 2 cents above the bar 9 signal bar low, running an exact break-even stop by 3 cents. Traders could avoid being stopped out and having to short again 50 cents lower by risking about 10 cents until after there is a successful breakout test. Once the market falls below the breakout test bar, move the protective stop to 1 cent above its high. The bar 5 high exceeded the swing high of the final hour of yesterday by 2 cents before reversing down for the second time in this price area. The buyers made 2 attempts to go above this area and failed both times, creating a double top, so the market should have at least 2 legs down. It also overshot the trend channel line drawn across bars 2 and 4, and the bull trend line breakdown to bar 7 was followed by the bar 8 lower high test of the bull extreme bar 5, leading to a bear swing. Bar 8 was a pullback from the spike formed by 4 bear bars that broke below the bull trend line, not shown. Traders debated whether the breakout would fail or succeed. The bulls saw the bar 7 outside up bar, which was a double bottom with bar 3, as a sign that the bear breakout would fail, and bought as it went outside up and above the bar 7 high. The bears saw the bear spike as strong and were looking to short a pullback. They sold below the low of the bear inside bar that followed bar 8. It formed a 2-bar reversal with bar 8. Bar 1, the bar after bar 2, bar 3, and the bar after bar 4 were 1-bar breakout pullback by setups. As strong as the 3-bar bull spike up to bar 9 was, traders cannot lose sight of the much stronger sell-off from bar 8 that preceded it. Beginners often only see the most recent few bars, and tend to ignore the much more impressive bars just a little to the left. Bar 9 was just a low 2 test of the moving average in a bear trend. Bar 10 was a double top with the high of the bar from 4 bars earlier at the moving average, and therefore another low 2 short. Beginners again probably saw the 3 strong bull bar rally to the moving average as a trend reversal, and again lost sight of the strong bear trend that was in effect. Bar 10 was just another lower high test of the moving average that followed another lower low in a bear trend. After a breakout from a wedge top, the pullback does not have to be a lower high. In figure 5.5, there were 2 wedge tops that broke to the downside, and in both cases the market pulled back to a higher high at bar 6 and bar 11. The market was in a trading range from August to October before breaking to the upside, and it had a lot of 2-sided trading. This was a trending trading range pattern, and the odds were high that once it reversed down, it would at least test the bar 6 high of the lower range. Once the market fell into the lower range and did not immediately reverse back up, the next test point was the bottom of the lower range. Goog formed a series of breakout pullback entries in the chart, shown in figure 5.6. The sharp rally off the open broke above the bar 1 swing high of yesterday, and the pullback at bar 5 could not even reach the moving average or the breakout point. When there is strong momentum, buying a high 1 pullback is a good trade. The signal bar is a small doji inside bar, indicating a loss of selling power following the large bear trend bar. The bear breakout below the bull micro trend line failed and became a pullback from the breakout above yesterday's high. There was a second long entry at bar 6, which was a high 2. In strong trends, sometimes the high 2 entry is higher than that of the high 1 here, 3 bars earlier. Bar 7 was the third strong bear spike in the move up to the higher high. This represented selling pressure, which is always cumulative, and indicated that the bears were becoming increasingly strong. Bar 8 was a breakout test that missed the low of the signal bar by 2 cents. Bar 9 was a breakout test that missed the signal bar low for the bar 8 short by 4 cents. These are just observations and not needed to take the breakout pullback shorts at bars 8 and 9. Bar 9 was a low 2 short setup at the moving average, and it was a bear trend bar, which is a reliable combination. This was followed by an inside bar, creating another breakout pullback short entry on bar 10. It was also the first clear lower high and the possible start of a bear trend. Bar 11 broke below the bar 5 pullback and resulted in a breakout pullback short at the moving average at bar 12. Bar 12 was another lower high and a double top bear flag with bar 9. Double tops do not have to be exact. Bar 12 was also the pullback from the bear spike down to bar 11 and the start of a bear channel, which had several more bear spikes in it. Bar 13 broke only 5 cents below bar 11, but quickly gave a breakout pullback short entry at the bar 14 low 1. Since bar 14 had a bull body, a more cautious trader would have waited for a second entry. The doji bar following bar 14 was an acceptable entry bar, but selling the outside bar that followed this doji bar was even better because it was a low 2. Why was it a low 2? Because it followed 2 small legs up. Bar 14 was the first leg up, and the outside bar 2 bars later traded above that small doji bar, creating a second leg up, and the low 2 short entry. Bar 15 was also an outside bar short entry for the pullback, following the breakout below bars 11 and 13. It was especially good because there were trapped longs who had bought the 2-bar bull reversal, thinking that it was a failed breakout below the bar 11 and bar 13 double bottom. Whenever a breakout below a double bottom tries to reverse up and fails, it is a failed wedge pattern and often has about a measured move down. The double bottom creates the first 2 pushes down, and the breakout below the double bottom is the third push down. Since there were 4 bear trend bars down from bar 14, and smart traders would have wanted a higher low pullback before going long. Bar 16 was a low 2 pullback after the breakout below yesterday's bar 2 swing low. Many of these trades were tiny scalps and should not be the focus of the majority of traders. Their significance is that they illustrate a common behavior. Traders should concentrate on trading the bigger turning points, like bars 4, 7, 9, and 12. As shown in figure 5.7, there were several failed breakouts from bull and bear flags on this 60-minute chart of EWZ, the iShares MSCI Brazil Fund ETF. Once there is a trend, and then a flag that has a breakout that fails and is followed by a reversal, that flag is the final flag of the trend. A final bull flag can reverse down after a higher high, like at bars 3 and 9, or after a lower high, like at bars 5 and 10. A final bear flag can reverse up after a lower low, like at bars 6, 11, and 13, or after a higher low, like at bars 1, 8, and 14. Sometimes the final bear flag is also the first leg up of the next bull trend, see figure 5.8. This 120-minute chart of Tata Motors Limited, TTM, a car maker in India, had a bear flag that ended at bar 5 and became the final flag of the sell-off. The bar 6 higher low led to a sharp rally to bar 7, which was above the bar 5 lower high and was therefore a higher high and a sign of bull strength. As discussed in the section on final flags in Book 3, the breakout from the final bear flag does not have to fall below the bear low. As shown in figure 5.9, the 5-minute E-mini was in a strong bear trend down to bar 1, and this was followed by a low momentum, rounded bear flag that ended at bar 2. Next came a sharp sell off to bar 3 that tested the bar 1 low. Although it was a couple of ticks higher, it was a double bottom test of the bear low. The rally to bar 2 in hindsight was the final bear flag and effectively the first leg up of the new bull trend, and the sell-off to bar 3 was a breakout pullback from that rally and a failed breakout of the bear flag. The bull spike up from bar 3 had so much momentum that it soared above the bar 2 bear flag without a pause. This usually indicates that there is more to go, so traders should not be quick to exit their entire long positions. The first pullback was a high one at bar 4, well above the bar 2 high. Sometimes the slope of the final flag of a trend is about the same as the slope of the new trend after the reversal. See figure 5.10. This 60-minute chart of GS had a final bull flag from bar 1 to bar 2, and its general slope was about the same as the bear trend that followed the reversal. The market knew the approximate rate of descent that the sell-off would have, but the sell-off was briefly interrupted by one final higher high to bar 3. The entire pattern from bar 1 to bar 9 is a downward channel, which is a bull flag. The move up to bar 3 was a false breakout to the upside. Chapter 6. Gaps. A gap is simply space between two prices. On daily, weekly, and monthly charts, traditional gaps are easy to spot. For example, if the market is in a bull trend and today's low is above the high of yesterday, then today gapped up. These traditional gaps are called breakaway or breakout gaps when they form at the start of a trend, measuring gaps when they are in the middle of a trend, and exhaustion gaps when they form at the end of a trend. When a gap forms at other times, like within the spike phase of a trend or within a trading range, it is simply called a gap. Traders usually cannot classify a gap until after they see what the market does next. For example, if the market is breaking out of the top of a trading range on the daily chart, and the breakout bar is a large bull trend bar with a low above the high of the prior bar, traders will see the gap as a sign of strength and will think of it as a potential breakaway gap. If the new bull trend continues for dozens of bars, they will look back at the gap and definitively call it a breakaway gap. If instead the market reverses down into a bear trend within a few bars, they will call it an exhaustion gap. If the bull trend goes for 5 or 10 bars or so and gaps again, traders will think that this second gap might become the middle of the bull trend. They will see it as a possible measuring gap, and many traders will look to take profits on their longs once the market makes a measured move up. The measured move is based on the height from the bottom of the bull trend to the middle of the gap, and this height is added to the middle of the gap. This type of gap usually is in the spike phase of a trend, and it gives traders confidence to enter at the market or on small pullbacks because they believe that the market will work its way toward a measured move target. After the bull trend has gone on for dozens of bars, reaches a resistance area, and is beginning to show signs of a possible reversal, traders will pay attention to the next gap up, if there is one. If one forms, they will see it as a potential exhaustion gap. If before going much higher, the market trades back down to below the high of the bar before the gap, traders will see that as a sign of weakness and will think that the gap might represent exhaustion, which is a type of buy climax. They will often not look to buy again until after the market has corrected for at least 10 bars and 2 legs. Sometimes an exhaustion gap forms before a trend reversal. And because of that, whenever there is a possible exhaustion gap, traders will look at the overall price action to see if the trader's equation warrants a short position. If there is a reversal, the trend bar that creates it is then a breakout gap. A bar can function like a gap and a possible start of a trend in the opposite direction. Because all trend bars are gaps, traders can see intraday equivalents of the traditional gaps that are so common on daily charts. If there is a bull trend that is at a resistance area and is likely to reverse down, reversals are discussed in Book 3. But has one final breakout, that bull trend bar might become an exhaustion gap. The bar is sometimes a very large bull trend bar that closes near its high, and occasionally the final breakout will be made of 2 very large bull trend bars. This is a potential buy climax, and it alerts astute traders to sell. The bulls sell to grab profits, since they believe that the market will likely trade down for a couple of legs and about 10 bars, possibly allowing them to buy again much lower. They also are aware of the possibility of an exhaustive buy climax and trend reversal, and do not want to risk giving back any of their profits. Aggressive bears are aware of this as well, and they will sell to initiate shorts. If a strong bear trend bar forms within the next few bars and the always-in direction flips to down, that final bull trend bar becomes a confirmed exhaustion gap, and the bear trend bar becomes a breakout gap. The bull trend bar followed by the bear trend bar is a climactic reversal and a two-bar reversal. If there are one or more bars between the two trend bars, those bars form an island top. The bottom of that island top is the top of the bear breakout gap and, like all gaps, might get tested. If it does, and the market turns down again, that breakout test forms a lower high. If the initial reversal down was strong, both bulls and bears will sell as the market tests the island top, and as the market turns down again, since both are more confident that the market will fall for about 10 or more bars. The bulls will sell to lock in profits or to minimize losses if they bought higher as the bull trend breakout bars were forming. The bears will sell to initiate shorts. Once the market trades down for many bars, profit takers, bears buying back their shorts, will come in and create a pullback or a trading range. If the market again has a bear trend bar that breaks below the trading range, that bar is then a possible measuring gap, and traders will try to hold on to part of their shorts until the market approaches that target. As the market turns down, traders will look at the strength of the bear bars. If there are one or two large bear trend bars closing near their lows, traders will assume that the always-in direction might be flipping to short. They will watch the next few bars to see if a high one by signal bar develops. If one forms and it is weak relative to the sell-off, like a small bull doji or a bear bar, more traders will look to short above its high than to buy. Remember, this is a high one pullback in what has been a bull trend, but now traders are looking for about 10 bars sideways to down, so more will look to short above the high one by signal bar than to buy. If they are right, the high one by signal will fail and form a lower high. If the reversal down is strong, traders will also short below the lower high and below the high one by signal bar. If the market goes more sideways to down and then forms a high 2 buy setup, the bears will assume that it, too, will fail and will place limit orders at and above its high to go short. Other bears will place stop orders to go short below the high 2 buy signal bar, because that is where the bulls who bought the high 2 will have their protective stops. Once these bulls get stopped out, they will likely not look to buy again for at least a couple of bars, and the absence of bulls and the presence of bears can lead to a bear breakout. If it is weak, the bulls might be able to create a wedge bull flag, a high 3 buy setup. If the breakout is strong, the move down will likely go for at least a couple of small legs and reach a measured move, based on the height of the trading range, the bull high to the bottom of the high 2 bull signal bar. The breakout bar then becomes a measuring gap. If the bulls are successful in turning the market up at the high 3, a wedge bull flag, then the bear measuring gap will close and become an exhaustion gap. This process happens many times a day on every chart, and traders are always asking themselves whether a breakout will likely succeed and turn the breakout bar into a measuring gap, or will it more likely fail and turn the trend bar that formed the breakout into an exhaustion gap. The labels are not important, but the implications are. This is the single most important decision that traders make, and they make it whenever they consider any trade: will there be more buyers or sellers above and below the prior bar? Whenever they believe that there is an imbalance, they have an edge. In the case of that bull breakout, when there finally is a signal bar for a failed breakout, traders will decide if there will be more buyers or sellers below that bar. If they think that the breakout is strong, they will assume that there will be more buyers, and they will buy below the bar. Others will wait to see if the next bar only falls for a few ticks. If so, they will place stop orders to buy above it, and they will consider it to be a breakout pullback buy setup. The gap will then likely become a measuring gap. The bears will see that signal bar for the failed breakout as a strong sell signal, and they will short below its low. If they are right, the market will sell off and close the bull gap, turning it into an exhaustion gap, and soon move below the low of the bull breakout bar, and they hope that it will continue much lower. All gaps will get filled is a saying that you sometimes hear, but this saying only rarely helps traders. The market is always coming back to test prior prices, so the saying would be more precise if it were all prior prices get tested. However, enough traders pay attention to gaps so that they act as magnets, especially when the pullback gets close to them. The closer the market gets to any magnet, the stronger the magnetic field and the more likely the market will reach the magnet. This is the basis for buy and sell vacuums. For example, if there is a gap up in a bull trend, once there is finally a correction or a reversal, the market might be only slightly more likely to go below the high of the bar before the gap, and therefore fill the gap than it is to go below the high of any other bar in the rally. However, since gaps are magnets, traders can look for trading opportunities as the market approaches them, just as they should as the market approaches any magnet. Gaps where the low of a bar is above the high of the prior bar, or where the high of a bar is below the low of the prior bar, are rare on an intraday chart of a highly liquid instrument, except on the first bar of the day when they are common. However, if one uses a broad definition, gaps of other types occur many times every day on a 5-minute chart, and they can be useful in understanding what the market is doing and in setting up trades. Occasionally, the open of a bar on a 5-minute chart will be above the close of the prior bar, and this is often a subtle indication of strength. For example, if there are 2 or 3 of these gaps on consecutive bull trend bars, the bulls are likely strong. All of these gaps have the same significance on daily, weekly, and monthly charts as well. Because gaps are important elements of price action, intraday traders should use a broad definition of a gap and look at trend bars as an intraday equivalence because they are functionally identical. If the volume was thin enough, there would be actual gaps on every intraday chart whenever there was a series of trend bars. Remember, all trend bars are spikes, breakouts, and climaxes, and a breakout is a variant of a gap. When there is a large gap up on the first bar of the day on the E-mini, there will be a large bull trend bar on the Standard and Poor's S&P 500 cash index. That is an example of how a gap and a trend bar represent the same behavior. When there is a large trend bar at the start of a trend, it creates a breakout gap. For example, if the market is reversing up from a low or breaking out of a trading range, the high of the bar before the trend bar and the low of the bar after it create the breakout gap. You can simply think of the entire trend bar's body as the gap as well, and there may be other recent swing highs that some traders will consider as the bottom of the gap. There is often not a single choice, but that does not matter. What does matter is that there is a breakout, which means that there is a gap, even though a traditional gap is not visible on the chart. The market will often dip a tick or two below the high of the bar before the trend bar, and traders will still think that the breakout is in effect as long as the pullback does not fall below the low of the trend bar. In general, if the market falls more than a couple of ticks below the high of the bar before it, traders will lose confidence in the breakout and there might not be much follow-through, even if there is no reversal. Whenever there is a trend bar in a potential bull breakout, always look at the high of the bar before it and the low of the bar after it. If they do not overlap, the space between them might function as a measuring gap. If the trend continues up, look for profit taking at the measured move based on the low of the bull leg to the middle of the gap. Sometimes the bottom of the gap will be a swing high that formed several bars earlier or a high within the spike, but a couple of bars before the trend bar. The low of the gap might be a swing low that forms many bars after the breakout bar. The same is true of a bear trend bar that is breaking out in a bear leg. Always look for potential measuring gaps, the most obvious one being the one between the low of the bar before the bear trend bar and the high of the bar after it. If the bull trend has been going on for 5 to 10 or more bars, and then there is another bull trend bar, it might become just an unremarkable gap, a measuring gap, or an exhaustion gap. Traders will not know until they see the next several bars. If there is another strong bull trend bar, the odds of a measuring gap are greater, and bulls will continue to buy with the expectation of the rally continuing up for about a measured move, based on the middle of the gap. Another common gap is between the high or low of a bar and the moving average. In trends, these can set up good swing trades that test the extreme of the trend, and in trading ranges, they often set up scalps to the moving average. For example, if there is a strong bear trend and the market finally rallies above the moving average, the first bar in that rally that has a low above the moving average is a first moving average gap bar. Traders will place a sell stop order at 1 tick below the low of that bar to go short, looking for a test of the bear market low. If the stop is not triggered, they will keep moving the stop up to 1 tick below the low of the bar that just closed until their short is filled. Sometimes they will get stopped out by the market moving above the signal bar, and if that happens, they will try one more time to re-enter their shorts at one tick below the low of the prior bar. Once filled, the signal bar is a second moving average gap bar short signal. Moving average gaps happen many times a day every day, and most of the time they occur in the absence of a strong trend. If traders are selective, many of these gap bars can set up fades to the moving average. For example, assume that the day is a trading range day and that the market has been above the moving average for an hour or so. If it then sells off to below the moving average, but is followed by a strong bull reversal bar with a high that is below the moving average, traders will often go long above that bar if there's enough room between the high of that bar and the moving average for a long scalp. Breakouts on all time frames, including intraday and daily charts, often form breakout gaps and measuring gaps that are different from the traditional versions. The space between the breakout point and the first pause or pullback after the breakout is a gap, and if it appears early in a possible strong trend, it is a breakaway gap and is a sign of strength. Although it will lead to a measured move from the start of the leg, the target is usually too close for traders to take profits, and they should therefore ignore the measured move projection. Instead, they should look at the gap as only a sign of strength, and not a tool to use to create a target for taking profits. For example, if the average daily range in the E-mini has been about 12 points, and after about an hour into the day the range is only 3 points, the gap formed by a breakout would lead to a target that would result in a range for the day of only 6 points. If a trend is just beginning, it is more likely that the range will reach about the average of 12 points and not just 6 points, and therefore traders should not be taking profits at the measured move target. When the distance from the start of the leg to the breakout gap, breakaway gap, is about a third to a half of an average daily range, its middle often leads to a measured move projection where traders might take profits or even reverse their positions. For example, if the market is in a trading range, and then the market forms a large bull trend bar that breaks out above the trading range, the swing high at the top of the range is the breakout point. If the market moves sideways or up on the next bar, the low of that bar is the first price to consider as the breakout test. The midpoint between its low and the breakout point often becomes the middle of the bull leg, and the gap is a measuring gap. If the range is about a third to a half of the recent average daily range, use the bottom of the leg as the starting point for the measured move. Measure the number of ticks between that low and the middle of the measuring gap, and project that same number of ticks up above that midpoint. Then look to see how the market behaves if it moves up to a tick or so of the measured move. If within a few bars of the breakout, the market pulls back into the gap, but then rallies, use that pullback low as the breakout test, and then the measuring gap is between that low and the breakout point. This is a sign of strength. Once the market rallies to the measured move projection, many traders will take partial or total profits on their longs. If the move up was weak, some traders might even place limit orders to short at the measured move target, although only very experienced traders should consider this. Elliot wave traders see most of these gaps as being formed by a small wave for pullback that is staying above the high of wave 1 and expect a wave 5 to follow. Not enough volume is being traded based on Elliot wave theory to make this a significant component of the price action, but whenever a pullback does not fall below the breakout point, all traders see this as a sign of strength and expect a test of the trend high. The pullback is a breakout test. If the pullback falls a little below the breakout point, this is a sign of a lack of strength. You can still use the middle between that low and the breakout point even though the pullback is below the breakout. When that happens, I refer to this type of gap as a negative gap, since the mathematical difference is a negative number. For example, in a bull breakout, if you subtract the high of the breakout point from the low of the breakout test bar, the result is a negative number. Negative measuring gaps lead to projections that are less reliable, but still can be very accurate and therefore are worth watching. Incidentally, stairs patterns have negative gaps after each new breakout. Small measuring gaps can also form around any trend bar. These micro-measuring gaps occur if the bar before and the bar after the trend bar do not overlap, and, like any gap, can lead to a measured move. The measured move will usually be more accurate if the trend bar was acting as a breakout. For example, look at any strong bull trend bar in any bull leg where the trend bar is breaking into a strong bull leg. If the low of the bar after it is at or above the high of the bar before it, the space between is a gap and it can be a measuring gap. Measure from the start of the leg to the middle of the gap and project up to see how high the market would have to go if the gap was in the middle of the leg. This is an area where longs might take profits. If there are other reasons to short up there, bears will short there as well. When these micro gaps occur in the first several bars of a trend, the market will usually extend much further than a measured move based on the gap. Don't use the gap to find an area in which to take profits, because the market will likely go much further and you don't want to exit early in a great swing. However, these gaps are still important in the early stages of a trend because they give trend traders more confidence in the strength of the trend. Breakouts occur many times every day, but most of them fail and the market reverses. However, when they succeed, they offer a potential reward that can be several times as large as the risk with an acceptable probability of success. Once a trader learns how to determine if a breakout is likely to be successful, these trades should be considered. There are other examples of measuring gaps in Chapter 8 on measured moves. Using this broad definition of a gap allows traders to discover many trading opportunities. A very common type of gap occurs in any 3 consecutive trending bars on any chart. For example, if these 3 bars are trending up and the low of bar 3 is at or above the high of bar 1, there is a gap, and it can act as a measuring gap or a breakaway gap. The high of bar 1 is the breakout point, and it is tested by the low of bar 3, which becomes the breakout test. On a smaller time frame chart, you can see the swing high at the top of bar 1 and the swing low at the bottom of bar 3. It is easy to overlook this setup, but if you study charts, you will see that these gaps often get tested within the next many bars but not filled, and therefore become evidence that the buyers are strong. A related gap occurs after the market has been trending for many bars, but now has an unusually large trend bar. For example, if the market has been going up for the past couple of hours, but now suddenly forms a very large bull trend bar with a close near its high, especially if the high of this bar, or that of one of the next couple of bars, extends above a trend channel line, one or more important gaps with one or more breakout points and breakout tests are created. Rarely, this bar is the start of a new, even steeper bull trend. But much more commonly, it represents a buy climax in an overdone, exhausted bull trend and will be followed within a few bars by a sideways to down correction that could last about 10 bars or so, and may even become a trend reversal. Experienced traders wait for these bars, and their waiting removes sellers from the market and creates a buy vacuum that sucks the market up quickly. Once they see it, the bulls take profits and the bears short on the close of the bar, above the bar, on the close of the next bar or two if they are weak, or on a stop below those bars. Look at the bars before and after the buy climax bar. The first gap to consider is that between the low of the bar after it and the high of the bar before it. If the market continues to go up for a few bars and then pulls back and rallies again, the breakout test is now the low of that pullback. If the market trades down below the high of the bar before the buy climax bar, the gap is then closed, filled. If the market continues down into a large leg down, the gap becomes an exhaustion gap. Also, look at the bars before the bull breakout for other possible breakout points. These usually are swing highs, and there might be several to consider. For example, there might have been a small swing high a few bars earlier, but another couple of higher swing highs that formed even a couple of hours earlier. If the breakout bar broke strongly above all of them, they are all possible breakout points that could lead to a measured move up, and you might have to consider the projections up from the midpoint of each of these gaps. If there is a confluence of resistance at one of the projections, like a trend channel line, a higher time frame bear trend line, or a couple of other measured move targets based on other calculations, like the height of the trading range, profit takers will come in at that level, and there will also be some shorts. Some of the shorts will be scalping, but others will be establishing swings and will add on higher. There is a widely held belief that most gaps get filled or at least the breakout point gets tested, and this is true. Whenever something is likely to happen, there is a trading opportunity. When there is a bear spike and channel, the market often corrects back up to the top of the channel, which is the bottom of the gap, and tries to form a double top for a test down. When there is a buy climax bar that breaks out above a significant swing high, there will usually be a pullback that tests that swing high, so traders should look for short setups that could lead to the test. However, do not be too eager, and make sure that the setup makes sense and that there is other evidence that the pullback is likely to be imminent. This might be a sideways bull flag that breaks out and runs for a couple bars and then has a strong reversal bar, turning that bull flag into a possible final flag. Final flags usually are followed by at least a two-legged correction that tests the bottom of the flag. They often drop for a measured move down from the top to the bottom of the flag and sometimes lead to a trend reversal. All of the preceding is true for bear breakouts as well. Besides the breakout gaps that form at the start of trends and the measuring gaps that form in the middle, exhaustion gaps form when a trend is trying to reverse. When there is a gap late in a trend, and then the market reverses and closes the gap becomes an exhaustion gap, and like all signs of exhaustion discussed in Book 3 on reversals. It is usually followed by a trading range, but it sometimes leads to a reversal. These are more important to traders who are trading off of daily charts, but day traders see them all the time on gap openings that lead to opening reversals. Day traders think of them as just failed gap openings, but they are a type of exhaustion gap. On the daily chart, if there is an exhaustion gap followed by a breakout gap in the opposite direction, and that gap remains open after the bar closes, this creates an island reversal pattern. For example, if there is a bull trend and then there is a gap up that is followed by a gap down on the next bar or even a dozen bars later, the bars between the two gaps are considered to be the island top. Figure 18.4 in Chapter 18 shows an example of an island bottom on a daily chart. Whenever there is a channel and then a trend bar that closes beyond the extreme of the prior bar, traders should watch to see if a gap forms. For example, if there is a bull channel or a bear flag, and the next bar closes several ticks above the high of the prior bar, this breakout bar might become a measuring gap. Watch the low of the next bar to see if it stays above the high of the prior bar. If so, the breakout bar might be a measuring gap. If the gap closes, the trend bar might be an exhaustion gap, and the bull spike could lead to a reversal down. Breakout gaps are discussed further in the first book in Chapter 23 on trends from the open and in the third book in the chapter on gap openings. Traditional gaps on a daily chart are classified as breakout gaps, breakaway gaps, measuring gaps, exhaustion gaps, and just ordinary gaps. For the most part, the classification is not important, and a gap that appears as one type initially can be seen as a different type later on. For example, gap 5 on the daily chart of Opal shown in Figure 6.1 might have been a measuring gap, but ended up as an exhaustion gap. Also, when a market is in a strong trend, it often has a series of gaps and any can become a measuring gap. Traders need to be aware of each possibility. For example, gaps 4, 21, 25, 26, 27, and 45 were potential measuring gaps. Gap 4 was a measuring gap, and the bar 6 high was almost a perfect measured move. The bar 2 bottom of the leg to the middle of the gap had about as many ticks as the middle of the gap to the top of bar 6, where profit takers came in, as did new strong bears. Profit taking came in just below the targets based on gaps 26 and 45. Breakout gaps often flip the always-in direction and therefore are an important sign of strength. Most traders would classify the following as breakout gaps: gaps 3, 7, 11, 15, 18, 29, 32, 36, 44, and 47. When there is a breakout and a gap, look at the gap as a sign of strength and not as a tool to create a measured move target. When a trend is just beginning, it is a mistake to take profits too early. Do not use a reasonable candidate for a breakout gap as a measuring gap. The rally to bar 22 broke out above the bar 6 high, and the pullbacks to bars 23 and 24 were breakout tests. The space between the bar 24 low, where the market turned up again, and the bar 6 high is the breakout gap. Here, because the bar 24 low was below the bar 6 high, the breakout gap was negative. Since it was a breakout from a large trading range, it had a good chance of also being a measuring gap. Some experienced traders would have faded the breakout and shorted below bar 22, looking for a test of the breakout point and a quick scalp down. The bulls were looking for the same thing and were ready to eagerly buy at the market or on limit orders when the pullback tested into the gap. The bulls originally bought the breakout in the move up to bar 22, and their eagerness to buy again at the same price enabled the new bull trend to resume and go for at least some kind of measured move up. For example, It might have been based on the height of the pullback from the bar 22 high to the bar 23 low. After a trend has gone on for a while, traders will begin to look for a deeper pullback. A gap often appears before the correction, and that gap is an exhaustion gap, like gaps 5, 16, 27, 33, and 45. When a gap occurs as part of a series in a spike or within a trading range, it is usually not classified, and most traders refer to it simply as a gap, like gaps 19, 20, 37, and 38. Traditional gaps on intraday charts can usually be seen on 5-minute charts only if the volume is extremely light. Figure 6.2 shows two related exchange-traded funds, ETFs. The FAS on the left traded 16 million shares today, and the RKH on the right traded only 98,000 shares. All of the gaps on the RKH chart were trend bars on the FAS chart, and many of the large trend bars on the FAS chart were gaps on the RKH chart, demonstrating that a trend bar is a variant of a gap. Intraday charts have their own versions of gaps. Every trend bar is a spike, a breakout, and a climax, and since every breakout is a variant of a gap, every trend bar is a type of gap. Gaps on the open are common on most 5-minute charts. In Figure 6.3, bar 2 gapped beneath the low of the final bar of yesterday, creating an opening gap. The market reversed up on bar 5, and at the time of the reversal, the odds of it being the start of a bull trend were good, given the strong bottom. Because it was the start of a bull trend, it was a breakout gap. Some traders saw its body as the gap, and others thought that the gap was the space between the high of bar 4 and the low of bar 6. Bar 6 and bar 7 were also trend bars and therefore also gaps. It is common for trends to have gaps along the way and are a sign of strength. Bar 11 was a breakout of the bull flag from bar 9 to bar 10, and a breakout above the opening range. Since the opening range was about half of the size of an average daily range, traders were looking for a doubling of the range, and that made bar 11 a likely measuring gap as well as a breakout gap. The market hesitated for 3 bars between bar 12 and bar 13 in the area of yesterday's high, going into the close. Some traders saw this as the top of today's opening range. Bar 13 was a bear reversal bar, and since the market might have traded below it, the bears saw it as a signal bar for a failed breakout of both the bar 9 high and the high of yesterday's close. Since the breakout was so strong, far more traders assumed that the failed breakout sell signal would not succeed, and therefore placed limit orders to buy at and below its low. Those aggressive bulls were able to turn the market up quickly on bar 14. The low of 14 then formed the top of the measuring gap, and the high of bar 9 was the bottom. Since bar 14 was an outside-up bar, it was a breakout pullback buy entry that triggered the buy as the market went above the high of the prior bar, bar 13. The bull trend went far beyond the measured move target. Had the bears succeeded in reversing the market down, bar 11 would have become an exhaustion gap instead of a measuring gap. As long as the pullback did not fall more than a tick or so below the bar 9 high, traders would have still looked at the gap as a measuring gap, and they would have considered taking partial profits at the measured move target. The market raced up so sharply that many would not have exited at the target. If the market fell further, traders would not have trusted any measured move up based on the bar 11 gap, and instead would have looked for other ways to calculate measured move targets. At that point, referring to bar 11 as either a measuring or exhaustion gap would have been meaningless, and traders would no longer have thought of it in those terms. As long as the sell-off did not fall below the bar 10 high, the bulls would have considered the breakout to be successful. If it fell below the high of bar 10 or the low of bar 10, traders would have then saw the market as in a trading range or possibly even a bear trend if the sell-off was strong. Bar 14 was a breakout test of the bar 11 gap. It missed the bar 9 breakout point by a tick and turned back up. By not letting the market fall below the bar 9 high or the bar 12 low, the bulls were showing their strength. The market broke out again on bar 15, which meant that bar 15 was a breakout gap and a potential measuring gap. Some traders would have used the height of the opening range for the measured move, the bar 4 low to the bar 13 high, and others would have used the middle of the gap between the bar 13 breakout point and the bar 15 pullback. Bars 15 and 16 were also gaps in a bull trend, and therefore signs of strength. Bar 17 was an especially large bull trend bar in a trend that had gone on for 10 or 20 bars, and therefore it was likely to function as an exhaustion type of trend bar and a possible exhaustion gap. Buy climaxes sometimes lead to reversals, but more often just lead to corrections that last about 10 bars and often have 2 legs. Bar 19 was another potential breakout gap, since it was the breakout above a small bull flag, but after a buy climax, more of a correction was likely. Bar 20 was an attempt at a bear breakout gap, but the body was too small. The bar did not break below the bottom of the developing trading range, the low of the bar before bar 19. Bar 22 was a breakout gap, and the bears hoped that it would lead to a measured move down, and therefore become a measuring gap. It had a large bear body, and it broke below a 5-bar ledge and the bottom of the trading range. However, in a strong bull trend, it could simply have been part of a test of the moving average, and it might simply have been due to a sell vacuum, with strong bulls and bears just waiting for slightly lower prices. The bulls were waiting to buy to initiate new longs, and the bears were waiting to take profits on their shorts. Bar 23 extended the breakout, but there was no follow-through, and like most reversal attempts and most bear breakout attempts in bull trends, it failed. Most traders wanted to see one more bear trend bar before they would have considered the market as having flipped to always in short. This is a common situation, which is why aggressive bulls buy the closes of bars like 23, expecting that the bears would be unable to flip the market to short. This allows those bulls to get long near the very bottom of the correction. Bar 24 was a bull moving average gap bar and a signal bar for the end of 2 legs down from the bar 17 by climax. Although bar 22 could be considered to be an exhaustion gap, since it was the end of a small bear trend, most traders still saw the market as always in long and the trend as still up, so there was no significant bear trend to exhaust. This was a pullback in a bull trend and not a new bear trend. Bar 22 was therefore just a failed breakout. Bar 25 was another breakout, since the market was reversing up from a pullback in a bull trend and therefore breaking above a bull flag. The bull inside bar after bar 23 was the signal bar for the bull flag entry. Bar 25 was a potential bear flag after the bear spiked down to bar 23. Once bar 25 closed well above the bar 24 high, the bears probably gave up on their premise that a second leg down would follow. That close created the possibility that bar 25 was a measuring gap, which it was once bar 26 turned the market up again after a 1-bar pause. The rally went well above the measured move target, and 25 became a breakaway gap. Some traders still wondered whether a bear channel might be underway, but when bar 26 went above the bear trend bar before it and above the top of bar 22, the bear breakout gap, the bear theory was untenable for most traders. Bars 27, 29, 32, and 40 were also bull breakout gaps. Bar 36 was a breakout gap, but the next bar reversed down. Some traders then saw bar 36 as an exhaustion gap and a possible end of the rally, and the start of either a trading range or a larger correction. Bars 37, 38, and 39 were bear gaps and signs of strength on the part of the bears, selling pressure. This 5-minute E-mini chart in figure 6.4 illustrates a number of gaps. The only traditional gap occurred on the open when the low of the first bar of the day gapped above the high of the final bar of yesterday. However, since the first bar did not gap above the high of yesterday, there was no gap on the daily chart. The market trended down to bar 13 and then rallied above the moving average, breaking the bear trend line. Notice how the low of bar 14 is above the moving average, and it is the first such bar in over a couple of hours. This is a moving average gap, and these gaps often lead to a test of the bear low and then a 2-legged move up, especially if the move up to the gap bar breaks above the bear trend line as it did here. Here, it led to a higher low trend reversal at bar 15 and then a second leg up to bar 18. Bar 6 broke out above the highs of bars 1 and 4, which became breakout points. The space between those highs and the low of bar 6 was a gap, and it was filled on the bar after bar 6. Day traders think of this as simply a gap up and an opening reversal down, but it is a form of an exhaustion gap. The bear trend bar before bar 10 opened near its high, closed near its low, and had a relatively large range. Since it formed after the market had trended down for many bars, it was a sell climax where there was a last gasp of selling with no one left who would be willing to sell until after a pullback, which often has 2 legs. That breakout bar broke below many swing lows, bars 2, 3, 5, 7, and 9, and bar 11 became the breakout test. There was also a large gap between the bar 10 high and the moving average, and that gap was filled by a two-legged move that formed a low too-short setup. The middle of the gap between the bar 9 breakout point and the bar 11 breakout test led to a measured move down from the bar 8 top of the channel down to bar 9. The hash mark below and one bar to the right of the bar 10 low is the projection down from the two higher hash marks. This gap became a measuring gap. Instead of reversing up, as is common after a reversal up from a trend channel line overshoot, the market broke to the downside and the bottom was at the measured move to the tick. Since you never know in advance which, if any, of the possible measured move targets will work, it is good to draw all that you can see and look for a reversal at any of them. These are reasonable areas to take profits on shorts. If there are other reasons to initiate a long, the chance of a profitable reversal trade increases if it occurs at a measured move. Here, for example, the market broke below a trend channel line and the prior low of the day and reversed up at an exact measured move. Although the rally to bar 11 was close to the bars 7 and 9 breakout points, the gap was not filled. That is a sign that the bears were strong, and it was followed by a new bear low. Bar 13 was another big bear bar after a protracted bear trend and therefore a second sell climax. The next bar filled the gap below the bar 10 low. Bar 14 was a second breakout test of the bars 7 and 9 double bottom, which was the breakout point. However, instead of the market falling, it went sideways to bar 15 and formed a wedge bull flag. This led to a rally and a closure of the gap, and the breakout below bars 7 and 9 failed. The day tried to become a reversal day, as trending trading range days sometimes do, but the bull trend could not maintain control late in the day. Bar 17 was a breakout pullback that tested the high of the bar 14 breakout point and led to a strong rally that stopped 2 ticks above the measured move from the bottom of bar 13 to the top of bar 11. The measured move hash marks are just to the right of the bar 13, and the distance from the bottom one to the middle one led to the projection up to the top one. Bar 18 is another example of a large moving average gap, and the gap was filled within a couple of bars. There are many other minor gaps as well, like between the low of bar 6 and the high bar 8. Even though that high is at the same price as the low of bar 6, it is a gap, and it is the breakout test of the breakout below bar 6. Similarly, the bar 15 reversal bar high was the breakout point for the breakout test bar that occurred 2 bars later. Note that the 3 bars with the largest bodies, bar 7, the bar before bar 10, and 2 bars before bar 18, all led to reversals. Remember, most breakouts fail to go very far and usually reverse, at least into a pullback. When a large trend bar occurs after a trend has been going for a while, it usually represents capitulation or exhaustion. For example, that large bull trend bar that formed 2 bars before bar 18 was in a very strong bull leg. Shorts were desperate to get out and were worried that the market might go much higher before a pullback would come and let them out at a lower price. Other traders who were flat were panicking, afraid that they were missing a huge trend into the close, so they were buying at the market, also afraid that a pullback would not come. This intense buying was caused by traders with tremendous urgency, and after they bought, the only traders left who were willing to buy were traders who would only buy a pullback. With no one left to buy at these high prices, the market could only go sideways or down. There were several micro-measuring gaps. For example, the bear trend bar after bar 6 set up 1, as did the bull trend bar after bar 10 and the bull trend bar after bar 15. All of the moves went beyond the measured move targets. The low of the bar after bar 6 and the high of the bar before bar 7 formed a micro-measuring gap, and the bar 7 low was an exact measured move down. The trend bar in the middle was a breakout to a new low of the day and a strong bear trend bar, closing on its low. The bar after bar 15 broke out of a small wedge bull flag. The low of the bar after it tested the high of bar 15, which was the breakout point. The test was exact, and as long as the low of the breakout test does not fall more than a tick or so below the breakout point, the test is a sign of strength. If the breakout test fell more, it would be a sign that the breakout was not strong and was more likely to fail. The space between the breakout point and the breakout test is a micro gap. Since it is a breakout gap, it should be used only as an indication of the strength of the breakout and not as a basis for a measured move. Initial breakouts generally lead to big moves, and traders should not be looking to take profits prematurely. Micro gaps are often negative gaps, meaning that the low of the breakout test bar is a tick or two below the low of the breakout point bar. Once the breakout bar closes, an aggressive trader can place a limit order to buy one tick above the high of the prior bar and risk just 3 ticks or so. The chance of success might be only about 40%, but the reward is many times the risk, so the trader's equation is very favorable. If the open of the bar is above or below the close of the prior bar, there is a gap. Sometimes it can be entirely due to low volume, for example, when there are many dojis, but other times it can signify strength. 7 of the 8 gaps in figure 6.5 were bullish. Only on bar 2 was the gap to the downside. When there are 2 or more successive gaps in the same direction and the bars have trending bodies, it is a sign of strength. In those 7 bull gaps, a large number of traders placed market orders on the close of the bar, and the orders got filled at the offer, indicating that the market had to go up to find enough sellers to fill those orders. If sellers are only willing to sell higher and bulls are willing to buy the offer, the market will likely continue up, at least for a while. Bar 1 set up a micro-measuring gap with the high of the bar before it and the low of the bar after it. The move up to the 7:35 a.m. PST swing high was an exact measured move from the open of the second bar of the day. Measured moves often begin with the open of the first trend bar of a spike. If the market goes above that target, then use the bottom of the spike to see if the market begins to correct at that target. The downside gap reversed up on the second bar, and it was therefore an exhaustion gap. Day traders would instead just think of it as a failed gap down opening and an opening reversal up. Part 2. Magnets, support, and resistance. There are 2 types of magnets, support and resistance. When a magnet is below the market, it is a support level, which means that it is an area where bulls will initiate positions and bears will take profits on their shorts. When a magnet is above the market, it is a resistance level, which means that it is an area where bulls will take profits on their longs and bears will initiate shorts. Support and resistance are magnets that draw the market toward them. When you become aware of a magnet not too far from the current price, trade only in the direction of the magnet until after it is reached. At that point, you will have to decide if it looks like the market will reverse, go sideways, or ignore the magnet and keep trending. Magnets tell you the likely destination, but not the path, and there may be big pullbacks along the way. Also, the market might be in a trading range for dozens of bars, but within striking distance of a magnet. Although you should be aware of the magnet, there still can be reliable trades in both directions as the market decides if it will test the magnet and how it will get there. Traders are constantly looking at support and resistance. The market has inertia and a strong propensity to continue what it has been doing. When it is trending, most attempts to reverse the trend will fail. For example, if the market is trending down, most support levels will fail to hold or reverse the market. However, all bull reversals happen at support levels, and all bear reversals happen at resistance levels. So if the market begins to reverse up, the potential reward is often many times larger than the risk. Even though the probability of success is often only 40%, the trader's equation is still positive, and the reversal trade is therefore mathematically sound. Inertia also means that when the market is in a trading range, most attempts to break out will fail, and the market will repeatedly reverse up from the support created by the bottom of the range and reverse down from the resistance at the top. Even though most attempts to reverse a trend will fail, all trend reversals and all pullbacks begin at support and resistance levels, so knowing where they are can lead traders to take profits and to enter reversal trades at optimal locations. Most E-mini trading is done by computers, and their algorithms are based on logic and numbers. When they buy a falling market or sell a rally, they are doing so because they calculated that the particular price was a logical location for them to place their trades. If enough algorithms are using similar prices, the market can reverse, at least for a bar or two, and often enough for a profitable trade. Although some algorithms use numbers that are not directly based on the E-mini price chart. For example, they might use data based on the options markets or other related markets. Unless many programs are coming up with similar numbers, it is unlikely that there will be enough force to change the direction of the market. When the market reverses, it always does so at support and resistance levels. With practice, an individual trader can usually spot them. Because some of these reversals lead to profitable trades, and because these levels are sensible areas to take profits, it is useful to know where possible turning points are. One of the important reasons to look for magnets is that they are logical areas to take partial or full profits. You should always be faster to take profits on a trade than you should be to look for an entry in the opposite direction. This means that you need a stronger setup to initiate a trade in the opposite direction than you need to take profits. If the move toward the magnet is weak, and if it is against the direction of a larger trend, you can also look to initiate a trade in the opposite direction, expecting a reversal. The market will usually overshoot the magnet, at least by a small amount, and if the move toward the magnet is not a strong trend, the market will usually reverse, at least for a bar or two. If the trend resumes and goes even further past the magnet and then reverses a second time, this is usually a reliable setup for a trade in the opposite direction, especially if there is a strong reversal bar. Any significant type of price action can form support or resistance, and common examples include trend lines, trend channel lines, any type of moving average on any time frame, measured move targets, prior swing highs or lows, bull entry bar lows and bear entry bar highs, bull signal bar highs and bear signal bar lows, yesterday's high, low, open, and close. The high, low, open, or close of any bar, especially if the bar is a large trend bar, daily pivots, Fibonacci retracement levels and projections, any type of band, support and resistance are terms created by traders to describe any price as having enough of a mathematical edge for a trader to place a profitable trade. These terms were created by traders to help them spot trades. The high of every bar on every time frame is at some resistance level, the low of every bar is at support, and the close is where it is and not one tick higher or lower because computers put it there for a reason. The support and resistance may not be obvious, but since computers control everything and they use logic, everything has to make sense, even if it is often difficult to understand. Every price on the chart has some mathematical edge, but the edges are usually too small to be tradable except by high-frequency trading HFT programs, many of which are designed to scalp for a penny of profit. By definition, a price is support or resistance only if it has a directional probability imbalance. For example, if a market falls to a level of support, traders believe that there is about a 60% chance or better that there will be at least a bounce big enough for a scalp, which is every trader's minimal trade. If the chance was only 52 or 53%, traders would probably not consider that high enough to use the term and instead would just consider the price as unremarkable. If the market is in the middle of a trading range, the low of the prior bar is always at least a minimal area of support in the general sense of the word, but that does not mean the expected bounce is big enough to place a profitable trade. If the expected bounce is only a couple of ticks, it is not support from a trader's perspective. If the current bar is still forming and it is on its low and is one tick above the low of the prior bar, there might be a 53% chance of the market bouncing 2 ticks before it falls 2 ticks. However, that is too small an edge and too small a price movement for traders to place a trade, although a high-frequency program might make that trade, and therefore traders would not call it support. The opposite is true for resistance. Support and resistance exist because the market has memory. Once the market returns to a prior price, it will tend to do the same thing that it did the last time it was there. For example, if the market falls through the bottom of a trading range and then rallies back to the bottom of the range, it will usually sell off again because that's what it did when it was last at that price level. The traders who failed to exit their longs and rode through the bear leg will be eager to get a second chance to exit them with a smaller loss, and they will hold until the market rallies back and tests the breakout. At that point, they will sell out of their longs, and this will create selling pressure. Also, the shorts who took profits at the bottom of the sell-off will be eager to short again on the rally. The combined selling by the bears and the liquidating bulls will create resistance to a further rally and usually drive the market back down. When the market falls back to a price and hits it several times and bounces each time, it is finding support at that price level. If the market rallies to a price level and keeps falling back, the area is resistance. Any area of support or resistance acts as a magnet, drawing the market to the price. As the market approaches, it enters the magnetic field, and the closer it gets, the stronger the magnetic pull is. This increases the odds of the market touching the price. That greater magnetic pull in part is generated by the vacuum effect. For example, if the market is having a bear rally toward a bear trend line but has not yet hit it, the sellers will often step aside and wait for the test. If they believe the market will touch the line, it does not make sense for them to sell just below the line when they can soon sell higher. The absence of selling creates a buy imbalance and therefore a vacuum effect that quickly sucks the market up. The result is often a bull trend bar. Then, the bull scalpers sell out of their longs for a profit, and the bears sell to initiate new shorts. Since there was no clear bull reversal at the low, most of the bulls bought for scalps, expecting only a pullback and then a resumption of the bear trend. Once the market gets to the target, traders think that the market will now more likely go down far enough to place a profitable trade, and they appear out of nowhere and short aggressively and relentlessly, driving the market down. The weak bulls who bought at the top of that strong bull trend bar are stunned that there is no follow-through, but they misunderstood the significance of the bull trend bar. They thought that traders were suddenly convinced that the market was going to break above the trend line and a bull leg would begin. They were oblivious to the vacuum effect and did not consider that the bears were just waiting for the market to get a little higher. The strong bull trend bar was due to the bears briefly stepping aside rather than the bears buying back their shorts. The bulls who kept buying needed to find bears to take the other side of their trades, and they could only find them higher, where the bears thought the market would begin to reverse. The market will continue down to an area of neutrality, and usually beyond, to the point that the bulls now have a mathematical edge. This is because the market never knows that it has gone far enough until it goes too far. Then it trades up and down above the area of neutrality, which becomes tighter and tighter as the bulls and bears are better able to define it. At some point, both perceive that the value is wrong, and the market then breaks out again and begins a new search for value. Every countertrend spike should be considered to be a vacuum effect pullback. For example, if there is a sharp bear spike on the 5-minute chart, and then the market suddenly reverses into a bull leg, there was an area of support at the low, whether or not you saw it in advance. The bulls stepped aside until the market reached a level where they believed that value was considerable, and the opportunity to buy at this great price would be brief. They came in and bought aggressively. The smart bears were aware of that magnet, and they used it as an opportunity to take profits on their shorts. The result was a market bottom on the 5-minute chart. That bottom, like all bottoms, occurred at some higher time frame support level, like a bull trend line, a moving average, or a bear trend channel line at the bottom of a large bull flag. It is important to remember that if the 5-minute reversal was strong, you would buy based on that reversal, regardless of whether you saw support there on the daily or 60-minute chart. Also, you would not buy at that low, even if you saw the higher time frame support, unless there was evidence on the 5-minute chart that it was forming a bottom. This means that you do not need to be looking at lots of different charts in search of that support level, because the reversal on the 5-minute chart tells you that it is there. If you are able to follow multiple time frames, you will see support and resistance levels before the market reaches them, and this can alert you to look for a setup on the 5-minute chart when the market reaches the magnet. However, if you simply follow the 5-minute chart carefully, it will tell you all that you need to know. In general, if the market tests an area of support 4 or 5 times, the likelihood of breaking through that support increases, and at some point, the breakout becomes more likely than not. If the buyers who lifted the market at this level fail repeatedly to do so again, they will give up at some point and be overwhelmed by sellers. For example, if the market is resting above a flat moving average, traders will buy every touch of the moving average, expecting a rally. If instead the market continues sideways and they don't even get enough of a rally to allow for a profitable scalp, at some point they will sell their longs, thereby creating selling pressure. They will also stop buying touches of the moving average. This absence of buying will increase the probability that the market will fall through the moving average. The bulls have decided that the moving average was not enough of a discount for them to buy aggressively, and they will do so only on a further discount. If it does not find those buyers within 10 to 20 bars after falling below the moving average, the market will usually either trend down or continue in a trading range, but now below the moving average. Traders will begin shorting rallies to the moving average, which will increase the chances that the market will begin to form lower highs and that the moving average will start to trend down. Once the market falls through support, it usually becomes resistance. And once the market breaks above resistance, it usually becomes support. This can also happen with a trend line or a trend channel line. For example, if a bull market pulls back to a trend line 4 or more times and it does not rally far above the trend line, at some point the bulls will stop buying tests of the trend line and they will begin to sell their longs, creating selling pressure. This is added to the selling of the bears, and since the bulls have stopped buying, the market will fall through the trend line. Sometimes, however, the market will instead suddenly accelerate to the upside, and the bears will stop shorting every small bounce and instead will buy back their shorts, driving the market higher. Institutional trading is done by discretionary traders and computer program trading has become increasingly important. Institutions base their trading on fundamental or technical information, or a combination of both, and both types of trading are done by traders and by computers. In general, most of the discretionary traders base their decisions primarily on fundamental information, and most of the computer trades are based on technical data. Since the majority of the volume is now traded by HFT firms, and most of the trades are based on price action and other technical data, most of the program trading is technically based. In the late 20th century, a single institution running a large program could move the market, and the program would create a micro-channel, which traders saw as a sign that a program was running. Now, most days have a dozen or so micro-channels in the E-mini, and many have over 100,000 contracts traded. With the E-mini currently around 1,200, that corresponds to $6 billion, and is larger than a single institution would trade for a single small trade. This means that a single institution cannot move the market very far or for very long, and that all movement on the chart is caused by many institutions trading in the same direction at the same time. Also, HFT computers analyze every tick and are constantly placing trades all day long. When they detect a program, many will scalp in the direction of the program, and they will often account for most of the volume while the micro-channel program is progressing. The institutions that are trading largely on technical information cannot move the market in one direction forever, because at some point the market will appear as offering value to the institutions trading on fundamentals. If the technical institutions run the price up too high, fundamental institutions and other technical institutions will see the market as being at a great price to sell out of longs and to initiate shorts, and they will overwhelm the bullish technical trading and drive the market down. When the technical trading creates a bear trend, the market at some point will be clearly cheap in the eyes of fundamental and other technical institutions. The buyers will come in and overwhelm the technical institutions responsible for the sell-off and reverse the market up. Trend reversals on all time frames always happen at support and resistance levels, because technical traders and programs look for them as areas where they should stop pressing their bets and begin to take profits, and many will also begin to trade in the opposite direction. Since they are all based on mathematics, computer algorithms, which generate 70% of all trading volume and 80% of institutional volume, know where they are. Also, institutional fundamental traders pay attention to obvious technical factors. They see major support and resistance on the chart as areas of value and will enter trades in the opposite direction when the market gets there. The programs that trade on value will usually find it around the same areas because there is almost always significant value by any measure around major support and resistance. Most of the programs make decisions based on price, and there are no secrets. When there is an important price, they all see it, no matter what logic they use. The fundamental traders, people and machines wait for value and commit heavily when they detect it. They want to buy when they think that the market is cheap and sell when they believe it is expensive. For example, if the market is falling, but it's getting to a price level where the institutions feel like it is getting cheap, they will appear out of nowhere and buy aggressively. This is seen most dramatically and often during opening reversals. The reversals can be up or down and are discussed in the section on trading the open in Book 3. The bears will buy back their shorts to take profits, and the bulls will buy to establish new longs. No one is good at knowing when the market has gone far enough, but most experienced traders and programs are usually fairly confident in their ability to know when it has gone too far. Because the institutions are waiting to buy until the market has become clearly oversold, there is an absence of buyers in the area above a possible bottom, and the market is able to accelerate down to the area where they are confident that it is cheap. Some institutions rely on programs to determine when to buy, and others are discretionary. Once enough of them buy, the market will usually turn up for at least a couple of legs and about 10 or more bars on whatever time frame chart where this is happening. While it is falling, institutions continue to short all the way down until they determine that it has reached a likely target and it is unlikely to fall any further, at which point they take profits. The more oversold the market becomes, the more of the volume is technically based, because fundamental traders and programs will not continue to short when they think that the market is cheap and should soon be bought. The relative absence of buyers as the market gets close to a major support level often leads to an acceleration of the selling into the support, usually resulting in a sell vacuum that sucks the market below the support in a climactic sell-off, at which point the market reverses up sharply. Most support levels will not stop a bear trend, and most resistance levels will not stop a bull trend. But when the market finally reverses up, it will be at an obvious major support level, like a long-term trend line. The bottom of the sell-off and the reversal up is usually on very heavy volume. As the market is falling, it has many rallies up to resistance levels and sell-offs down to support levels along the way, and each reversal takes place when enough institutions determine that it has gone too far and is offering value for a trade in the opposite direction. When enough institutions act around the same level, a major reversal takes place. There are fundamental and technical ways to determine support and resistance. For example, it can be estimated with calculations, like what the S&P 500 price earnings multiple should theoretically be, but these calculations are never sufficiently precise for enough institutions to agree. However, traditional areas of support and resistance are easier to see and therefore more likely to be noticed by many institutions, and they more clearly define where the market should reverse. In the crashes of both 1987 and 2008 to 2009, the market collapsed down to slightly below the monthly trend line and then reversed up, creating a major bottom. The market will continue up, with many tests down, until it has gone too far, which is always at a significant resistance level. Only then can the institutions be confident that there is clear value in selling out of longs and selling into shorts. The process then reverses down. The fundamentals, the value in buying or selling, determine the overall direction, but the technicals determine the actual turning points. The market is always probing for value, which is an excess, and is always at support and resistance levels. Reports and news items at any time can alter the fundamentals, the perception of value, enough to make the market trend up or down for minutes to several days. Major reversals lasting for months are based on fundamentals and begin and end at support and resistance levels. This is true of every market and every time frame. It is important to realize that the news will report the fundamentals as still bullish after the market has begun to turn down from a major top, and still bearish after it has turned up from a major bottom. Just because the news still sees the market as bullish or bearish does not mean that the institutions do. Trade the charts and not the news. Price is truth, and the market always leads the news. In fact, the news is always the most bullish at market tops and most bearish at market bottoms. The reporters get caught up in the euphoria or despair and search for pundits who will explain why the trend is so strong and will continue much longer. They will ignore the smartest traders and probably do not even know who they are. Those traders are interested in making money, not news, and will not seek out the reporters. When a reporter takes a cab to work and the driver tells him that he just sold all of his stocks and mortgaged his house so that he could buy gold, the reporter gets excited and can't wait to find a bullish pundit to put on the air to confirm the reporter's profound insight in the gold bull market. Just think, the market is so strong that even my cabbie is buying gold. Everyone will therefore sell all of their other assets and buy more, and the market will have to race higher for many more months. To me, when even the weakest traders finally enter the market, there is no one left to buy. The market needs a greater fool who is willing to buy higher so that you can sell out with a profit. When there is no one left, the market can only go one way, and it is the opposite of what the news is telling you. It is difficult to resist the endless parade of persuasive professorial pundits on television who are giving erudite arguments about how gold cannot go down and, in fact, will double again over the next year. However, you have to realize that they are there for their own self-aggrandizement and for entertainment. The network needs the entertainment to attract viewers and advertising dollars. If you want to know what the institutions are really doing, just look at the charts. The institutions are too big to hide, and if you understand how to read charts, you will see what they are doing and where the market is heading, and it is usually unrelated to anything that you see on television. Most major tops do not come from climaxes made of huge bars and volume, which are more common at major bottoms. More often, a top comes from a trading range, like a double top or a head and shoulders top, followed by a breakout in the form of a bear spike. However, tops can be climactic, and bottoms can be trading ranges. The chapters on trading ranges, further on and channels, in Book 1, describe how to use support and resistance to place trades. For example, traders will buy near the bottom of a channel or other type of trading range and short near the top, and then take profits and reverse on the test of the other side of the channel or trading range. In a strong trend, the market extends beyond most magnets. For example, in a bull trend, beginning traders will discover that the rally continues up far beyond every measured move target and trend channel line that they draw. These beginners will mistakenly be shorting at every perceived resistance level, finding their losses growing all day long. They incorrectly keep shorting tops that look great but are bad and refuse to buy pullbacks that look bad but are great. However, once there finally is a pullback or a reversal, it will always occur at a resistance level. Even in strong trends, measured move targets often work precisely to the tick. Obviously, this is in part because computers can calculate them accurately. Computers control the market, and their profit-taking has to be at some calculated level, which is always at some magnet. Additionally, if a trade is minimally good, meaning that the strategy is profitable, the reward has to be at least as large as the risk to create a positive trader's equation. This usually results in some profit-taking once the reward reaches the size of the risk, because this is the minimum level that the market has to reach to make the strategy profitable. Minor swings often end precisely at measured move projections, and many strong trends end exactly at, or within a tick, of a significant measured move target, as the price gets vacuumed to the magnet. The monthly chart of the Dow Jones Industrial Average, figure P 2.1, shows several types of support and resistance. All are magnets. Trend lines and trend channel lines are important support and resistance areas. The bar 18 bottom of the 2009 crash reversed up from below a monthly trend line drawn from the 1987 crash low to the October 1990 pullback. It also was at the trend channel line created by bars 8 and 12, creating a dueling lines pattern discussed in a later section. All major reversals up from bear markets occur at support and all tops occur at resistance, but most support and resistance do not stop trends. However, if there is a strong reversal pattern and it forms at a support or resistance level, institutions will take profits, and many will even enter in the other direction. Market bottoms more often come from sell climaxes, like the crashes of 1987 and 2009. Market tops more often come from trading ranges, like around bars 9 and 15. The bar 15 high was close to a measured move up based on the height of the bar 12 to bar 13 bull spike. The moving average repeatedly acted as support, like at bars 3, 4, 6, 8, 14, and 20, and resistance, like at bars 11 and 17. Trading ranges act as support and resistance. The breakout below the bar 9 trading range was resistance to the bar 11 rally, and the bar 15 trading range was resistance to the bar 17 rally. Once the market rallied up to bar 15, bar 16 found support at the top of the bar 9 trading range. Swing highs and lows act as support and resistance. Bar 12 found support at the bar 8 low and formed a double bottom. Bar 13 formed a double top with bar 11, but the market went sideways and soon broke above that resistance. Support became resistance and resistance became support in the 5-minute E-mini chart shown in figure P 2.2. This was true for both the moving average and for trend lines. Bars 1, 2, 5, 6, 17, 18, 19, and 20 found sellers on rallies to the moving average, and bars 7, 8, 13, 15, and 16 found buyers on minor pullbacks to the moving average. Bars 12, 13, 15, and 16 were repeated tests of the moving average, and the buyers were not getting rewarded and soon stopped buying the pullbacks. The market then fell below the moving average, and the bears began to short small rallies up to the moving average, creating a series of lower highs and lows. The bull trend line was a best fit line drawn with the objective of having as many bars as possible tested. Buyers were clearly buying in the area of the trend line, and it was tested more than a dozen times without a sharp rally away from the trend line. This lack of acceleration made the bulls more cautious over time, and eventually they became unwilling to buy in the area of the trend line. Once the market fell below the trend line, bulls became even more hesitant to buy and began to sell out of their longs, and bears became more aggressive. Lower highs and lows formed, and traders began to draw bear trend lines where they shorted rallies. Incidentally, any upward-sloping channel should be thought of as a bear flag, even if it is part of a bull market, because eventually there will be a break below the trend line, and the market will behave as if the channel was a bear flag for trading purposes. Likewise, any downward-sloping channel should be thought of as a bull flag, and its eventual breakout should be traded as if a bull leg is underway. Chapter 7. Measured moves based on the size of the first leg, the spike. A measured move is a swing that is equal in size to a prior swing in the same direction. You estimate how far the market will go on its second attempt based on how far it went on its first. Why do measured moves work? If you are looking for a measured move, then you believe that you know the always-in direction, which means that you are probably at least 60% certain that the move will occur. The measured move is usually based on the height of a spike or trading range, and the initial protective stop is usually beyond the beginning of the first move. For example, if there is a strong buy spike, then the initial protective stop is one tick below the low of the spike. If the spike is huge, traders will rarely risk that much and will usually still have a profitable trade, but the theoretical stop is still below the spike. Also, the probability is often more than 60%. If the spike is about 4 points tall, then the risk is about 4 points. Since you believe that the measured move will occur and that the strategy of buying at the top of the spike is sound, then you are risking 4 points on a 60% bet. Mathematics dictates that your belief that the strategy will be profitable when the probability is 60% will be true only if the reward is at least as big as the risk. This is discussed in Chapter 25 about the mathematics of trading. This means that for the strategy to work, you need to have a 60% chance of making at least 4 points, which is the measured move target. In other words, the only way that the strategy works is if the measured move target is hit about 60% of the time. Since trading a trend is the most reliable form of trading, if there ever are strategies that work, then this has to be one. Is this the reason why measured moves work? No one knows for sure, but it is a plausible explanation and the best that I have imagined. Most measured moves are based either on spikes or on trading ranges. When one is based on a spike, it usually leads to a trading range, and when it is based on a trading range, it usually leads to a spike. For example, if there is a double top, which is a type of trading range, traders will often take partial profits once the breakout up or down reaches a measured move. Traders look for a breakout, which is a spike, and they usually expect some profit taking once the spike has reached the measured move area. If the breakout was with a strong spike, and there is no significant pause at the measured move target, the spike itself often leads to a measured move based on the height of the spike. Once the market gets there, traders will often begin to take profits, and the result will usually be a trading range. Once there is a pullback from a strong move, there is usually a second leg in the same direction, and it is often approximately the same size as the first leg. This concept is the basis for a few reliable techniques to project a possible target for the end of that second leg. That measured move area is a reasonable place to take profits on your trend position, and then you can wait for another pullback to re-establish your position. If there is a strong reversal setup, you can also consider a countertrend trade. When a market makes a sharp move and then has a pullback, it will likely have a second leg, and the second leg is frequently approximately the same size as the first. This is a leg 1 equals leg 2 move, but it is also called an ABC move or an AB equals CD. This alphabetical terminology is confusing, and it is simpler to just refer to the two moves as leg 1 and leg 2, and the pullback after leg 1 as simply the pullback. The confusion with the alphabetical labeling is that in the AB equals CD pattern, the B, C, and D correspond to the A, B, and C of the ABC move. The B leg of an ABC is the pullback, and it creates a thick area on a market profile CME Group's graph of price and time information. The middle of any thick area often leads to a measured move, and here the target is the same as the one based on AB equals CD. For example, for the AB equals CD in a bull trend, if you start at point R and add the length of the AB leg, which is B minus A, then add that to C, you get C plus B minus A. For the thick area, you start at R and then add the length of the AB leg, which is B minus A. Then move back down to 1/2 of the thick area, so subtract half of the BC leg. And then add the height of B minus 1/2 of the BC thick area to get the measured move up from the middle of the BC thick area. Both equations equal C plus B minus A and therefore give the same measured move projection. This is way too complicated, and it is of minor importance because you should not be fading the move with a limit order solely based on Fibonacci extensions or measured moves or any other magnet. They just provide a guide to keep you trading with the trend until they are approached, and at that point, you can consider countertrend setups as well. In addition to clear pullback entries that set up measured moves, sometimes there is a more subtle situation that is equally valid. When a market has a strong trend move, and then a fairly strong pullback leg, and then a trading range, traders can use the approximate middle of the range to project where the second leg of the pullback might reach. As the trading range unfolds, keep adjusting the line to where you estimate the midpoint is, and that will usually be around the midpoint of the pullback, once the move has finally completed its second leg. This just serves as a guide to where you should be anticipating the two-legged pullback to end and for the market to set up a trade for a resumption of the trend. You can also simply use a leg 1 equals leg 2 measurement. For example, in a two-legged bull flag, take the length of the first leg down and subtract that height from the top of the pullback to find a reasonable location for where the second leg down of the pullback might end. There is a variation of this in spike and channel trends where the height of the channel is often about the same as the height of the spike. This is especially true when the spike is strong, like one with exceptionally large trend bars or several strong trend bars with little overlap and small tails. When there is a strong spike, the market often makes a measured move in either direction, but usually in the with trend direction based on some combination of the open, close, high, or low of the first and last bars of the spike. For example, if there is a huge bull spike, take the number of points from the open of the first bar of the spike to the close of the final bar of the spike, and add that to the close of that final bar of the spike. The channel that follows usually will find some resistance in that area, and the market will often then correct down to the bottom of the channel. This measured move target is an area where you can take profits on your long position. Sometimes the market might make a measured move from the low of the first bar of the spike to the close or high of the final bar of the spike, or from the open of the first bar to the high of the final bar, so it is prudent to look at all the possibilities. Less often, the market will not form much of a channel up and will reverse to below the bottom of the spike, and then make a measured move down. It is important to remember that most of the time the market is in some kind of trading range, and therefore the directional probability of an equidistant move is 50%. This means that the market is as likely to go up X number of points as it is to go down that same number of points. When there is a trend, the odds are better in the trend direction. When there is a strong spike, the odds of follow-through might be 60% and sometimes even 70% if the overall chart pattern is consistent with a strong trend move. Also, when the market is at the bottom of a trading range, the probability favors a move up, and when it is at the top of the range, the probability favors a move down. This is because of market inertia, which means that the market tends to continue what it has been doing. If it is trending, the odds favor more trending, and if it is in a trading range, the odds favor that breakout attempts will fail. In fact, about 80% of trend reversal attempts fail, and that is why you should wait for them to evolve into pullbacks and then enter in the direction of the trend. Also, 80% of attempts to break out of a trading range fail, and it makes far more mathematical sense to fade the tops and bottoms of the trading range than it does to buy large bull trend bars near the top and short large bear trend bars near the bottom. Here is an example of a measured move that uses several assumptions. There was a strong bull spike made of 3 bull trend bars that broke out of a trading range. The next bar was a small doji bar, and this pause meant that the spike ended on the prior bar, which was the last of the consecutive bull trend bars. The breakout was strong because there was very little overlap between the bars, with the open of each bar at or above the close of the prior bar. The biggest tail on any bar was only 2 ticks, and a couple of bars had no tail on the bottom. The first bar was 3.5 points, 14 ticks tall. The second bar was 10 ticks tall. The third bar was 8 ticks tall. And the fourth bar had a 1-tick bull body but a 3-tick tail on the bottom and a 2-tick tail on the top. The doji was the first bar that lacked momentum, and it therefore told you that the spike had ended on the previous bar. The open of the first bar was 8 points below the close of the third and final bull trend bar in the spike, so the spike should be thought of as being 8 points tall, at a minimum. You could use the low of the first bar to the high of the third bar, or even the high of the doji fourth bar, but it is more conservative to use the smaller figure for your initial projection. If the second leg surpasses this target, then look at other targets. As that spike was forming, if you bought at any point, your stop on your trade might have to be below the bottom of the spike. For argument's sake, assume that you would risk to 1 tick below the open of the first bar of the spike. If you bought at the market at the highest tick when the spike was 3 points tall, then you would be risking about 3 points to make at least 3 points. At that moment, you believed that the market would have a measured move up equal to the height of the spike, which was 3 points tall. You knew where your stop was, and you didn't yet know where the top of the spike would be, but you knew that it would be at least as high as where you bought. Since you believed that the market was trending, you felt that the odds were better than 50-50 that the market would go up 3 points before it fell and hit that stop 3 points below. After the spike continued to grow to 7 points, you changed your assessment. You now believed that since the market was still trending, the odds were at least 50-50 that the market would go up 7 more points before it fell 7 points. At the moment, you already had 4 points of open profit on a trade where you were hoping for 3 while you risked 3. If you wanted, you could have bought more at the high tick of the spike, which was still forming, and then your risk would have been 7 points, maybe a few ticks more, since you would probably have wanted to risk to 1 tick below the bottom of the first bar of the spike, and your profit target would be 7 points higher. However, on your initial long, you were still risking 3 points, but now had better than a 50% chance of making a total of 11 points, the 4 from your entry to the current top of the spike, and then 7 more. Once that fourth bar formed, which was a doji, you then knew that the spike up had ended at the close of the prior bar, 8 points above the open of the first bar of the spike. At that point, you would have concluded that the market had more than a 50% chance of going up 8 more points above the close of the spike, before falling 8 points to below the open or bottom of the spike, maybe a tick or 2 more than 8 points on the downside, since the safest stop was beyond the start of the spike. Since the spike was so strong, the probability was likely more than 60%. As soon as the spike ended, two-sided trading began, and at that point uncertainty increased. The market corrected sideways to down, and then the channel up began. Although the market might have made a leg 1 equals leg 2 move up from the bottom of this pullback, where the spike was leg 1 and the channel was leg 2, when a spike is very strong, the more reliable target is the one based on the open of the first bar of the spike to the close of the final bar of the spike. As the market rallies, the probability of higher prices slowly erodes. When the bull channel reached about half of the distance to the measured move target, the directional probability of an equidistant move fell back to around 50 to 55%, and uncertainty once again was very high. Remember, a bull channel is usually followed by a move back down to the bottom of the channel and then at least a bounce, so the bull channel was actually the first leg of a trading range that had not yet formed. Once the market made it to the measured move target area, it was likely the high end of that incipient range, and the odds favored a move down. This is true of all trading ranges. This is an excellent area to take profits on your longs, and because so many traders take profits in the area of the measured move, the market begins to pull back. Most traders will not look to buy aggressively again until the market retraces to around the bottom of the channel, where a double bottom usually forms. This area is also a magnet. The bulls begin to buy again, and the bears who shorted at the top of the channel will take profits. Since the market is now around the bottom of the developing trading range, the directional probability slightly favors the bulls. Once the market enters the trading range, the directional probability of an equidistant move is again 50-50 whenever the market is near the middle of that range. If your risk is X points, you have a 50% chance of making X points before your stop is hit, and a 50% chance of losing X points before your profit target is reached. This is a byproduct of the markets being relatively efficient. Most of the time, they are efficient, and the odds of making X points before losing X points are close to 50-50. The best trading occurs when the odds are better than 50-50, but this often occurs during spikes, which are emotional, fast-moving, and difficult to enter. Traders understand this, and that is why the spike grows so quickly without any pullbacks. Traders keep adding to their positions all the way up because they know that, until the spike ends, the odds of making as much as they are risking are better than 50-50, and the odds fall to about 50-50 only once the channel is well underway. When that spike is forming, they do not know if there will be a pullback before the market goes higher, but they are confident that it will go higher in the near term. Rather than waiting for a pullback that may never come and therefore missing out on a strong trade, they buy at the market or on 1 to 4 tick pullbacks and risk to around the bottom of the spike. This urgency is behind the formation of spikes, and the increased risk keeps many traders away. Most beginners are unwilling to risk the 3 to 7 points. Instead, they should simply buy a small position, maybe 1/4 of their normal size, and take the risk, because that is what the institutions are doing. They understand the math and therefore are not afraid to take the trade. This move toward a 50-50 market is the basis of all measured move trades. The odds are out of balance, and the rally to the measured move is an attempt to restore uncertainty. The market invariably overshoots and has to backtrack to home in on a 50-50 market. The measured move area is an overshoot of the odds, and they then briefly favor the bears. Once the market retraces to the bottom of the channel, the odds again overshoot, but this time in favor of the bulls. When the market bounces back up toward the middle of the developing trading range, the odds are once again around 50-50 and the market is in balance. ExxonMobil, ZOM, had a strong first leg up from bar to bar B on the daily chart shown in figure 7.1, so traders bought the bar C higher low for a possible leg 1 equals leg 2 rally. Bar D slightly undershot the target, the top of the dashed line. Once in the area of the target, many traders saw what they thought might be two-legged bear rally after the sell-off to bar A. If you were to use ABC labeling, bar B is point A, bar C is point B, and bar D is point C. And because of this confusion, it is better to simply refer to the move up to bar B as leg 1, the sell-off down to C as the pullback, and the rally up to D as leg 2. Once there was a higher low at bar E and the rally broke above bar D, a trader could look at AD as a first leg that contains two smaller legs, AB and CD, and then stay long until there was a measured move up. Add equals F, and the target is the top of the solid line. Fibonacci traders also look to other extensions, 138%, 150%, 162%, etc., as valid areas in which to look for reversals, but this is too complicated and approximate. Once the market has clearly two-sided behavior, it is just as reliable to look to buy low and sell high whenever there is a strong signal. Sometimes a leg 1 equals leg 2 measured move has a leg 1 that is not the absolute low of the initial sell-off. The correction up from the first leg down is usually a two-legged move or a wedge bear flag, but the pullback from either often falls below the beginning of the corrective leg, as it did in figure 7.2 at bar 6. By the time bar 9 formed what appeared to be the end of the pullback from the first leg down, astute traders were open to the possibility that the correction up to bar 9 began at bar 4 and not bar 6, and therefore thought that the second leg down might be equal to the bar 1 to bar 4 first leg down instead of the bar 1 to bar 6 first leg down. The bottom of bar 12 was a perfect leg 1 equals leg 2 measured move to the tick based on the bar 4 end of the first leg. If the market instead continued down, then traders would have watched to see what happened once it fell to the area of the leg 1 equals leg 2 based on a leg 1 ending at bar 6. Why did it make sense to consider the possibility that leg 1 ended at bar 4? Traders were looking for a two-legged pullback up before the second leg down began, and the move up from bar 6 to bar 9 was in a channel and therefore likely just one leg. Elliot wave traders know that upward corrections can include a pullback that goes below the bottom of the initial move down, and they call this sideways type of correction a flat. The flat here would be the move up to bar 5, the move down to bar 6, and the move up to bar 9. Also, the move up to bar 5 was a reasonably strong bull spike, and therefore it was a possible start of the correction. The pullback to bar 6 from that spike up was a lower low pullback, and lower low pullbacks are common. Therefore, as the correction was unfolding, traders were not troubled by this interpretation. Bars 5 and 8 formed a potential double-top bear flag, but the breakout to bar 9 eliminated that possibility. However, whenever there is a breakout above a double top, traders watch to see if it fails. If so, this effectively is a wedge top. The three pushes up are the bar 5 and bar 8 double top, followed by the failed breakout to bar 9. Once the market spiked down to bar 10 after the failed breakout, traders believed that the second leg down from the bar 1 high had begun. There were some other noteworthy features on this chart. Bar 12 was an expanding triangle bottom with bars 4, 6, and 12 being the three pushes down. The first day opened with a sharp rally up to bar 3 and then a sharp sell-off down to bar 6 that extended about as far below the open as bar 3 did above it. Even though the range was small, it was about average for the recent days. The end of December often has small days. Whenever a day has an average range and the open is in the middle of the range, the market often tries to close around the open. Traders know this, and that is why the tight trading range that followed bar 7 had a good chance of having a breakout that tested the open of the day. The day closed at one tick above the open, and this formed an almost perfect doji candle on the daily chart. The rally to bar 9 was a breakout test of the sell-off below bar 3. The sell-off to bar 23 was a breakout test of the rally above bar 13, and it missed the break-even stops by one tick. It was also an exact test of the open of the day. In figure 7.3, Research in Motion RIM had a sharp move up to bar 2 after an opening reversal from below yesterday's low, and then a pullback to bar 3. Since a second leg up was likely after a strong 3-bar bull spike, if traders were interested in knowing where it might end, they could keep adjusting line B to be in the middle of the developing range. Once the market breaks out, they could make a parallel and drag it equidistantly up from line for a measured move, where they could expect to take profits. Even though the market was in a trading range, there was a slight bias toward an upside breakout because the move before the trading range was up and most of the bars in the trading range were bull trend bars, representing buying pressure. Until the market broke out of the triangle by going above bar 6, traders could have traded in both directions, as they can in any trading range. Since a trading range is an area where both the bulls and the bears have agreed that there is value, most probes away from the middle fail, and the market will get drawn back into the range. Eventually, the market will break away from the magnetic field and find value at a different price. When there is a news release that creates a spike, the spike often leads to a measured move where traders can look to take profits. In figure 7.4, at bar 1, the market was surprised by an announcement about the president proposing new banking regulations, and this led to two large bear trend bars. Once there is a pause bar like a doji, a bar with a large tail on the bottom, or a bar with a bull body, then you know that the spike had ended on the prior bar. Here, the spike lasted 2 bars and traders looked for a measured move down from the close of the final bar of the spike. They expected it to be about the same number of ticks as there were from the open of the first bar of the spike down to the close of the final bar of the spike. Sometimes the high of the first bar to the low of the final bar of the spike becomes the height of the measured move, but traders will always look at the nearest possibility first and look for bigger moves only if the first target failed to contain the market. This target is a good place to take your final profit on a swing short and then look for a pullback to short again. If there is a strong reversal signal at that test area, a countertrend trade can be considered. A spike can be followed by a measured move in either direction. In figure 7.5, there was a strong 6-bar rally on the open, but the market failed at the moving average on this large gap down day and ultimately reached a measured move to the downside. The move was based on the open of the first bar of the spike to the close of the final bar of the spike. Although most spikes end as soon as there is any pause bar, if the move continues up after the pause, you should consider the possibility that it will function like a spike, which it probably is on a higher time frame chart. Chapter 8. Measured moves based on gaps and trading ranges. Gaps are common on daily charts where the low of one bar is above the high of the prior bar or the high of a bar is below the low of the prior bar. If there is conviction about the direction of the market, the middle of the gap often becomes the middle of the trend. As the market gets near the measured move target, traders will look carefully at the exact target and often take partial or total profits in that area, and some traders will begin to take positions in the opposite direction. This often leads to a pause, a pullback, or even a reversal. When a breakout occurs on an intraday chart, only rarely will this kind of gap appear. However, there is often something just as reliable, which is a gap between the breakout point and the first pause or pullback. For example, if the market breaks out above a swing high and the breakout bar is a relatively large bull trend bar and the low of the next bar is above the breakout point, then there is a gap between that low and the breakout point, and that often becomes a measuring gap. If the bar after the breakout is also a large bull trend bar, then wait for the first small bull trend bar, bear trend bar, or doji bar. Its low is then the top of the gap. If the breakout point or the breakout pullback is unclear, the market will often just use the middle of the breakout bar as the middle of the gap. In this case, the measured move is based on the start of the rally to the middle of the breakout bar. The market would then be expected to rally for about the same number of ticks above that level. If the market pulls back within a few bars of breaking out and the low of the pullback is in the gap, then the gap is now smaller, but its midpoint still can be used to find a measured move target. If the market pulls back further, even to a little below the gap, the midpoint between the breakout point and that pullback can still be used for the projection. Since the difference between the breakout pullback and the breakout point is then a negative number, I call this a negative gap. Measured move projections are less reliable when they are based on a negative gap. On a market profile, these intraday measuring gaps where the market moves quickly are thin areas between two distributions and represent prices where the market is one-sided. The distributions are fat areas and are simply trading ranges where there is two-sided trading taking place. A trading range is an area of agreement on price, and its middle is the middle of what bulls and bears think is fair. A gap is also an area of agreement. It is an area where the bulls and bears agree that no trading should take place, and its middle is the midpoint of that area. In both cases, on a simplistic level, if those prices are a midpoint of agreement between bulls and bears, then they are a rough guide to the midpoint of the leg that contains them. Once they form, swing part or all of your with trend entries. As the target is approached, consider counter-trend entries if there is a good setup. Most traders use the height of the prior trading range for measuring, which is fine because the exact distance is only approximate no matter how you do it. Unless you are a Fibonacci or Elliot wave trader and have the uncanny ability to convince yourself that the market almost always creates perfect patterns, despite the overwhelming evidence to the contrary. The key is to trade only with the trend, but once the market is in the area of the measured move, you can begin to look for counter-trend entries. However, the best counter-trend trades only follow an earlier counter-trend move that was strong enough to break the trend line. If the market pauses after the measured move is reached, the two strong trend legs might be simply the end of a higher time frame correction. And if that appears to be the case, then swing part of any counter-trend entry. Two legs often complete a move, and the move is usually followed by at least a protracted counter-trend move that has at least two legs, and it sometimes becomes a new, opposite trend. The counter-trend move will often test all the way back to the breakout point. Sometimes the projections are exact to the tick, but most of the time the market undershoots or overshoots the target. This approach is only a guideline to keep you trading on the correct side of the market. The middle of a gap often leads to a measured move. In Figure 8.1, the E-mini had a gap up at bar 3 above the bar 2 high of the previous day, and the middle of that gap was a possible middle of the move up. Traders measured from the bar 1 bottom of the rally to the middle of the gap, and then projected that same number of points upward. Bar 4 came within a couple of ticks of the projection, but many traders believe that a target in the E-mini has not been adequately tested unless the market comes to within 1 tick of it. This gave traders confidence to buy the sharp sell-off on the open of the next day down to bar 5. The high of the day was 2 ticks above the measured move projection. The market sold off on the next day down to bar 7, but rallied again to test just below the target. On the following day, the bulls gave up, and there was a large gap down and then a sell-off. There were certainly news announcements that the television pundits used to explain all of the moves, but the reality was that the moves were based on math. The news was just the excuse for the market to do what it was already going to do. Figure 8.2 shows 2 days that have measured moves based on thin areas. A thin area is a breakout area where there is very little overlap of the bars. The market had a sharp move up from bar 3 on the Federal Open Market Committee (FOMC) report at 11:15 a.m. PST and broke above the bar 2 high of the day. The flag at bar 4 tested the breakout with a 2-legged sideways correction, and there was a small negative gap between the top of bar 2 and the bottom of the bar 4 breakout test. If you subtract the high of the bar 2 breakout point from the low of the bar 4 pullback, you get a negative number for the height of the gap. Although the middle of a negative gap sometimes yields a perfect measured move, more commonly the end of the measured move will be equal to the top of the breakout point, here the bar 2 high, minus the bottom of the initial trading range, here the bar 1 low. You could also use the low of bar 3 to calculate the measured move, but it is always better to look at the nearest target first and to consider further targets only if the market trades through the lower ones. The market reached the line C target from the line A, bar 1, to line B measured move exactly on the last bar of the day, and poked above the line D target using the bar 3 to line B projection on the open of the next day. Even though bar 1 is higher than bar 3, it can still be considered the bottom of the measured move by thinking of the sell-off to bar 3 as just an overshoot of the bar 1 actual low of the leg. On the second day, there was a gap below bar 7 and above bar 8, and the line F target was exceeded just before the close. Incidentally, there was also a double top bear flag at bars 8 and 9. Apple was in a strong bull trend on the monthly chart shown in figure 8.3. Whenever there is a trend, traders look for logical levels where they can take partial or full profits. They usually turn to measured moves. Bar 13 was just above the measured move based on the strong rally from bar 4 to bar 5. Bar 10 was a bull trend bar that broke out above the bar 9 pullback from the attempted breakout above bar 5. Every trend bar is a breakout bar and a gap bar, and here bar 10 functioned as a breakout gap and a measuring gap. Although bar 11 spiked below bar 10, the move down was unlikely to have much follow-through as a failed breakout bar because the signal bar was the third consecutive strong bull trend bar. This was too much momentum to be a reliable short. The market tested into the gap above bar 9 again at bar 12, and this pullback gave traders a potential measuring gap. The market turned down at bar 13, about 3% below the target based on the move up from the bar 8 low to the middle of that gap. It might be in the process of forming a 2-bar reversal, which could lead to a deeper correction that could have a couple of legs and last for 10 or more bars. Since bar 13 was the 6th consecutive bull trend bar, the momentum up was still strong. When this much strength occurs after a protracted bull trend, it sometimes represents a climactic exhaustion of the trend and is followed by a large correction. This is a reasonable area to take partial or full profits on longs, but not yet a strong enough setup for traders to be initiating shorts based on this monthly chart. However, since there is not yet a clear top, the market might have another push up to the measured move target based on the bar 10 gap. Although it is too early to tell, traders might be using the bar 8 low to the bar 9 high to create a measured move target. Although not shown, that target is just slightly below the target based on the bar 4 to bar 9 bull spike, which the market already exceeded. Traders need to see more bars before they know whether the high is in or it will reach the target based on the bar 10 gap. If it does, it may or may not find profit takers and shorts, but since it is a clear measured move magnet, it is a logical area for both to be present. As shown in figure 8.4, the move down to the breakout pullback bear flag around bar 3 was steep, and a reasonable target for a measured move down is from the top of the leg bar 2 to the approximate middle of the flag line C. This projected to line D, which was overshot and led to a moving average test. You could also have used the bar 1 high for a measurement, but you should generally look at the start of the current leg for your first target. After the line D target was reached, the line E target based on the bar 1 starting point was hit soon afterward. Note that the move down to bar 4 from bar 2 was a strong bear trend with no significant trend line break, so it was best to stick to with trend setups. The small wedge bear flag around bar 4 was mostly horizontal and therefore a possible final bear flag. But since there had yet to be a sharp rally, like a gap bar above the exponential moving average, countertrend trades had to be scalps if you took them at all. You should take them only if you are a good enough trader to then switch to with trend trades as soon as one developed. If you are not, you should not be trading countertrend, and instead you should be working hard to take with trend entries. Just being in the area of a measured move is not enough reason for a countertrend entry. You need some earlier countertrend strength. On the second day, there was a flag around bar 10 after the breakout above bar 8. This breakout above the double bottom bull flag projected up to line H. The first bottom was the 1-bar pullback in the spike up from bar 7. If instead you used the bar 7 low of the day, the target would have been reached shortly after the gap up on the following day. Once there is a breakout flag, it is wise to swing part of your with trend trade until the measured move is reached. At that point, consider a countertrend trade if there is a good setup. As shown in figure 8.5, line B is the midpoint of the thin area in between the breakout, the high of bar 2, and the low of the first pullback, the low of bar 5. The measured move was hit to the exact tick at bar 8. Line E was the midpoint of a thin area, and the market greatly overshot its line F projection. The breakout from the bar 12 bear flag had a huge thin area down to bar 13, but it was so late in the day that a measured move from its midpoint was unlikely to be reached. However, at that point the day was clearly a bear trend day and traders should only be shorting unless there was a clear and strong long scalp. There were a couple in the final hour. The 5-bar spike down to bar 13 led to a measured move down, and the low of the day missed it by a tick. Incidentally, the move to bar 7 broke a trend line, indicating that the bears were getting stronger, and the move to bar 9 broke a major trend line, setting up the bar 10 lower high test of the trend extreme bar 8, and the subsequent bear trend that followed. Chapter 9. Reversals often end at signal bars from prior failed reversals. The entry price of an early reversal that failed is often a magnet for a later, successful reversal. For example, if there is a bear trend and there have been several bull entries that failed as the market continued to sell off, each of these entry prices and the highs of every signal bar will be targets once a reversal up finally succeeds. The market will often rally all the way to the highest signal bar's high before having a significant pullback. It is likely that some traders who entered on those higher signals scaled in as the market went against them, and they then used their initial entry as their final profit target, exiting breakeven on their worst entry and taking profits on all of the lower entries. It might just be that smart traders believe this to be the case and will dump their longs at those targets, or it might simply be one of the many secret handshakes that all great traders know, and they exit there simply because they know that it is a reliable recurring pattern for pullbacks to end near earlier entry points. It can also be something of a, "Thank you, God, I will never do this again," price for traders. They did not exit a losing trade, and their loss kept growing while they kept hoping for the market to come back to their entry. When it finally does, they exit and swear that they will never make that mistake again. There is a mathematical basis for just about everything that happens in trading, especially since so much of the volume is generated by software algorithms that are based on statistical analysis. In the example of that bear trend that reversed up, that earliest buy signal is often at the start of a bear channel. When a bear channel begins, the directional probability of an equidistant move is at least 60%. That means that the market had about a 60% chance of falling 10 ticks before rallying 10 ticks. It can be any size move that is within reasonable reach based on the recent swings, but the key point is that the market has a downside bias. As the market falls and the momentum slows, the directional probability falls to around 50% when the move down is about half over. But the price of this neutral area is usually not knowable until after the market forms a trading range. As it continues to fall down to some significant magnet, the directional probability overshoots neutrality and actually shifts in favor of the bulls. In the middle of the trading range, there is uncertainty, but once the market hits the bottom, there is agreement that the market went too far. At this point, the directional probability favors the bulls. It will then rally and begin to form a trading range. The directional probability always favors the bulls at the bottom of a trading range, and that bottom will be at some key technical price. There are many to choose from as the market is falling, and most do not lead to a clear buy setup. Some firms will write programs based on one or more technical support levels, and other firms will use others. When enough key technical areas occur in close proximity, there will be enough volume betting on a reversal to change the direction. At that point, the math is on your side because you are buying at what will be the bottom of a trading range. The reversal point is never known with certainty in advance, but it will happen with some kind of reversal pattern. It is important to watch for these patterns when the market is at key technical levels, like at measured move targets, trend lines, and even higher time frame moving averages and trend lines. This is discussed further in the chapter on reversals in Book 3. It is usually not necessary to look at lots of charts in search of setups, because there will be a reasonable setup on every chart if you are patient, vigilant, and aware of the patterns. Once the market turns up, it will usually try to form a trading range, and the first possibilities for the top of the incipient trading range are those earlier long entry prices. The market will try to rally to the top of those bull signal bars. As it is going up, the directional probability falls back to 50%, and it continues to fall further as the market gets near the top of the range. Since that top is never known in advance, and the middle of the trading range where the directional probability is neutral is never known in advance, the market overshoots until it hits some technical level where traders believe it is clearly overdone. This is often at the level of those earlier buy signals. Remember, the directional probability favored the bears when the price was last there, and when it gets there another time, it usually favors the bears once more. That is why the market typically turns down there again. It is a price where the sellers took control. The rally often forms a double top with one of those earlier entry bars and then turns down, at least briefly, as the trading range evolves. The market will often go up and down as it searches for uncertainty, which means a neutral directional probability of 50%. At some point, the market will decide that this area no longer represents value for both the bulls and the bears, and that it is a bad price for one side. The market will then trend again until it finds a price that both the bulls and the bears see as a good price at which to initiate positions. The monthly chart of the SPY, an exchange-traded fund that is comparable to the E-mini, had a strong bull trend that ended in 2000. But there were several attempts to reverse into a bear trend as the market continued up. See Figure 9.1. Each of the bear signal bar lows, bars 1, 2, and 3, was a target for any correction on the way down. Likewise, the bear trend that ended in 2003 had several failed bull reversal attempts along the way, bars 4, 5, and 6, and the high of each bull signal bar was a target for any subsequent rally. Also, the rally from 2003 had several failed bear attempts, bars 7, 8, 9, and 10. And each one was a target in the bear trend that ended in early 2009. That sell-off had several bottom attempts, and the high of each of those buy signal bars, bars 11, 12, and 13, is a target for the current rally. Finally, the rally up to bar 17 had several attempts at a top bars 14, 15, and 16. And the bottom of each of those sell signal bars is a magnet on any sell-off. None of the targets ever has to be reached, but each is a strong magnet that frequently draws the market back to its level. Chapter 10. Other magnets. There are many other price magnets that will tend to draw the market toward them for a test. Here is a list of some. Many of these are discussed elsewhere in the books. When a market is trending toward a magnet, it is prudent to trade with the trend until the magnet is tested and preferably overshot. Do not trade countertrend at the magnet unless there has been some prior countertrend strength like a trend line break, or unless the move is a pullback in a higher time frame trend. Trend lines. Trend channel lines. Any measured move target including a leg 1 equals leg 2 projection. Spike and channel. The start of the channel is usually tested before long. High, low, open, and close of yesterday. Swing highs and lows of the past few bars or even days, often setting up double bottom bull flags and double top bear flags. Breakout points. Gaps of any kind, including moving average gaps. The extreme of a trend after every type of pullback. See Chapter 11 on the first pullback sequence. Trading ranges from earlier in the day or prior days, including tight trading ranges and barbed wire. The extremes and the middle often get tested. The approximate middle of the range on a trading range day, especially if there is an intraday trading range in that area, a fat area. Final flags. After the breakout from the flag, the market comes back to the flag and usually breaks out of the other side. Barb wire. Entry bar and signal bar protective stops. Entry price breakout test. Huge trend bar opposite extreme, the low of a huge bull trend bar and the high of a huge bear trend bar. Common profit targets for scalp and swing positions. In Opal, 50 cents and $1. In the 5-minute E-mini, 5 to 6 ticks for a 4-tick scalp, and 3, 4, and 10 points for a swing. A move equal to the size of the required protective stop. If an E-mini trade required you to use a 12-tick protective stop to avoid getting stopped out, expect the move to ultimately reach 12 ticks in your favor. Daily, weekly, and monthly swing highs and lows, bar highs and lows, moving averages, gaps, Fibonacci retracements and extensions, and trend lines. Round numbers like hundreds in stocks, e.g., Opal at $300 and thousands in the Dow Jones Industrial Average, Dow 12,000. If a stock quickly moves from $50 to $88, it will likely try to test $100 and usually go to $105 or $110 before pulling back. When there is a huge trend bar with small tails, traders who enter on the bar or soon afterward will often put their protective stops beyond the bar. It is fairly common for the market to work its way to those stops and then reverse back in the direction of the trend bar. Bar 1, in figure 10.1, is a huge bull trend bar with a shaved bottom. The market reversed down off the bear inside bar that followed and formed a higher low, but not before running the protective stops below the low of the trend bar. Smart traders would have shorted the inside bar, but they were ready to go long above the bar 2 bull reversal bar that hit the stops and then turned the market back up. Bars 3 and 4 were also huge trend bars with small tails, but neither was followed by an immediate pullback that ran stops.
And with that, we've completed Chapter 10 and finished Parts 1 and 2 of Trading Price Action, Trading Ranges. Understanding trading ranges is a critical skill, one that separates emotional trading from disciplined decision-making. Take time to study these concepts, review the charts, and let price action guide your decisions. If this audiobook helped you, please share it, give it a thumbs up, and subscribe to support the channel. Thank you for listening, and I'll see you in the next part of the journey.